Got one more slide? Could you move the slide? The clicker stopped working. Anyway, thank you. So the purpose of this conference, from my point of view, is not just to bring you all together and learn something, although that's worth enough. It's to ask, after 50 years of floating exchange rates, can we actually do any better? If we sat down and tried to build a new regime or tried to alter the current regime, could it be better? And that's what we're going to spend the next day and a half trying to find out. Thank you all for joining us on this journey. I think it's an important one. And with that, I believe Maurice, the Fred Bergston Fellow to be, chairs the first session.
Okay, thank you, first of all, Adam, for those kind words. It's a great honor to occupy this chair named after Fred at the Institute, and I will, when I introduce Fred in a minute, you'll see why I feel that way. It's also a great honor to follow Olivier. I seem to always be following Olivier and then finding that my feet are too small to fill his shoes. So maybe I need thicker socks or multiple pairs of socks or something. But I also want to thank the Institute for sponsoring this conference and all of you for agreeing to participate and attend. I think it's going to be a very interesting day and a half. And I think one of my goals here will be to get the dollar or exchange rates back into that list of priorities that Adam showed you. Our first panel is on from here to there, from there to here, 1973 expectations and 2023 reality. This is one of the few panels where I'm going to be the youngster around the group, which feels great. Because we have some very distinguished participants who commented on or participated in, to some degree, some of the events that occurred, or at least much closer to it than I am, and than most of us are. Just as a sort of housekeeping thing for all the panels, each speaker will have 10 minutes. At least for this panel, I will sit in the front and obnoxiously hold up a sign telling you to stop when it's time to stop. And basically, I'm hoping that each speaker can come up here and go through their slides, then return to the round tables, and then when all speakers have finished, they'll come up to the table for the Q&A session. Let me introduce our very distinguished group, and they will go in alphabetical order, and that's the order in which I will introduce them. Bob Aliber joined the faculty at Chicago GSB, as it then was, in 1965. Has been a leading scholar on exchange rates and international financial markets. When I was in grad school, I followed the very influential Wingspread conferences that he organized, and most recently, over several editions, he's been updating the famous Kindleberger classic, Manias, Panics, and Crashes, which became Kindleberger and Aliber, and now it is Kindleberger, Aliber, and Macaulay, and the world seems to not stop producing Manias, Panics, and Crashes to keep updating the book. So I think it's going to have a long life. C. Fred Bergston is a non-resident senior fellow and a member of the board of directors here at Peterson. He is also the founding president and president emeritus of the Institute. And he has an incredible range of policy experience in the White House, at the Treasury, reaching back to the Nixon administration. In the 8 years in which data on quotations of think tank economists were kept. I'm not sure what those 8 years were. He was consistently the most widely quoted, which doesn't surprise me at all. We also have Ann Kruger, a senior fellow at SAIS, Johns Hopkins, and professor emeritus at Stanford. Anne has been an incredibly influential writer on development, on trade, on exchange rate issues, was chief economist at the World Bank, and was deputy managing director at the IMF. Richard Fortas is here also. Richard is the founding president of the Center for Economic Policy Research in, well, London and Paris now. I think it's fair to say that the CEPR turbocharged European economics more than any other institution I know of, and created a global community centered in Europe, which has been immensely productive and influential. And the organization goes from strength to strength with a big imprint on policy and as well as on pure research. And our final panelist is Ted Truman, a senior fellow at the Mosavar Rahmani Center for Business and Government at Harvard, at the Kennedy School, formerly a senior fellow here at Peterson. Ted was the head of the International Finance Division at the Fed for more than 2 decades, did a number of tours at Treasury where he was immensely influential in actually getting things done that nobody knew you could get done, but that were very helpful for individual crisis countries and for the world economy. Justice had an immense impact through his policy advice and writings. So with that, again, let me remind the speakers of the 10-minute target, and we'll start with Bob Aliber. I'm praying that the clicker works. But thank you. Here it is. We also have to get the.
Thanks. Thank you very much. Here's my agenda for the day. But first, I'd like to start with several commercials. The first is for the Graduate School of Business. Pete Peterson graduated from the Graduate School of Business in 1951, and like so many other graduates, has been remarkably successful. In his case, he's been remarkably generous as well. The second commercial is for the 8th edition of Manias, Panics, and Crashes, which appeared last week. And the Silicon Valley Bank crisis appeared at the same time. Now, I want to start with a personal experience. In August 2004, I got an announcement from my credit card company. You have been pre-approved for a balance transfer at 0 interest rates for a year. Have any of you ever received such an announcement? So I called MBNA and said, have I read this correctly? And they said, yes. And then I said, what's my credit line? And there was a long pause. And then the response was $100,000. And I said, please wire $100,000 to my account at the LaSalle National Bank in Chicago. And I went out to Independence, Kansas, and bought a new Cessna aircraft. Thank you, MBNA. Thank you, Mr. Greenspan. we've had 70, 80 banking crises since 1980, and they're all alike. They're all alike. And I'm going to convince you of that in a couple of minutes. Because I admire this 10-minute contract time, I'm going to go to the last topic on my agenda, the costs of flexible exchange rates to the United States. Somebody here, no doubt, will come forth with the remark of Secretary of the Treasury Connolly, the dollar is our problem and your currency. That's one of the most stupid remarks a Secretary of the Treasury has ever made. Right. We allow foreigners to determine our immigration policy, our tax policy, our policy on abortion. But what we've essentially done for the last 50 years is allow foreigners to determine the value of the dollar. And we've lost 3 million manufacturing jobs, and there are other costs. Now, let me come to the second item on my agenda. The most influential argument about floating exchange rates is Milton's classic article. And then we have the reinterpretation by Egon. Let me tell you what it was like being a graduate student in New Haven in 1960 when Egon came from Austria to New Haven. And we had different views on exchange rates. The success of that article is that they hid the capital account. And for 60 years, the critics have been pointing to phenomena that have come from capital account transactions, and Milton and Egon would come back with one-off anecdotes. And I think if you read the transcript of the 1969 conference at Melvin Village, the Boston Fed conference, Milton, the empiricist, was replaced by Milton, the evangelist. Some facts were made up. So I have a central proposition today. Let's look at the incentive for cross-border capital flows. And so we have the interest rate differential and the anticipated change in the price of the currencies, both with and without parities. The interest rate term is much larger and more variable in a world without floating. And the exchange rate term clearly is much more variable. And the difference between the two terms is much more variable. So we've had much larger cross-border capital flows. And if we come now to the second line, this is the definition. Now we have tremendous variability in K, and that means that C must adjust. And this is a story of how I bought my first Cessna, that we had a massive inflow of capital to the United States, and that we had an asset price boom as a result of that capital inflow. C had to adjust. This is a definition. It cannot be falsified. If K is the shock, C is the induced variable. We have had 4 asset price bubbles since 1980, and each of those 4 asset price bubbles is the result of a surge in the foreign demand for US dollar securities. Right? So this is a story of the 1980s. It was a story of the 1990s. You will remember that Alan Greenspan in December 1996 spoke about the exuberance in the currency market, and then stock price values doubled in the next 3 years. What happened? We had the Asian crisis. Asia developed a very large capital account deficit. There had to be a corresponding capital account surplus. That corresponding capital account surplus was in the United States. If the United States had a increase in its capital account surplus, it needed a corresponding increase in the current account deficit, and so we had an asset price boom. and that paid for the first Cessna. So if we could go to the last, oh, I have the control. So what are the costs of the United States? The value of our currency has been determined by our trading partners. We've lost we've lost 15 to 20% of our manufacturing jobs because foreigners love US dollar securities. We've had an overpriced dollar, and as a result, the incentive to invest in the production of tradable goods has been smaller, and that has meant that we have grown less rapidly. We've had 4 consumption booms as a result of, which have been induced as a result of capital inflows. So can you see my Make America Great cap? It has a blue background. But we have become essentially protectionists in some way. We've lost our initiatives toward global integration because foreigners have given us an overvalued dollar. Thank you very much.
Let me start by echoing Adam and saying how great it is to have Maurice joining the Institute and how honored I am to have my name on the chair that he will now be filling here. So it's a great thrill, actually, to have that happen and to work with you on this session today. I, too, am going to start with an anecdote, personal anecdote, but of a very different kind. In the summer of 1972, midway between the 2 big currency realignments, dollar devaluations, that are the baseline for our conference today, I attended the Summer Olympics in Munich for its last 2 weeks. Now, you will remember that at that Olympics, the Palestinian terrorists kidnapped and later murdered a number of Israeli athletes and trainers. And one result of that was to delay the entire Olympics by a day, the result of which in turn was to delay my return flight home by a day. So when I got to the airport in Frankfurt to change my schedule to come back, I was told that was fine, but I had to pay additional amount because I'd moved outside the window of the fee I had paid earlier. I said, fine, and I rolled out some $100 bills to pay the fee, to which the airline counter said, sorry, we don't take dollars. Now, this was the world's key currency, the dollar, becoming inconvertible into the assets of the US's flagship airline of the day, Pan American, in the financial capital, Frankfurt, of the world's second key currency of the time, the Deutschmark, and was kind of an indicator of the degree to which the international monetary system was not performing. I happened to write a couple of books at the time, one called The Dilemmas of the Dollar, another was an edited volume of articles by a lot of the top people in the field at the time. I use that as kind of my baseline for trying to address the question Maurice raises. What were the expectations at that time, and what were the hopes, actually, of the people that were involved at the time? The minimum hope and expectation was to avoid repetitions of the kind of problem I had faced at the Frankfurt airport, to restore convertibility of the world's leading currencies. But there was widespread agreement that there were 3 big problems that had to be resolved. Fritz Machlup had his famous trilogy: adjustment, better adjustment process needed for the imbalances, enough liquidity to finance ongoing international trade and investment, and a restoration of confidence, including particularly in the world's key currency, the dollar, as it was at that time. But I have to say, as I went back and looked at the documents from the time, including what I'd written, expectations were pretty low. people that were advocating change, of course, expected it to occur through negotiation and sweet reason, but in fact, it occurred through crisis. As Adam was saying, the dollar going off gold in 71, the subsequent period of turmoil in the markets, it was not a negotiated reform. And I had 2 long talks with Paul Volcker about it, actually, during the last year of his life, a couple of years ago, and we reminisced about it. And at one point, I congratulated him. I said, Paul, one of the great things you did was lead the world into flexible exchange rates. And he said, no, Fred, I didn't lead the world. He said, we officials capitulated to the world. It was the markets, of course, which drove that outcome and created the regime of flexible exchange rates. But expectations were pretty low because it had created so many crises, led to that crisis. And I think it's fair to say that most of the officials who were involved, Ted will probably talk about this, most of the officials who were involved actually wanted, and this includes Volcker, wanted and expected to go back to fixed rates. After all, they did 2 major realignments to restore fixed rates, pushed through the Congress, $2 devaluations. It was their intention not to reform to flexible rates, but to go back to fixed rates. And that expectation obviously was dashed and didn't occur. Most of the academics who were advocating for floating rates, not Milton, but most of the others were willing to take some limited forms of flexibility, wider bands, crawling pegs, all that. But nobody could agree on anything. And when Ted and John Williamson and their colleagues worked on the Committee of 20 after the 2 years of turbulence, they were unable to agree on anything. And so the system basically capitulated to the markets and moved to floating rates. Now, fast forward to today, from there to here. That was there, and what about here? I would argue that there have been 3 or 4 big successes over the last 50 years coming out of that period of extreme turbulence. The first, and I would emphasize that, I guess this contradicts what my predecessor here at the podium said, I believe that the move from fixed to flexible rates was the most sweeping and most positive international monetary reform of all time. It was not negotiated. It was not intended by Connolly and Nixon and the people who triggered the crisis, to be sure, but that was the outcome. And the Nixon shocks, which I, along with many others, excoriated at the time as a terrible thing, actually turned out to be a benefit because it unfroze the old system and, over a period of admitted turbulence, led to a much, much improved adjustment process. Now, I don't want to overdo that and say that floating rates have solved all problems, and Bob's right, a lot of difficulty with it, including particularly for the US. But as we look at each of the major monetary crises of the last 25 years, from the Asian crisis, through dot-com, through global financial crisis, through COVID, and right up to the day with what's happening in the banking system today, in all of those crises, and here I'm going to echo what Adam said, the exchange rates have been calm and unperturbed. The exchange markets have been islands of stability during periods of otherwise economic, financial, and monetary disruption. And that, in my view, has got to be regarded as a big improvement. No longer when I go to the airport in Frankfurt do I worry about converting my dollars into Pan Am tickets. That's a huge change. Now, it obviously hasn't solved all the problems. We still had big imbalances. The markets have gotten things wrong. At the plaza, you had to bring down the hugely overvalued dollar that was driven by market forces. Governments had to intervene to bring it back down. You had governments messing things up by moving back to fixed rates, de facto. The Chinese with their massive manipulation. Bob says, Chinese set the dollar rate against the RMB. The Chinese current account surplus went to 10% of GDP, caused enormous domestic political pressures here. It was Chinese currency manipulation, not WTO entry that led to the bulk of the China shock, in turn creating enormous protectionist backlash here in the United States. So I don't suggest that the adjustment process has been perfect, but it has certainly been dramatically improved as a result of what happened way back 50 years ago. On the other variables, there's certainly been enough liquidity around. Bob Triffin worried there'd be enough liquidity to finance world trade and investment, therefore promote SDRs and the like. What happened, of course, was that the dollar continued to reign supreme. Its market share has gone down a bit. That will be talked about a lot at the conference. But certainly the increase in official reserves, mainly in dollar form, has been a tremendous source of increased liquidity, with countries from China on down to Hong Kong, Singapore, and many smaller countries piling up massive amounts of reserves way beyond what had ever been imagined in the past. So there's been plenty of liquidity. And confidence, despite all the disturbances, has been largely restored, particularly in the dollar, as the key currency. And as I say, there's really been very little focus on exchange rates in these crisis periods. The other thing they did 50 years ago was finally eliminate gold from the system and take that source of instability out. That too, I think, has to be regarded as a plus. Final substantive point, two big surprises, I think, today from where we were 50 years ago. One being that the dollar, and that'll be discussed here a lot, but the dollar still pretty much continues to reign supreme. I think most of the people at the time, including a lot of US officials, both wanted and did expect that the dollar's role would decline over certainly the subsequent 50 years. And it has a bit, but not a lot. And so it still maintains at the center of the system. The flip side of that was that a lot of people expected a big increase in the role for an international reserve asset. The SDR had already been created. The first implementation of SDRs had already occurred. And of course, that has not occurred in any significant way over the last 50 years. So dollar's still up, international reserve asset and cooperation is still somewhat down, and the world stepping somewhat similar now to what it was then, despite the fact that Charlie Kindleberger and I and others said the dollar's had it now as a result of all these crises in the early 70s. It has been remarkably resilient. Final story, Bob mentioned how Pete Peterson graduated from the University of Chicago Business School in 1951. And when Pete was invited by George Shultz to come to Washington to essentially succeed me in a much more elevated position to coordinate US foreign economic policy out of the White House in 1970 and 71, Pete consulted Milton about whether he should take the job. And Pete recounts that Milton said, no, you should not take the job at all. Because if exchange rates are not flexible, the job will be impossible. If exchange rates become flexible, the job will be unnecessary. And therefore, you should not take the job. Well, Pete wisely rejected Milton's advice. And of course, Milton was wrong, as Bob says, floating rates did not take care of all the problems. But the namesake of this institute had some ties with this original crisis of the time, was deeply involved in the Nixon shocks, which in my remit did lead to the most sweeping and positive international monetary reform of all time, despite its warts, despite its shortcomings, despite the fact that that's not the way all of us would have wanted to see progress made. I believe that's a major takeaway from the topic we discussed today. Thank you very much.
Interesting. I also plan to start with an anecdote. All of us, if you want to go back to those times. Let me just start first by saying that until the late 1950s, we had one balance of payments crisis after another, many of them associated, of course, with adjustments after the Second World War and so on. But there were also, and this is important, capital controls in all but 4 countries as of 1959. And that's, I think, an important fact to remember when you look back to what were exchange rates doing earlier on, because they do very different things with capital controls than they do otherwise. The Marshall Plan had primed the current account transactions in many of the countries they were supporting and sort of forced bilateral trading arrangements to move to multilateral among them, but that was not the end of capital controls. And that's, I think, important to remember. But where I want to start is a story from 1967, I believe. I was returning from Turkey, and I'd been asked on my way back. I had been in Turkey working at a conference, and the conference had been organized, I think, by some people who invited the IMF to send a representative, and they couldn't. So I was asked, since I was going anyway, would I represent the IMF? And that was, since there was no real function in representing, I said yes. But I was asked on the way back to stop in and talk to the very eminent and very impressive then head of the Exchange and Trade Relations Department at the IMF, Ernest Sturt. He was a Czech citizen, and he'd been the Czech delegate to Bretton Woods. Before that, he had received his PhD from the University of Chicago in, I think, 1937, but I'm not sure of that and meant to look it up. And he had returned, and when I saw him, the previous day from London, where he had been negotiating with officials of the British Treasury and European countries with regard to British devalued foreign exchange crisis, British foreign exchange crisis in 1967, and the pound had the night before been devalued. The pound rate was set at 14.2 to the dollar, fixed again, and he told me that the continental Europeans had said that if the pound were devalued any further, they would follow. They would not let it go any further than that for those reasons. 14.2 was all I could get, and he was sort of a little bit unhappy about that. He wanted 15 something or other. But his comment was the interesting thing, and as I said, he was at Bretton Woods. He said, I recall the final dinner at the Bretton Woods when Lord Keynes proposed a toast, and the toast was as follows: here is to no more competitive devaluations. Little did I, said Zurich, did I dream that I would spend the rest of my life persuading countries to devalue, which sort of an interesting sidelight. I think his father had actually been foreign minister of Czechoslovakia in the pre-war years, but I'd have to check that one too. I'm sure he was in the government. Anyway, there are many other episodes like that. Like Fred, I was caught, but it was in Amsterdam as I was going to London, having left Turkey and flying through Amsterdam. And I tried to exchange dollars for pounds at the Amsterdam airport, which didn't work, but they took my Turkish lira, which was an convertible currency, and the Turkish inflation rate was about 50% at the time. But it worked because there were lots of Turkish workers in the Netherlands. So I also got stuck on dollars at a time when it seemed fairly ridiculous. So it was, you are not unique in that regard, Fred, despite many others in which you are. Anyway, most advanced countries, of course, did have to follow the Bretton Woods obligations and by commitments made in connection with GATT membership. And between those two, and then the recipients of the Marshall Fund, by and large, the advanced countries managed their fixed rates fairly well with capital controls, but they weren't pressed upon terribly hard for the most part at that time. And of course, later on, capital accounts opened up, and I'll come back to that. But for developing countries, the situation was different. And it's interesting because the focus so far has been on what changed for developed countries, and of course, they mostly went to much more flexibility. The developing countries had started without even using the exchange rate as the way to allocate foreign exchange, because after going through their sterling balances, which many had accumulated during and after the Second World War, once they'd run those down and once they'd achieved independence and once they thought they wanted economic development, they forgot the budget constraint and in effect then discovered very quickly that they had current account deficits. And as many of my friends in those countries at the time explained to me, they could not devalue the currency because that would make capital goods cheaper. And without more capital goods, how could you get more growth? And without more growth, how would you ever get out of this mess? Which, of course, is not exactly a line of logic that most of us would entertain, but they did at the time. So many developing countries allocated foreign exchange through import licensing, about which I could tell lots of stories if there were more time. But at any event, with that import licensing, the exchange rate played a role, but it was a different one, namely in terms of giving premium to those who got the import licensing and setting up much of the corruption that has continued ever since. It also misallocated resources a lot. When I was in India, I was able to prove to the Ministry of Finance and the Ministry of Commerce that they were importing copper because they permitted it to be imported. And then it was being processed into copper vases and jars and stuff like this and exported. And the copper cost of the import was more than they got for the export. And it was perfectly sensible for people to do it, given the exchange regime that worked and all the rest of it. And there were many more stories like that. It was highly irrational. With that irrationality, of course, little by little, things got worse and worse. They repeat over and over again, was there a stop-go balance of payments crises? And as development economists at the time said, each stop-go crisis, and the stop is longer and harder. The go part is shorter with less growth. And you could see from the relatively high rates of growth in the early 1950s, they were slowing down and things were getting worse. But it was predominantly the advanced countries that abandoned fixed exchange rates 50 years later. Most developing countries are slower to move. It was fortunate, though, and in this I agree with Fred, but I would agree on the real side, that the abandonment was before, and I agree on his side too, but and the abandonment was before the massive oil price increase of 1973, which was a huge shock, much bigger than any later one, because it quadrupled the oil price. That went from something like 2% of GDP on average to 8%. It was huge. And for many developing countries, given their situation, it was even worse than it was for others. And at that time, the recycling mechanism could take place with oil dollars going into mostly European bank accounts, which in turn were relent to developing countries, which worked better because, of course, there was the flexibility on the European side, and that absorbed some of the shock in terms of other countries. However, gradually, an increasing number of developing countries decided to move to more flexibility, or at least willingness to adjust the exchange rate. South Korea abandoned its fixed exchange rate finally in 1966. Not to say it was totally free, but to say they let it move at least with the price level plus a bit more. Hong Kong never paid any attention to what it was. Taiwan had gone first, and they were pretty flexible. But they also had more sensible monetary policy and so on. But with that shift in exchange rate system, it's the second profound, or first of, some countries gradually saw others and moved in the same direction, so that the degree to which there was overvaluation and extremely high premia on import licenses diminished over time, even though many countries did not abandon the exchange control system until a decade or two later. But it was not unusual in the 1980s for exchange rates or the inflation rates up to about 1,000%. And the official rate is 2% of the black market rate, Ghana, for example. There were many of them, not just one or two. And we didn't even think anything of it. It was just the way the world worked. And when we talk about the international financial system, I don't think we should forget that those countries, even at that time, accounted for about 37% of world trade, as they were badly allocating, misallocating, and under-exporting by virtue of the problems. But the second profound change took place, the second profound change took place later, after Korea and so on had moved over and showed how successful things could be otherwise. And private capital flows began growing. Korea, it's often forgotten, borrowed 10% of GDP in private markets in every year for 10 years after 1960, and the debt to GDP ratio fell because they were going faster than that. And this showed other countries what could be done and what was possible. And so capital flows, the Koreans, of course, were creditworthy, and so that led the banks to lend to other countries and so on. And we moved to the current era, which is more one of the banking crises, which were referred to earlier. Earlier, they were foreign exchange crises because there was no foreign exchange. Later, they became other things. I'm going to skip a few things, but my colleagues, Ron McKinnon in particular, supported fixed exchange rates because they thought that would bring monetary and fiscal discipline. I think we were wrong in that. I don't think that was as much of an argument. I think what brought more fiscal discipline was simply the recognition of what went wrong when you use exchange control. And therefore, there wasn't as much of it. Secondly, we still have a lot of countries that use things like multiple exchange rates. My favorite example at the moment is Argentina. This week announced the introduction of the, which is the one this week, Malbec rate, which is going to be a special exchange rate for the export of Malbec wine. It already had a rate for the soybean rate was already there, and they announced there will be further rates soon. So we haven't completely lost the multiple exchange rate system. That stuff is still there, but not as much. And the countries that have moved have been the ones that have been more successful. I think we also have a lot of problems on other scores. I'll just very briefly that we need to sort out some of the conflicting claims between groups. We do not have a single government, and on the other hand, what's happening now is with the current focus where it is, but I think the multilateral institutions are being pushed into areas where they have less competence, and some of the things that should be more critical and are very important are being forgotten. I'd love to say much more, but I don't think Maury will let me. Thanks.
Did we get my slides up? Very good. Okay, well, you will all be pleased to see, I'm sure, that there is no ageism in this organization. No age discrimination here. Aside from Maury, I am the youngster on this panel, right? That's a change for me. I rather like it. But being in the company of these very distinguished people is the real pleasure. Unlike them, I wasn't there in a sense in 1973. I was a microeconomist. I wasn't doing things like this. So I don't speak from any personal recall. The past few years, past several years, I've been working on financial stability issues, macro PRU and all that, and that influences the perspective that I'm going to bring here. Now, let's see whether I can try the other way. That's it. So I'm looking from the perspective of, what was the case then and what's the case now. What's the same? We still have an asymmetric system. That's been mentioned. The US resisted the breakdown of the exchange rate mechanism, partly because it seemed to be an instrument of US hegemony. Some thought that losing the link to the dollar would bring an era of unbridled fiat money and huge inflation everywhere. But, there was significant inflation, of course, in the 1970s. Much of that was due to loose fiscal policy, especially, I have to say, in the UK, and, of course, to the oil shocks, already mentioned. And then tight monetary policy and inflation targeting brought that down. But the US dollar is still the dominant currency in the system. The US financial system is still the center of the global financial system, and the US is the world banker. Why not the euro? Why not China? And that's very simple. Europe has a very fragmented financial system, and China has a very closed financial system. And it's until there's a change in either or both that the dollar will stay where it is. Why is it still asymmetric? There are characteristics of fiat money that are very important here, in particular, the network externalities that we're familiar with. And that gives you a dominant player, and those characteristics are tied, as I said a moment ago, to the depth and range of the financial system and its integration with the global economy. I think we should also go back to the hegemonic stability story, but take it in reverse, that the need for stability drives the acceptance of a hegemon. Now, that might change. That's part of the so-called the deglobalization story, which I would question, but that's not for today. But can't question the falling weight of the US in the economy and the global economy. Will that translate eventually into more symmetry, more multipolarity in the global financial system? Well, I doubt that until, as I say, we see big changes, either in Europe or China or both, in the financial sector. And actually, if there is some merit in hegemonic stability, maybe we should want that asymmetry. Now, on the macroeconomics, not much change. It's at least as important are the global imbalances as they were pre-1973. We seem to live with them, but I believe, I wrote about it at the time in 2009, that they were one of the major causes of the global financial crisis. The long-term, very long-term historical data show a consistent downward trend in real interest rates. They were low already in 1973. They fell below zero in the mid-70s, as inflation went up, of course. There was as we know, monetary policy response in the US, a brief rise in the beginning of the 80s, but they've trended steadily down since. Talking about real interest rates here. And one final characteristic that of the macroeconomics that, of course, I worked on with Hélène, the role of distance in cross-border financial intermediation. That remains unchanged. Every study, there are hundreds of them now, that looks at portfolio allocation and foreign direct investment. Shows that despite the fact that you can now communicate with the touch of a button across the globe, distance matters a lot in financial transactions. So what's new? Crises. Barry and I wrote that piece, some people remember, in the mid-90s called Crisis, What Crisis? And that in turn was taken from for me at least, the story of the United Kingdom in the mid-1970s. Crisis, what kind of crises? Well, you had in succession the crises that I list there, including, in the end, the biggest one of all, the global financial crisis. And looking back, of course, the breakdown of the Bretton Woods system was not a financial crisis and didn't bring a financial crisis. I think that's rather important. Those crises exhibited features, again, of work that I did with Barry a long while back, in this case, that the interconnections between exchange rate crises, bank failures, and debt defaults. Now, so is there much new? If you look back at the crises that I've listed there, a lot of those crises featured those interconnections. And what was the role of floating rates? Not obvious. You could argue, of course, that fixed rates forced adjustment, but that doesn't fit many of these stories. Mexico, of course, had fixed rates, and look what happened there. And you can go on. I would take exception to the view that the countries that were involved in the Asian financial crisis had floating rates. I mean, look at Thailand, look at what happened to the exchange rates of those countries when the crises came. They tanked, as we know, and that was very, very important, very painful in some cases. I note, again, somebody referred to the UK crisis, so-called, in 1967, the 14.2% devaluation. It was Anne. The 14.2% devaluation. It was a big thing, of course, in London, where I was at the time. Actually, no, I was in Oxford. I take it back. It still reverberated, even in the halls of Oxford. Yet, it wasn't a crisis of any real significance. And the global financial crisis was not, in many ways, it was partly, I believe, a macroeconomic phenomenon, but it also had a very important new element, and that is the prominence of counterparty risk, which is why the system really broke down. Interest rates, global liquidity. We've had this long period of falling rates, historical trend, and we arrived at zero a little while back, and I don't see that reversing. There are lots of factors involved. Some people take different views. My view is that we will, for real rates, that they will stay very low for very long. We've seen a major expansion, that was referred to before, of global financial assets and global liquidity relative to GDP. Global liquidity, of course, was the topic of the latest Bundell Fleming lecture a few months ago. Is this system irreparably fragile, bound to break down? Well, I don't think so. I don't see a shortage of investable assets out there. Safe assets, well, I can go a long time on the safe asset story controversy, but I would simply say safety is a multidimensional continuum, or a continuum along various dimensions. So The question then is whether the availability of whether the high degree of global liquidity, the availability of investable assets is a consequence of floating rates, or is it a consequence of low real interest rates, the search for yield, and the buildup of vulnerabilities in the system. In periods of extreme tension now, we've also seen that the major central banks can move in to support global liquidity if there is a threat. They can use currency swaps and have done. They can intervene very importantly as market makers of last resort. And I refer you to a very good paper that's come out of the European Systemic Risk Board on that issue, which is concerning a lot of the officials. There is, of course, an increased role of non-bank financial intermediation relative to banks, and that's particularly the case in cross-border finance. It's not obvious that that's related to floating rates. Maybe it's related to low interest rates. And final slide, what could not have been expected? Crypto. I've been working on that for the past year heavily, and it's quite fascinating. Very steep learning curve, I warn you all, if you really get involved with this. It's very complicated and difficult, and lots of things I still don't understand. But there's no doubt that about the psychology of the crypto story. And part of it rests on doubts about fiat money and doubts about exchange rates, indeed. And that has contributed to the enthusiasm for crypto in that community, which is very widespread. You'd be surprised how many hundreds of millions of people actually own some of that stuff. Despite the fact, which is verifiable, that it has not been a good inflation hedge. What about, could anybody have expected 50 years ago that we'd be talking so much about central bank digital currencies? I should think not. You could argue, indeed, you can go further beyond CBDCs to think that maybe if we end up with blanket universal deposit guarantees for banks, that effectively bank money becomes central bank money. Yeah? And banks become state banks. It's not clear that that would increase confidence in fiat money. So this new world is going to be a very complicated and tricky one. And finally, is how much of these new things could be attributable to the breakdown of the Bretton Woods exchange rate mechanism? In my view, not a lot. Thank you.
So it's a pleasure to be back at the Peterson Institute and be part of this distinguished panel. You may think of us as the geezer panel. In fact, we survived 50 years of floating exchange rates, just like the international monetary system survived 50 years of floating exchange rates. We use, let's go to the next slide, which is this way. Next slide. Next slide. There we go. Too far. Back. Oh, going the wrong way. Come on, Ted. Start over again, would you? Why this hell with it? There it is. Okay. So we used the meetings 50 years ago in Paris to date the start of the floating exchange rates. However, as this picture shows you, the path to where we were, and some others have referred to, as Fred in particular, the path has started several years before and continued for several years afterwards. We struggled with the consequences and implications of the Paris decisions for another 5 years before the IMF articles were completely codified to legalize floating exchange rates. And moreover, as I think others have commented, the ministers and governors in Paris did not make a positive decision to adopt floating. They backed into the regime. Now, how do I make this thing go correct direction? Yes. For more than a decade, as others have commented, before March 1973, the focus of international economic policy and global concerns had been the U.S. current account balance and the dollar's foreign exchange value. This was basically the economic backdrop of what was going on at that time. And as I think Fred referred to it, that preoccupation continued for at least the last another 20 years. So where were we in March of 1973? As far as I can remember, views on the future of the foreign exchange rate system were diverse. For many decades, as has been commented, many academics, a few policymakers advocated greater flexibility. They argued that allowing the market to determine exchange rates would limit, if not eliminate the external account problems as a sort of and relieve a source of constraint on domestic economic policies. Others feared a return to the monetary chaos of the interwar period, but most accepted the decisions of March because they saw no viable alternative. But many were skeptical of the promised benefits. A few of my colleagues on the staff of the Federal Reserve Board saw the Paris announcements as vindicating their positive view of floating or flexibility, but most of us had more questions than answers. For example, would nations restore the par value system? Could we reach an agreement on a system with greater flexibility of exchange rates, facilitating a less asymmetric adjustment process as had been proposed by the United States? And what did floating mean for economic policies and outcomes? What we did know was that the conditions that led to the meetings would continue to dominate policymaking. In official circles, many expected, or at least hoped, that floating exchange would be temporary, as Fred referred to. In fact, 11 days later, the C20 is a test if you know what the C20 was. The C20 met in Washington, and in their communique, they said exchange rates must be a matter of international concern. And in the reform system, the exchange rate regime should remain based on stable but adjustable par values. But floating exchange rates could provide a useful technique in particular situations. They also agreed on the need for exchange market stability and the importance of fund surveillance of exchange rate policies. The principal concern was the potential for a reemergence of 1930s-style exchange rate unilateralism. Short of that outcome, exchange rate flexibility might be abused by countries seeking to strengthen their competitive positions. And to guard against the latter outcome, the IMF promulgated a set of so-called guidelines for the management of floating exchange rates. This is the key point, during the present period of widespread floating. So the guidelines called for intervention to maintain orderly markets. They discouraged aggressive intervention to accumulate reserves when a country's effective exchange rate was rising, or to reduce reserves when it was falling, leading with the wind. And despite these good intentions, countries did more or less what they wanted to do. Now, in the view of some, we had entered a new international monetary non-system. For these observers, the essence of the Bretton Woods system was the discipline, fixed or rarely adjusted par values exerted over domestic economic policies. I do not agree with this non-system view. I think that the Bretton Woods monetary system not only survived the Paris decision, but contributed to them. In my thinking these days, the core principles of that system set up at Bretton Woods was a commitment to cooperation, as illustrated by the decisions in Paris, which were reached on a cooperative basis. Countries didn't all go off and do their own thing. Somewhat they did, but not entirely. And second, the principle preserved in Paris that a country's exchange rate was a matter of common concern. Now turning to, can I get this right? The 2023 reality, I think it's fair to say we have a mixed regime. The major currencies now float with very infrequent market interventions. US and European monetary authorities have not intervened in significant amount for more than 25 years, and the Japanese for more than 20 years. On the other hand, many other countries still actively use exchange market intervention as a policy tool. Over the past 50 years, many countries have experienced exchange rate crises. Some were linked to domestic banking, inflation, or external debt crises. Some were exacerbated by movements in the exchange rates of the advanced countries. But the exchange rate regime has not been responsible for these crises. I think I agree obviously with Richard at this part. On the other hand, the regime also has not delivered on the promises of some advocates that would be an absence of such phenomenon. We have learned, as Bob pointed out, that exchange rate movements are dominated by financial expectations. Exchange rates are not anchored by the prospects for the real economy, and the real economy is slow to adjust to changes in exchange rates. The global adjustment process and the chronic US current account deficit dominated international policy concerns in Paris 50 years ago and for the following 2 decades. In recent years, concerns about global imbalances, we could debate about whether, before the global financial crisis, have dramatically receded. I would not, however, exclude the possibility that such concerns will reemerge. I'm an alumnus of this institution in which we practice responsible excess. So in 2022, the US current account deficit exceeded 3% of GDP for the second year in a row. And in October, the IMF staff projected its slight narrowing this year and to 2.3% in 2022. In the IMF's January 2023 World Economic Outlook update, somewhat inexplicably, did not mention current account positions at all for any country in the world. You might consider that progress, you might not. And maybe this indifference may not be justified. Earlier in 2022, the IMF staff estimated that in 2021, I'm almost done, 2021, the dollar was overvalued by 8.7% in a wide range of 2.3 to 10%. The estimate was based on the normal for the US current account of 1.3% compared to the actual deficit of 3.6. In 2022, the dollar appreciated by a further 7.8%, so that ceteris paribus, the overvaluation is now 17%. It does not require a lot of imagination to speculate that if the United States economy were to go into recession or goods production were to decline, that pressures would mount in this country to, quote, do something about it. And Congress has provided the administration with the tools to identify and call out countries that resist appreciation of currencies or have large current account surpluses. Use of these tools would, at a minimum, increase foreign exchange market volatility. So 50 years ago, the monetary authorities were forced into embrace floating exchange rate. They did not know what to expect. Over the years, the regime has been buffeted by many influences. The regime has not measured up to the expectations of the enthusiasts, but has survived and evolved. What more can we ask? I guess that's what this conference is all about. Thank you.
Okay, let me thank the speakers for keeping so well to the statutory time limits, but nonetheless giving very rich presentations. And the Q&A session, which I'm going to open now, will give them a chance to expand on some of their remarks. Let me just sort of give a brief 2-minute overview of some of my takeaways, and then we'll ask the panelists. Maybe the panelists would want to start coming up to the podium now while I drone on, and then we can move to the Q&A. Bob Aliber, as he has in a number of writings, pointed to the importance of capital flow shocks, and these are a major theme in current research, of course. These have real effects. For Milton Friedman, a capital flow shock was really not a thing. So he would look at horror at our modern models with noise traders and not really understand what those were about. But the balance of payments identity suggests that capital flow shocks can affect current accounts and real activity. For Fred, the new floating rate system is really a triumph of unintentional reform. And as he pointed out, for at least for advanced economies, exchange rates, which had been the locus of crisis very much in the 50s and 60s, 40s, in fact, were no longer the locus of crisis. But as Ann Kruger pointed out, emerging markets did not move immediately to the flexible exchange rate system. And for emerging markets, the role of the exchange rate is actually quite a bit different. Richard focused on financial markets and crises, the newer kinds of crises beyond currency crises. I would argue that, disagreeing a little bit, that there is a connection between the regime and financial crises, essentially arising through the trilemma. The relaxation of the need for fixed exchange rates has allowed, caused would be too strong a word, but it has allowed extensive financial development and financial integration, which has been very much associated with crises, though crises in the crypto sphere are a totally different animal, which it is harder, I agree, to link to exchange rates. Ted also raised some of these issues in his presentation. I think it's notable that the origin of the Basel Committee on Banking Supervision comes immediately with the onset of floating exchange rates and the financial stability concerns in international banking that arise in those first years. Finally, I was really struck by Ted's last chart on current accounts and the for the U.S. global imbalances and the dollar. Back in 1991, Paul Krugman wrote a monograph for Peterson called "Has the Adjustment Process Worked?" And if you sort of extend Paul's graphs out through the subsequent episodes, you see very clearly this pattern, which we're now experiencing, of a dollar appreciation. Is coming back to Bob's remarks, being driven in part by capital inflows, reducing U.S. competitiveness being associated with a growing U.S. current account deficit. And I think it is an open question how these sort of larger current accounts will play out in the coming period in terms of protectionist pressures and the other tensions that have arisen around the floating rate system. So with that, let me open up the Q&A. There are microphones, there's standing mics. I don't know, do we have mobile? We have mobile mics, thank you, Jessica. So raise your hand and please, at the beginning of your question, identify yourself and your affiliation. Jeff Frankel, sorry, I was that guy.
Jeff Frankel, Harvard Kennedy School. Well, great to be back at Peterson Institute. I heard this is addressed to whoever wants to answer it. I heard about capital account shocks being something that wasn't foreseen by advocates of floating rates, and that drove the dollar in the early 80s, or drove the dollar now. But it seems to me those were not exogenous crazy capital markets just doing their thing. They were responses to differences between U.S. macroeconomic policy mixes and the macroeconomic policy mix in the rest of the world. The appreciation of the dollar in the early 80s was due to the Volcker Reagan mix of monetary and fiscal policy pushing up real interest rates and attracting the capital inflow. And at least the first phases of it were consistent with fundamentals and consistent with the idea that U.S. fiscal expansion was crowding out investment, so it might as well also crowd out the trade deficit. Fundamentals working. And more recently, the U.S. tightening monetary policy in advance, or to a greater extent, can you hear me? Tightening monetary policy to advance or to a greater extent than other countries explain the appreciation of the dollar. And you could argue it's an optimal thing if we're trying to fight inflation. You want the dollar to go up, and if other countries don't want to fight inflation to the same extent, we're still putting more weight on output employment, they don't have to raise interest rates as much. So my question is, haven't floating rates fulfilled what was indeed Milton Friedman's promise to accommodate differences in policies and let each country choose its own macroeconomic policy mix that suits it the best?
Whoever wants to jump in.
I would say, Jeff, yeah, I would say yes. And that was one of the reasons I extolled the move to floating as a sweeping positive international monetary reform. What we have learned, however, is that when the flexible rates move too far, particularly on the appreciation side for a deficit country, that you do get real economic effects that push back against trade policy. That was most dramatic in the early 80s with the run-up to the plaza, which was, of course, as you know well, motivated by a huge outbreak of protectionist pressure in the US. The rest of the world feared that, particularly the Japanese, the rest of the world feared that sufficiently to agree to drive the dollar back down. That was the most dramatic case where the protectionist trade reaction drove the monetary exchange rate policies. Ted raises the question, that last slide that Maurice referenced, whether something like that could occur again. It's certainly true that in trade terms, the dollar is now greatly overvalued. I think the reasons are largely what you said, the reflection of different macro and monetary policies. So far, those macro policies have dominated any concern about the external side, and we've seen remarkably little protectionist pressure in the Congress. However, that's in the face of two administrations now, which themselves have been somewhat protectionist. The current one pushing industrial policy now in that vein. And so maybe that's the safety valve that, for better or worse, is responding to the overvalued dollar.
Bob?
Thank you. Let me make 2 points. The first is I want to go back to Milton's classic essay. What was the case of floating exchange rates? It was less expensive to adjust the exchange rates to the differences in the price levels of different economies. It's the tail wagging the dog issue, right? It was less expensive if the tail adjusted rather than if the economies adjusted to keep this tail constant. It was all about essentially maintaining competitive equilibrium. Now, what has happened with floating exchange rates? the distortions in between the competitive positions of different countries under floating exchange rates are 4 or 5 times larger than they ever were under fixed exchange rates. Right? The price of the dollar increased by 50% in the 1980s. Right? The US competitive position declined very, very sharply. There is no counterpart to this. Right? The source of monetary instability is the variability in cross-border investment flows. This is a statement about the data. Let me conclude with the following point. I love monetary histories. My neighbor in Evanston, Bob Hissell, has just come out with a new history of the Fed, right? There's no indication in that history that the United States is an open economy. Or Alan Binder, brilliant economist, marvelous new book. What was the source of the 2008 crisis? Or as Michael Lewis said when reviewing Secretary Geithner's memoir, is Secretary Geithner believes that the monetary crisis was an act of God. Right? Each of these 80 crises that we've had since 1980, each of these banking crises is a result from the variability in cross-border investment flows. Several of us here are part-time experts on Iceland, right? What happened in Iceland? A massive increase in its current account surplus, its capital account surplus. That could only have occurred if there was a counterpart increase in its current account deficit. Why did the Iceland current account deficit increase? Because, and this is the intermediate argument, because there was an increase of household wealth of a factor of 4 in about 6 years. This is the monetary instability of money sloshing across national borders and the domestic adjustments to these cross-border flows. Thank you.
Preface, I'm struck by the fact that Europe has not been mentioned once in the discussions so far. Not once, unless I missed something, you know, I was taking notes. So let me just take one case. You could have said something, for example, about capital controls in Europe and the long time that it took to get rid of them and what the consequences of getting rid of them were in terms of the move to monetary union. You could have, but nobody did, and so on. But let me just take one example related to this, to the exchange rate versus trade, and that is from 1992, from the crisis of September 1992, when the German authorities resisted an overall appreciation of the Deutschmark, right? One of the reasons for that is that, an important reason for that, was that they did not want to impair the competitive position of Germany within Europe. And then if you look further and more broadly, why did we end up with a single currency? Because countries on the whole didn't want to see competitive devaluations. And, you know, I'm surprised, as I say, that people haven't mentioned that.
Yes.
I'm Barry Wood, an economics columnist. It seems that the floating system has worked so well for many countries, but maybe not for the United States. And I want to just pose the question, since the United States dollar value is high and our current account is high and growing, is the greatest failure of the floating system that the United States fiscal policy, fiscal policy is not disciplined by the system?
Well, I think there always has been a tension in talking about the current account balances, how much emphasis you put on the exchange rate and how much you put on C plus I plus G plus X minus M. And I think that tension in the literature has never been complete. It's there, but there's a tendency to emphasize one or the other. And I think it's my personal view is if it was felt to be important, I'm not sure it needs to be, but it felt to be important to reduce our current account deficit and improve our international investment position, which is negative but still net zero in terms of recorded earnings, you would have to adjust macro policies to support that. And that, on the other hand, that doesn't mean that exchange rates don't play a role in pushing around things in the short run, and including, and I think history shows that on several occasions over the last, at least the first 25 years of floating exchange rates, attempts to deal with the exchange rates that are out of line were hinged on changes in U.S. policy. That was true, for example, in a small way in 1987 when we had to have a budget summit to get the Europeans to agree to help support the dollar. And it was the case in 1978 when the Federal Reserve had to raise its interest rates in order to get the Germans to go along with the rescue package at that time. So underlying a lot of disputes over the years has been questions of the underlying macroeconomic policies in the United States, and it's fair to say on the other side as well.
I'll just say one word about Barry's premise that floating rates have not been so good for the United States. And there certainly have been downsides, and Bob Oliver outlined those. But remember that in the run-up to the crisis period in the early 70s, it was the United States which was not doing so well under fixed rates. And in fact, contrary to what somebody said, it was the U.S. which drove the breakup of the Bretton Woods system. I mean, U.S. liked hegemony, but finally decided the costs were too great and drove the breakup of fixed rates. Why was that? Remember, all of you were too young. Almost all of you were too young. In the 1960s, President Kennedy was reportedly, by his official historian, more terrified of the balance of payments deficit than any other issue except nuclear war. The United States applied comprehensive capital controls. That is forgotten. On short-term movements, on FDI, the U.S. had comprehensive, first voluntary, then mandatory capital controls. The Johnson administration seriously considered a travel tax, taxing foreign tourism by all Americans. That was a serious proposal. That was studiously thought about, rejected by the Congress, but it was thought about. The first protectionist pressures in the post-war period bubbled up, despite continued U.S. economic dominance. The Burke-Hartke legislation in the early 70s, the Mills bill that passed in 1971, all those things were early manifestations of the effect of fixed rates, dollar overvaluation, at the time. And that all explains why the U.S., reversing its position, no longer decided to support and defend the gold price, $35 an ounce, but decided that it needed a devaluation. And John Connolly's great genius, aside from his other problem, John Connolly's great genius was turning dollar devaluation into a political victory for himself and the Nixon administration. So when we say floating rates haven't been so great for the U.S., and I agree, lots of problems. I've talked about many of those myself, particularly when other countries like China manipulate to distort the flexible rate system. The U.S. was not so happy under fixed rates, and for justifiable and understandable reasons.
Okay, we started a little bit late, so I can take one more question before we go to Larry.
how we got it such a big deal, but yeah.
Larry Shembri, formerly of the Bank of Canada, now at the Fraser Institute. I'd like to build on Jeff's point. The fact that we had floating rates really allowed countries to adopt inflation targets. And I think inflation targets has been a regime that's clearly expanded across the world. I mean, in terms of Latin America, many countries have inflation targets coupled with a flexible exchange rate. So I think it was one of the great advantages of having floating rates is it allowed countries to adopt inflation targets, and some of them differ. And I think that's been a great source of stability for the world. I mean, apart from the pandemic, but for the last 30 years, inflation has generally been pretty low, stable, and predictable. So I think the combination of inflation targets was only and flexible exchange rates was only able to take place with the advent of floating rates.
Richard. Very quickly, I would just change the wording of what you said. You said allowed adopting inflation targeting. In the UK, at least, it required the adoption of inflation targeting. At least that was the perception of policymakers at the time. We were forced out of the European monetary system in 1992, and what was going to be the anchor for monetary policy. People looked around, there was a lot of discussion, et cetera. Ultimately, the anchor for monetary policy that was chosen was inflation target. So it was not that we were allowed to get there, it was necessitated in a sense. You can argue about whether that was the right response or not. On the whole, probably it was, and it has worked reasonably well.
I think we need to, and Ann emphasized this implicitly in her remarks, differentiate between what floating rates had effect have done for the major countries and economies and what they've done for other countries. And in those cases, it's more complicated. In some cases, I agree with Ann, they held on, I think that's what you're trying to say, they held on too long. But the fact that they live in a world in which you have the yen and the dollar and the euro, sterling, I guess I have to mention, floating around, right? That means that there's no such thing as a fixed exchange rate for other countries, or they have to think about their own way in terms of exchange rate stability, right? Because their effective exchange rate is changing every day, and that does complicate, I think, to some extent, the policy making in developing countries. I'm not sure that they wouldn't. I think they might have been worse off with periodic 1960 style crises. But it's not been, I think, it's not been as clear sailing as the system has not been as clear sailing for many of the developing countries that we might be inclined to think.
Okay, well, if no one has a final word beyond Ted's final word, let me thank this wonderful panel, and please join in doing so. I believe we have a coffee break now. Good. Coffee is around the corner, in case you're wondering.
Yours was very interesting. I liked it.
I mean, I always try to say something a bit
Provocative.
out of the out of the ordinary. Yeah, exactly.
So your back is a problem.
Yeah, but otherwise,
perspectives on the previous panel from people who, if not in the room, were in contact with and influencing the people in the room 50 years ago. And we had some surprising, in some ways, long-term perspectives from that time, very relevant for the day. Towards the end of the conversation, I believe in the Q&A, there started to be mention of inflation targeting, and that is a natural bridge into the topic of our second session, which is the post-1973 currency regime and inflation experiences. Obviously, monetary policy and its flexibility are one of the key aspects of what floating exchange rates were supposed to give us, and also with the risks about price stability in a floating exchange world, not just for the US, but for others, were vocalized quite a bit. It's my privilege to chair this session, and we have four current and former monetary policymakers, all of whom are also distinguished scholars. Let me introduce them in alphabetical order, in the order in which it is stated, which they will speak. First is our colleague Jose de Gregorio, who, in addition to being a non-resident senior fellow here at PIIE, is the Dean of the School of Economics and Business at the University of Chile. He was governor of the Central Bank of Chile from 2007 to 2011 and vice governor from 2003. He had served on the bank's board from 2001. He also had his experience in 2000 and 2001 as the Minister of Combined Portfolios of Economy, Mining, and Energy in Chile. Recently, we published his book, How Latin America Weathered the Global Financial Crisis in 2014. Speaking second is Kristen Forbes, the Jerome and Dorothy Lemelson Professor of Management and Global Economics at MIT Sloan School. She served as an external member of the Monetary Policy Committee of the Bank of England from 2014 to 17. She also served in the US Treasury and at the US Council of Economic Advisors in the early 2000s. And of course, she is a distinguished scholar on exchange rates and monetary policy. And for people in this room, many of you know her as the convener of the Bellagio Group of Officials and International Economists. Speaking third is, on the record, I'm appreciative, is our currently serving Chief Economist of the European Central Bank, Professor Philip Lane. He's, of course, a member of the Executive Board of the European Central Bank in that role. He's previously served as chair of the Advisory Technical Committee of the European Systemic Risk Board and chair of the ESRB High-Level Task Force on Safe Assets. He was, of course, governor of the Central Bank of Ireland and had a distinguished career in academia prior to that, including seminal work on global imbalances and international finance. Finally, alphabetically, another close colleague and alumna of the Peterson Institute, Dr. Catherine Mann. Catherine is currently an external member of the Monetary Policy Committee of the Bank of England. She started there in September of 2021. Prior to her appointment, she was Global Chief Economist at Citibank from 2018 to 21, and Chief Economist, Head of the Economics Department, and G20 Finance Deputy at the OECD from 2014 to 2017. She had previously been a professor, I guess is still considered a professor of the practice at Brandeis University, and has, as I mentioned, a period at the Federal Reserve and then at the Peterson Institute, which we are glad to recognize. So if I could ask the four speakers to come up, I will, like Maurice, sit in the front row and give time signals. If you wish to speak from the podium, please feel free. We'll pretend the clicker works and take it from there. And first up, Jose, if you can come forward. Thank you.
Thank you very much. I think I have some slides. Well, they will appear, I hope so. So, well, it is a pleasure to be here. I have to talk like that. It's a pleasure to be here, and my first time at the Peterson after the pandemic, so it's great. I hope it will continue. So I'll talk a little bit about what's going on and basically to just, well, okay, thanks. This is, you can do. I'll talk a bit about inflation and monetary policy and exchange rate regimes in emerging markets. Then I'll talk about two issues that I think that are quite relevant on exchange rate adjustment, and especially because what we think is that having flexible exchange rate has many costs, and especially in emerging markets, but it helps the adjustment. And this adjustment, of course, many times has been questioned, and I want to talk about that. I think that I'm going the other way around. No, I got it. I think that the first thing, I don't know who's in this. Okay. The first thing that it happened was the emerging market economies adopted flexible exchange rates much later than Bretton Woods ended. So this was by mid-late 1990s. And until mid-1990s, most crises in emerging markets were associated with rigidities in the exchange rate regime. We had the debt crisis in Latin America in the 1980s. We had the Mexican crisis in 1994. The Asian crisis, there was always some rigidity in the exchange rate. So there were two things that we have in the late 1990s. First, inflation decline, and there was a worldwide inflation decline, and high inflation Latin America, one digit everywhere around the world. Causality is a discussion that I won't take here, but many countries start adopting inflation targets, and there was a move, this is for emerging market, a move towards flexible exchange rate. The blue is peg exchange rates. Then if you divide the green, which is the intermediate level, there are few freely floating exchange rate among emerging markets, but a lot of, I would say, managed float or white bands. But there has been much more flexibility. We don't know, as I said, what's causality, but one thing that was quite surprising and quite important during this period is that we observe a decline in the exchange rate pass-through to inflation. And this is this is basically a summary of a lot of evidence that has shown that the exchange rate pass-through has declined sharply in the short run, in the long run, among emerging markets. Today, a rough number we would say could be in the long run 0.2 depreciation with respect to the dollar, and this is even has happened in the period of very high exchange rate depreciations that we had during COVID, that we have during a taper tantrum and the global financial crisis. The effects on inflation have been much more muted. There are reasons. Taylor argued that with anchor inflation, we may have we would have a lower incentives for producers to pass through cost to prices. There are many other reasons why it's very different to change your prices when you're in a flexible exchange than when you're in a fixed exchange rate with infrequent devaluations. But that has been quite important. So what we have in this context, and I think that the first worry with this low pass-through, this environment in which exchange rate didn't affect that much domestic prices, was a discussion about external adjustment. In a world of local currency pricing, where you just all goods are priced in local currency, exchange rates do not play a role at all. So the things that we were used to believe from Mandel Fleming and traditional models of external adjustment was questioned when we saw that there was a low pass-through from exchange rate to prices. Now, under dominant currency pricing, also the adjustment is limited. This is the most accepted view today, I would say. Changes in bilateral exchange rates do not affect external adjustment because it doesn't change relative prices, because prices are set in dollars. So let's say a Chilean exporter to Brazil only changes real dollar will have effects on the price. And however, we have been looking this with some colleagues, and we have observed that just to put a summary and tempt you to read the paper, then is we have in the short run DCP, a depreciation with respect to the dollar. The blue line is almost 1-to-1 because exports, let's say to Brazil, are denominated in dollars. However, as time goes on, this one declines, it's 0.3 in our estimations, and what becomes relevant over time is the bilateral exchange rate, so the relation between the real and the peso. And as we expect, in the red line, if there is a depreciation of the real with respect to the peso, Brazilians will export less, and the red line, we see a decline in export, which is what we were used to learn from standard Mandel-Fleming. What is interesting, and I will not go into the details, is that also we would expect that if the price, you price in dollars and the price in Brazil goes up, we should export less. However, we see that the blue line is relatively stable, and we argue that there are supply effects. Chilean exporters find more, and this is quite a standard, find more profitable when there is a multilateral depreciation of the dollar. Despite the dollar and the real are the same, they want to export more to Brazil. Despite there is a decline in the demand for export, there is an increase in supply of imports. We are doing more of this, but I think that the exchange rate and what we show that still the exchange rate plays a very important role in the adjustment. And the second issue that has motivated, there were fear of floating this idea by Calvo and Reinhardt for two reasons. One was inflation, and we saw exchange rate pass-through had declined. There was no reason to have that fear of floating because of inflation. And the second reason was mismatches, was that we borrow in dollars, we lend in pesos, a depreciation of the dollar will make us poor, we will have a financial collapse. It's chaos is coming. So that's, first of all, I have to say that there is not that much evidence of pervasive and dramatic currency mismatches in emerging markets. Some firms borrow in dollars, they hate themselves, but we have not, and this I think, beyond the academic evidence and papers, the fact that there has been large fluctuations in exchange rate in the last 20 years, without severe financial problems is a practical evidence that we do not observe that much currency mismatch. We had global financial crisis, 30, 40% depreciation in emerging markets. There was inflation, there was no financial. Then we have the taper tantrum. We were very scared because there was this announcement by the Fed, caused turmoil everywhere. We were floating. I don't see. There are some special countries. I will always when we talk about Latin America, we have to exclude Argentina and Venezuela. Okay, that's fine. And then there are some other countries. But in general, we don't observe. And then we have COVID. There was a lot of government support, but we have COVID, and there was no huge crisis. So we have to, and what I will show you is that the evidence, this is the case of Chile, and I was extremely surprised, and I think that's very interesting. Chile had this is the net international investment position, the blue line. The red line is accumulated current account. Despite having accumulated deficit current account growing in 2019, in 2020, what we observe is that the net international investment position improved. Why? Because there was a sharp depreciation. Chile is short in dollars. The government is short in dollars. Firms are short in dollars. And there was a depreciation. And also remember that we had a social unrest, total chaos, close to a revolution, very bad performance of our stock market compared to that of the US. And most of the difference is explained by valuation effects because being an internationally financially open economy has served as insurance with all the costs that have. So I think that this is not just Chile. We're doing, and I may show you soon, a panel data for all emerging markets, and this happening in most countries. More open countries financially, they have more asset and liabilities, so the valuation effects become more important. Let me just close. I have 20 seconds to say that flexible exchange rates, inflation targets, and low inflation have brought many benefits to emerging markets with few exceptions, we have not seen large financial or macro collapses since the early 2000s. Emerging markets weathered very well the global financial crisis, then the COVID crisis. Still, we have the big problem how to make emerging markets to grow faster. That's not the macro problem, it's the long-term problem. By looking at the Euro crisis some years ago, the most recent financial turmoil in the US, it seems that emerging markets are having much better macroeconomic and financial performance than advanced economies, thanks to flexibility, pragmatism, and a little bit of prudence. Thank you.
Thanks very much. Well, thanks, Adam and Maury and Doug for including me in this event. This has been a great motivation to take a step back and think about how different exchange rate regimes have been performing over the past 50 years. So the topic of this panel is supposed to be inflation experiences. So I'm going to focus on one narrow aspect of that, and that is if we have been able to replace what was called the golden anchor to achieve price stability in the post-Bretton Woods anchor, or post-Bretton Woods regime. And by golden anchor, I mean obviously the Bretton Woods system of gold being linked to the dollar and dollar being linked to other currencies through a peg. So this concern about what would be the anchor if you abandoned this Bretton Woods system was a key concern of policymakers. There we go, thank you. And this is nicely summarized in this quote from this nice book by Jeff Garton, 3 Days at Camp David, when he details the debates about what could replace the Bretton Woods system and was the system appeared cracked. He writes that Volcker believed that money needed an anchor, some price that was a fixed point and that an exchange rate tied to gold served that purpose. He was convinced that fixed currencies imparted a necessary discipline on national policymakers who otherwise would too easily resort to easy policies that would lead to inflation. So major concern was what's going to anchor prices if we give up on this golden anchor of the Bretton Woods system. Now, if these policymakers could look forward to what was going to happen in terms of the rapid pace of globalization in the 1990s and 2000s through trade, capital flows, supply chains, they might have even been more worried about losing this anchor. Because as a number of researchers have shown, including a paper I did for the institution across the street, we're increasingly seeing that inflation is driven by global factors, by global shocks. So if policymakers back in the 1960s had seen how inflation is going to deviate substantially from targets because of these external global shocks, they probably would have been even more concerned about losing this anchor for price stability. So what I'm going to do is try to answer this question. In the post-Bretton Woods era, have countries been able to find a new anchor for achieving price stability in the face of these large global shocks? And to try to get at that, I'm going to look at some different pieces of evidence, focusing on advanced economies. So in contrast to Jose's comments, I'm just going to focus on advanced economies due to data limitations, although I'll comment briefly on emerging markets at the end. And I'm going to compare how countries with more flexible exchange rate regimes have done compared to countries with more rigid exchange rate regimes in terms of their inflation rate, their sensitivity of inflation to common global factors, and then look specifically in their inflation sensitivity to specific global shocks. And what I'm going to conclude is that at least in advanced economies, some have been able to replace the anchor of having a pegged exchange rate with some other sort of anchor and been able to achieve just as much price stability as countries that have maintained some sort of pegged exchange rate. So let me jump right in. So I'm going to, again, show you a bunch of comparisons. Advanced economies only. I'm going to focus on the last 20 to 25 years, so the second half of the post-Bretton Woods era, so the period when all of the adjustments we heard about in the last panel have sorted themselves out, and the regime looks something like it does today. And let's look at inflation rates for some different countries. So blue is the average CPI inflation rate for advanced economies, big set of about 33 advanced economies. And then I'm going to break that down into two subsets of the advanced economies. Green is countries that have a rigid exchange rate, where rigid is defined as a conventional peg currency board or no separate legal tender, i.e. Euro countries. Red is countries that have maintained more flexible exchange rates, basically some form of a floating exchange rate. And when you look at average inflation for these different groups of countries, there's not much difference. Yes, there's big movements in average inflation, but there don't appear to be big differences in terms of countries that have abandoned an anchor of a fixed exchange rate versus those with flexible exchange rates. If anything, if you calculate the deviations, countries that have maintained a more rigid exchange rate do a little bit worse in terms of deviating from 2% targets. Countries with no anchor have done a little bit better, but those differences are pretty minor. So first pass, countries that abandon the anchor don't seem to have done any worse in terms of meeting inflation targets. Second test, what about sensitivity of inflation to shared global factors, now that global factors are a bigger driver of inflation? So look at the same groups of countries. And now what I do is take out the first principal component of CPI inflation, calculated over 4-year rolling averages. So what this basically shows is how correlated inflation is in each of these countries with inflation in other advanced economies. How much does your inflation rate co-move with inflation of other advanced economies? And the first thing that jumps out is just this upward slope in this graph. And this captures what's been documented in other work, that the global factors are becoming more and more important in driving inflation. Just to put some numbers on it, in the mid-2000s, about 50% of the movement in inflation in an advanced economy was correlated with movement in inflation in other advanced economies. In 2022, 90% of changes in your inflation rates in advanced economies was correlated with changes in inflation in other advanced economies. So there's a big shared global pattern in inflation now in advanced economies. But then again, if you break down what's happening on average in advanced economies in blue to those that have abandoned the anchor of a fixed exchange rate in red, countries with a flexible exchange rate, you don't see that they are any more vulnerable to this shared global shocks driving inflation. If anything, in the mid-2010s, they look less vulnerable. So countries that have, again, abandoned the anchor seem to have even more idiosyncratic component of inflation. They aren't more affected by these global shocks than countries that have maintained an anchor. So at least on that second test, it looks like abandoning the anchor hasn't hurt them. It made countries more vulnerable to external shocks. So these are nice comparisons, but it doesn't really tell you how vulnerable countries are to specific global shocks. So for a final piece of analysis or final piece of evidence, I go to estimating some Phillips curve regressions. And I'm going to build on work I did with Joe Gagnon, sitting right there, and Chris Collins, who also helped me update these regressions. And what I'm going to do is just estimate standard new Keynesian Phillips curve models. I'm going to first show you I'm not going to, I have lots of numbers. I won't put them all up here. I'll just show you the key results and key findings. So first row, and I'm going to show you 4 specifications. First one just shows that there's nothing funky going on here. This just estimates the standard model. This looks at quarterly inflation, advanced economies, and inflation is seasonally adjusted. And when you estimate standard new Keynesian Phillips curve panel of about 30 advanced economies, you get the expected signs, everything significant. What this means is if you have more slack, red means the coefficient is negative. More slack, you have lower inflation, as you'd expect. And if you have higher inflation expectations or higher lagged inflation, you tend to have higher inflation. So as expected, nothing funky going on. Then I re-estimate the model that I used as the baseline in the paper with Joe, where we add 2 things. We add nonlinearity for the Phillips curve, and we use a specification that allows the Phillips curve to be flat when you have slack in the economy, and then the Phillips curve gets steeper when you have less slack. And then we also control for specific global factors that influence inflation. So when I add those extra controls, you get everything comes in as expected in terms of sign and largely significant. And again, what the coefficients on slack show you is that when you have slack, the Phillips curve basically flattens. And then you get expected signs on the global variables. When you have more global slack, you have less inflation. When you have a growth of global value chains, you have less inflation. When you have a higher oil price inflation or commodity X oil price inflation, you tend to have higher inflation. So all expected, nothing new here, just showing that the sort of standard results hold up. Now I'm going to show you the new thing relevant to this panel. What has happened when you adopted a flexible exchange rate or a fixed exchange rate in this post-Bretton Woods era? Does that make you more sensitive to the global shocks? So to test that, I'm going to interact each of the global variables with a dummy variable if you have a flexible exchange rate or if you have a rigid exchange rate. And that's shown in the parts that are have a rectangle around them in red. The fact those coefficients are light and generally don't have stars means they're generally not significant. And what that means is if you adopted a flexible exchange rate, then you are not more sensitive to global shocks than any other countries. Even though you don't have an anchor, you're not more sensitive to these big global shocks, which are increasingly important in driving inflation. Same with countries that maintain an anchor. They kept a pegged exchange rate. They aren't any less vulnerable or more vulnerable to these big global shocks, which increasingly affect inflation. The only exception is this coefficient on the far right, the green one for flexible exchange rate and global value chains. That comes in positive, but that basically counteracts the coefficient above, which means global value chains seem to have had less effect on countries with flexible exchange rates. So if anything, they're better anchored, not worse anchored. But overall, and I've also done this for core inflation, and you get the same results. When you estimate what's driving core inflation in a sort of Phillips curve model, you find that core inflation is less affected by global variables in general, but there's no significant difference for countries that have abandoned the anchor and have a flexible exchange rate. So let me tie that all together. What's it all mean? My takeaway from this is that pegs haven't been needed to anchor prices, at least in advanced economies in the post-Bretton Woods era. Inflation in countries that abandoned the anchor and went for flexible exchange rates has not been any worse in terms of meeting inflation targets. The sensitivity of inflation to common global factors often hasn't been any also hasn't been any greater, and the sensitivity of countries without an anchor to global shocks also hasn't been any greater. So it looked to me, at least in these sort of rough comparisons, that the shift has been largely a success. The loss of the golden anchor from the Bretton Woods era has not undermined price stability in advanced economies, despite the growing role of large global shocks that push inflation away from targets for brief periods of time. So these concerns that I started with, that Volcker talked about losing the anchor if they could maintain price stability, haven't played out. And of course, the answer is probably what was discussed briefly in the first panel, raised by Larry and Richard mentioned, is that it appears that what was the anchor in terms of the being linked to gold and the dollar has been replaced by the stone columns of independent inflation targeting central banks. These independent inflation targeting central banks seem to have been able to provide the anchor for price stability that was previously accomplished through the peg in the Bretton Woods era. So all in all, fairly successful outcome, at least based on these rough comparisons. But I did want to end with one caveat, because I'm an economist, you can't be all positive, there's always downsides. And the one caveat was for if I try to replicate this for emerging markets. The results are less strong for emerging markets. Maybe Jose could comment on this in the panel at the end. I can't replicate all of the analysis I just showed you for emerging markets because there's not sufficient data. But at least the parts I could replicate raise some questions of whether emerging markets have been as successful at anchoring inflation without pegging their exchange rate. And here's just the one comparison I'll end on. This is the chart I started with, CPI inflation for advanced economies with rigid exchange rates in green, more flexible in red, no big difference in advanced economies. Do the same thing for a large sample of emerging markets. Now, purple is average inflation for emerging markets as a whole. Red is those with very floating exchange rates. Green is those with very rigid exchange rates. And now you see some big differences. Emerging markets that have adopted floating exchange rates have hit inflation further away from targets. Rigid exchange rates seem to provide more of an anchor. Thank you.
So it's a pleasure and an honor to be part of this event today. What I would say is, Adam had a very intriguing introduction about what's the fuss. Let me say also, 1973 to now, it's been brought up in different contributions. You could also frame that in different ways. You could talk about the trend in North Star, as Richard was doing. You talk about the trend in globalization. You talk about the amazing convergence to low and stable inflation rates until 2021. When I was doing my PhD, in fact, my main paper was about the variation of inflation rates around the world in the 1980s. And that was not a topic that would generate very much interest until quite recently. So the question is, how does that connect to the movement away from the Bretton Woods system? And I suppose that one of the basic points I want to say is that was not, at some level it was 0-1. So the remarkable New York Times front page you started with. But another level, and again, if you zoom back, and maybe if you go forward maybe another 20, 30 years and people look backwards, they would say, okay, is 1973 the event? Or is it something like maybe from the mid 60s actually, maybe running all the way, and I'm going to use 2015 as actually my number. So 2015, that period, at least in the European context, is really a huge learning period. Lots of decisions along the way about, okay, what's next? How do we replace the system that was there with a new system? And essentially, I do give this kind of I mean, the discipline of the Peterson Institute and saying 5 slides does mean I'm not going to go through it. But what I'm going to say here is from a European perspective, there's a big learning episode in the 1970s about, okay, what's next in terms of snakes and so on. Then with the EMS from 79 onwards, which of course, after the currency crisis of the early 90s, there was a question, okay, what's next? And then towards the end of 95, okay, let's go for monetary union. But then monetary union from day one was not exactly perfect. And I dated myself all the way to 2015, summer 2015, thinking about okay, now that we've experienced some crises, how are we going to run this in a more stable way? What kind of ancillary policies do we need? And so this goes all the way through the Greece referendum in June, July 2015. And of course, I came in October 2015. So all of that learning episode was behind us in some way. And if you like, in the last number of years, the challenges Europe has faced in my time has been essentially big common challenges. For a long time, it was how are we going to deal with below target inflation using unconventional policy? Then, of course, we had the pandemic quite recently, and then in the last couple of years, this above target inflation shock, which has involved the end of QE and also the hiking cycle. So in terms of that, that's point number one, it's not 0-1. There's a long period there of monetary instability in some sense, or monetary regime instability. Look at the amount of, I mean, of course, the careers of many of us here were spent on all of those episode by episode, whether it's incremental adjustments or big bang adjustments, such as monetary union. And one way to think about it is here we are in March 23, which is 50 years of the end of Bretton Woods. In May 23, we'll be celebrating 25 years of the ECB. Because of course the ECB was set up and we're planning for that. And so half of this period since the end of Bretton Woods from a European perspective has been under monetary union. And again, my working day is basically spent on the assumption the relevant part of monetary union is 2015 onwards, when a lot of this is shaken out. And Maurice already mentioned the trilemmas. I mean, the issue is, I mean, I agree with Kristen, what she just said about you can deliver low inflation in many ways. So it's not about the ability to deliver, but it's basically how do you manage these various trilemmas, the monetary policy trilemma, the financial stability trilemma, and then the political economy trilemma, which of course I think is also a Peterson product from Danny Roderick's book from probably 25 years ago now. And the unique answer in Europe was monetary union. So it's this fuzzy concept. Let's not go for one of the corners of that triangle. Let's create essentially a shared system. So, okay, for many purposes, what Kristen did about let's classify it in a certain sense as a fixed exchange rate. To some extent, sometimes you can do, but fundamentally, we have a common currency. And how that works with a governing council now with 26 members, and again, with so many countries involved. And we all know, we knew then, and we still know, it's obviously a lot easier if the shocks are mostly common shocks, and a lot more difficult if the shocks are country-specific shocks. And then this idea of country-specific shocks, there's really two types. One is basically asymmetric shocks, and these can happen. The question is, in the ratio of the overall type of shocks that hit economies, how important are they? And some shocks were important in this period, like the rise of China was asymmetric across Europe, for sure, But also a lot of asymmetric shocks are really asymmetric policy errors. And if you can avoid those policy errors at the national level, then the common monetary policy can be more effective. Okay, so then in this period, I think it's fair to say pretty big common shocks and common trends. The trend in the real interest rate, the global factor in the business cycle, as Kristen was mentioning, the pandemic, the war now that we have, the energy shock and upcoming, and now climate change and various geopolitical trends and shocks and trends. And basically all the time, I asked the staff, I asked everyone, okay, show me the counterfactual. How would we deal with all of these with 19 extra currencies in Europe? Would this really make policy making as effective? I'm sure they would all deliver low inflation by hook and by crook. But in terms of the efficiency of policy making, it's a local solution in the sense that it does internalize the intra-area spillovers. So Richard mentioned the issue about competitive devaluations, even calibrating monetary policy. So Maurice worked last autumn about watch out for spillovers. Of course, we also have to watch out for global spillovers. But the internal spillover across Europe, if we had 19 extra monetary policies, would be quite something. And I would want to emphasize, it's already come up with Jose, that essentially if you have this zone, which is big enough, that essentially the euro is the currency of pricing. It's the currency of trade within the euro area. It's the currency of importing into the euro area. And it's the currency of finance. A lot of the issues about which you might be concerned about volatility are limited. Let me emphasize, analytically, the euro is the anchor for the wider European system. I'll show you that in a minute. And then also, I would say, trying to keep the time, of course, I focused on a lot of intra-European issues, but of course, we pay great attention to all of the global spillovers. And I'm not going to show charts today, but I mean, maybe over the course of today and tomorrow, I mean, how the global system works, and we've seen this again this week, is underpinned by swap lines among the major currencies. And just thinking about the ability of those countries involved in organizing that system is really do we have a system? Do we not have a system? We do have a system, and it's underpinned by the major central banks working together in that sense. Okay, so here are some of the pictures. One is basically the dominance of the euro as a regional currency. So most of the trade for Europe is in euro. Most of the trade beyond just the euro area is in euro. So in that sense, it's this regionally dominant currency. And it's important, honestly, for me, when we think about movements in exchange rates and how they matter and so on, how they matter for trade. I mean, what Jose said, I fully agree with. Like over time, this issue doesn't matter so much how you invoice because the macro takes over. But for a lot of this, it's quite important. And on the right, you see country by country, it's very important. And let me make a kind of glancing comment here about the last couple of years and how countries in Europe have been responding to the inflation challenge with monetary policy. Now, you can do this in different ways. So here in the horizontal axis is basically the surge in inflation. Here in this chart is since the start of 22, maybe I should have gone to mid 21, which is more when the surge started. And the vertical axis is the cumulative change in interest rates. And maybe one basic point here is essentially, with the exception of Hungary, which is has its own journey up in the upper quadrant, essentially interest rates have not, they definitely moved earlier than the ECB, but in the grand scheme of things, the interest rate responses have clearly been anchored by what the ECB has done, even though the inflation challenge has been quite different. I think this connects back to the anchor role of the ECB in the European system. Okay, so let me, having raced through that, and I hope in the panel discussion we can come back to some of this, it is essentially when we think about the history over a longer horizon, for me, only in the recent years have we started to see a more mature version of the euro. And the question of under what circumstances does this how costly has it been? How beneficial has it been for countries to join the euro? And I think in terms of the trade-offs, the joint ability to respond to common shocks does mean it's increasingly popular. It's pretty high and stable level of popularity for the euro, more than the ECB, I should say, but for the euro as a common currency, people like it. There is not any big kind of alternative narrative to that. Second point I want to say is, again, it's an anchor for the region, not just for the euro area. All of this did require, and this was the learning over 10 or 15 years, ancillary policies. Macro-PRU, micro-PRU, common supervision, the European fiscal framework. It's not over. We clearly think more needs to be done in terms of banking union, capital markets union, and some central fiscal capacity. And then, as Richard already mentioned, we're in a new phase now of digital currencies. And just imagine if the European debate was talking about 19 extra digital currencies. We all know with digital currencies, the issue is going to be more severe for small countries in terms of potential of substitution. So for the euro, again, this digital phase, I think will come back to the value of a common monetary policy and essentially losing the floating exchange rate at a national level. For the unique circumstance of Europe, counter maybe to the global trend, I think that this is turning out to be a stable approach. Let me stop there.
Well, hi, everybody. It's really great to be back here at Peterson. And I think what I'm going to be saying in my remarks here are bringing together quite a bit of the themes that were already in the panel. So maybe it's just that great minds think alike. And so we are all kind of focused on the same set of issues. But I'm going to talk a little bit about 50 years of exchange rate pass-through. It's a really large topic, so I decided to take the advantage of you note on the title there that I was in the International Finance Division with, of course, Ted, for quite a few years at the beginning of my career, and now where I am at the Monetary Policy Committee at the Bank of England. So I sort of have a bookends of this looking at exchange rate pass-through. So in the early floating period, sort of at the first 10 years or so, really the only thing that we focused on was, how much did the exchange rate move? How did it affect import prices? And then, following on from there, affecting CPI or whatever the preferred measure of inflation was. Maybe there were periods of time where we might look at trade-weighted exchange rates, or maybe we looked at bilateral exchange rates. We might have used methodologies that went directly from the exchange rate changes to the CPI. Maybe we looked at intermediate methodologies and tested whether some of those coefficients of the exchange rate pass-through was equal to 1 or wasn't. But that was sort of like the first 10 years, I'd say. Then, when exchange rate pass-through met the IO, industrial organization, in other words, there was a real major research explosion, which we're really addressing as well right now. And I just had to give you this first paragraph of my 1986 Federal Reserve Bulletin article on sort of the, as I say, prices, profit margins, and exchange rates. This was industrial organization. This was disaggregated data, which I had to handwrite out from microfiche. And so it was, about the exchange value of the dollar declining from its peak. How is it going to affect domestic inflation? This pass-through relationship had been stable, a point that I will return to at the end when asking the question whether it will continue to be that way, and whether or not, for example, volatility in exchange rates mattered. So we can kind of think about how the questions have remained the same. It's just that the data that we apply to them have improved. I'd like to, going back to what new things I'm going to add is first the shocks, which have already been discussed a little bit, but I'm going to talk about them again, and then definitely come back to the role that central banks play in exchange rate pass-through. It's already been mentioned a number of times, but I think I have a couple different charts. So, there is so much research on these topics that one has to decide who's kind of generated the best charts, and who's also going to be at the event. And so this is both a great chart pack, as well as it's from Kristen's work when she was on the Monetary Policy Committee at the Bank of England. And what this work does, and I think it really opened up a very broad set of research. It's from 2015, and there has been a lot of research since then, but this is for the UK, and it basically shows how the two pieces of exchange rate pass-through, from exchange rates into import prices, and then the second step from import prices into the CPI, depends on the nature of the shock. I think we need to continue to look at both of those steps of the exchange rate process, exchange rate pass-through process. So what these charts do is taking a 1% appreciation of the sterling, so that's what we're doing in this particular example, what generated that appreciation, and that is on the left-hand side, and then what are the implications for CPI, which is in the right-hand panel. And you can see that depending on which generated the original shock, you end up with some dramatically different outcomes, both on the first stage of import pass-through, exchange rate pass-through to import prices, and then the second stage to CPI. Now, what these charts do, which I think is a very clever way of showing these charts, is it is showing you essentially the elasticity. It's in a VAR context, so it's not a structural time series estimation, but it's showing you the impact effect and then the time series effect of this, the nature of the relationship between the two phases, the export price, exchange rates to import prices, and then along to CPI. So for example, if we just look at a blue line here, comparing the two, that would be a UK demand shock. It does is associated with this appreciation, which reduces import prices. You can see that on the left-hand side. But then what happens when we take that demand shock, and including the import price effect, and we end up on the right-hand side to show that domestic inflation, even in the face of an appreciation, is robust in the face of a demand shock, so that the demand effect is outweighing both the imported price effect as well as the pass-through. So here's a case of where in sort of IO terms, do the domestic producers get to take advantage of both a reduced cost of inputs and then price higher once it gets into the domestic market. Now, another example that I think is an interesting one to consider here is the green line. That's where the appreciation of the pound was due to a domestic, let's see, green is the domestic supply shock, another interesting situation for the UK. And in this case, you end up with this was a positive global domestic shock, reducing import prices again, say it's a productivity shock. And in this case, the impact on domestic prices is, of course, dramatically different. So this is a case of where the underpinnings of the supply shock show up both at the first stage and then at the second stage of the pass-through. So turning now to sort of the central banking part of this, I think what one of the points that has been brought out in a number of cases is the reduced role of exchange rate pass-through, and somehow that this is it doesn't really matter anymore, that exchange rate pass-through is not an important question. And perhaps that's why when Adam listed up what were important issues on the PIIE website, that wasn't, exchange rates weren't a vocabulary word there. And one can argue that, well, maybe it doesn't matter anymore. This is taken from a paper from the IMF, which is looking at how exchange rate pass-through has changed over time, over pretty short period of time, really, with the pass-through into 12 months being in the purple, and then pass-through in the longer period, 2 years, being in the black bar. Over all of this time period, you can see the exchange rate pass-through really is no longer very interesting. It's all small. It hasn't really, it's no longer a big driver of the underlying state of inflation in economies. Now, is this just the Great Moderation? Is this just because of central bank credibility and inflation targeting? Well, maybe. And since we are all credible as central bankers, maybe we will be able to continue to be credible in the face of the shocks that we're going to be observing here over the next few years. The digging down on central bank credibility and digging down on a central bank's perspective is to argue that exchange rate pass-through is essentially endogenous to central bank policy. And this is an example taken from a speech middle of last year, where I evaluated the extent to which exchange rate pass-through, which is in the middle chart, and then effect on consumer prices in the right-hand chart, how that is related to a reaction function of the Bank of England generated by the data, which is in the solid blue line, and then two other reaction functions, either an activist reaction function of the central bank policymaker or a gradualist one. So let me just step through this quickly. And that is, we were, there was facing a situation where, let's say there was monetary tightening in the neighborhood. In this example, it was monetary tightening in the United States. And then what would be a logical, what would be a response by the central bank in the UK? So the blue line, as I say, the dark blue line is generated off of the actual data, the implied reaction function of the Bank of England from the data. And you can see that this reaction function is, there is monetary tightening. It does lead to, you can see it initially tightens in the UK by about 25 basis points. And then there's a loosening following thereafter. What that does to sterling is to initial appreciation of the sterling in the dark blue line, but not very much, not very much. And the overall inflationary outcome on the right-hand panel is one of higher inflation, higher price level, actually. Now, the two alternative reaction functions were either activists raising the domestic policy rate by the full amount, 100 basis points, or to gradually step up in the dotted blue line. The inflation outcomes, the sterling outcomes in the center, a lot more sterling reaction from an activist approach versus the gradualist approach, and the inflation outcomes or the price level outcomes on the right-hand panel being dramatically different as well. So to stabilize price levels in the face of a spillover coming from abroad, an activist approach would have stabilized the price level. And then just to conclude, for some future work, as this chart is taken from, I don't see Carmen out there yet, so. Okay, well, as I was saying, taking the charts, you can see the extent to which exchange rate volatility has dramatically fallen. GDP-weighted inflation has dramatically fallen, but look at the title of the paper. The reason why this matters is that the research frontier for exchange rate pass-through, in my view, has to look at asymmetries, ups versus downs being mattering. Volatility is probably going to be higher, not lower. There are thresholds that firms look at when considering whether and when to change their prices. And I also would hope that there would be a stronger marrying of the Helene Ray work, the financial flows and risk, and into the pricing strategy, which it plays a central role in exchange rate pass-through. Thank you.
Thank you very much to all our speakers. If I could ask our 4 distinguished panelists to make a panel. Sorry to be the time police, but given the quality of people in the room, we want as much discussion as possible. As I would say, as usual at the Peterson Institute, but we're a little out of practice on in-person meetings. There is a moving mic up front with our meetings coordinator, Jessica, and there is a standing mic in back. I'm not going to pose any questions because the audience is good, but first I'm going to ask whether, starting with Jose, you wanted to make any response to subsequent speakers, especially since I think Kristen specifically referred to you at the end of her talk.
Just one comment that I'm very surprised because we have been talking about how the exchange rate pass-through had changed over time. One of the things that I was doing preparing for this talk was to check the pass-through for the current very high inflation. And if you correlate them, it's 1-to-1. But so because it's an inflationary shock, it's not exchange rate shock. So I think that we have to be extremely careful. I haven't seen the recent evidence, but yeah, we have to be careful with evaluating what are the true exchange rate pass-through because indigeneity and causality may go the other way around. That was it.
Thank you. You're as always extremely concise, I say. Kristen, Catherine took your prior work in not in vain, very much in spirit. Is there anything you would like to respond to from Philip or Catherine?
Actually, I hit what I'd like to see done, which I'm sure neither of you have done yet, but a good agenda for future work is, as Catherine highlighted, there's now the evidence that the extent of exchange rate pass-through varies based on the shock, why the exchange rate has moved a lot. But then both Catherine and Jose mentioned that exchange rate pass-through seems to have fallen in the late 2010s. But my take on that was part of the reason exchange rate pass-through had fallen was the nature of the shocks was different. You didn't have some of the major shocks in the 2010s, which are correlated with more pass-through. But it seems like we have just had a tremendous natural experiment in terms of some massive global shocks, some massive supply shocks in the last 3 years. And at least in this earlier work you cited, supply shocks often have much greater pass-through. And that could be a factor contributing to high pass-through from exchange rate depreciations into inflation, and why inflation is more persistent in some countries. So I just wonder if either of you would comment on that, if that fit with what you looked at, although my guess is you haven't actually estimated it yet.
Well, the low pass-through, a very old story. I see Holger Wolf, we work at that time together, and I realized that the pass-through were extremely low. The first time was for the Euro crisis of the late 1990s. I just talk an anecdote. When you become older, you can tell anecdotes. I was at the IMF in the team of Italy and Spain that were in the EMS joining the Euro. And I came from Latin America, and I remember, so I said, well, and they were extremely afraid because they said, if we have a devaluation and we do a readjustment, pass-through will be 1-to-1. So I remember I said to a famous policymaker now, but in Latin America, it didn't happen this. You don't have 1-to-1, but this is Europe. So that's fine. So that was
Anecdotes can be good. This is good.
At that time, there was a huge adjustment of currencies in the early 1990s. There was no inflation and rapid growth in Europe.
Thank you. I'll just say, if somebody wants to do that study for the Peterson Institute, that would be good too. Philip, you brought in, as we expected, an absolutely critical, important perspective about what Europe has done and tried to make it fit into the overall framework without overselling it, and we appreciate that. Given playing time cop in your dense 5 slides, is there any other point you'd like to make before we open to the general discussion?
Well, maybe just again thinking about natural experiments and also ways to kind of understand the world. I mean, the euro is also, because we know, is a big political motivation to form it. So thinking about, we now have 25 years of data of the euro. So thinking about, for example, exchange rate behavior, spillovers. So let me call out a few different things, but from my life as an academic researcher and then something we see day by day. Number one, the real exchange rates within the euro area are much less noisy, obviously, because we don't have national currencies. And over time, what you see is the trend in those real exchange rates do a good job of matching productivity, the terms of trade, and so on. So in other words, if you clean out the noise of nominal volatility, models of exchange rates that you might run on a real basis show up. What is also true is across Europe, across the euro area, the inflation differentials across the member countries highly correlate with trade-weighted exchange rates. Because, of course, all countries have different trade patterns around the world. So in the sense of but I wouldn't locate it necessarily as just mechanical pass-through. It's more, as Kristen just said, you have to think about the shocks that generate swings in the external value of the euro and how that affects countries differently. What I would say is, and again, when you think about this, for a lot of macro and different central banks differ about how closely they adhere to this analytical framework, differentiating essentially the local non-traded component of inflation versus the tradable sector. And the tradable sector, I mean, Cathy's 1986 Federal Reserve Bulletin, it's exchange rates, profit margins, and profit margins is a big story in Europe at the moment. And the connection between global prices. Of course, if the global price on tradable goods shoots up and you're a European producer, your cost base doesn't necessarily change. And it's going to pass through one for one into profits in some sectors. So I would say the margin of profit margins, I think, is quite important. On the asymmetry, let me mention 2 asymmetries, because we just had a big increase in costs, and now that's reversing. One is the intersection with financial constraints. Absolutely, last year, the scale, so it's not so much, the scale of the shock was so big, various firms would just have shut down if they did not pass through immediately the price increase. In reverse, you don't have the same bankruptcy constraint. So when the input cost falls, then it's going to be a market structure issue, a competitive pressure issue. But in the other direction, absolutely last year, it was basically, if we don't raise prices, it's over. So that kind of basic solvency constraint, I'm sure, has mattered quite a bit. But I also agree with Cathy, it also depends on the monetary policy reaction as well, how exchange rates respond. So let me stop there.
Thank you, Philip. Catherine, given the discussion, anything you want to add?
So the one thing I want to emphasize.
Could you turn on your mic, please?
Right. The one thing I think I want to emphasize is ultimately exchange rate pass through both at the first stage and the second stage is a function of firms' pricing strategies. One of the things that we have learned with looking at our decision maker panel, which is a publicly available thing, is that firms' pricing is very much related to the skew and the distribution of the prices in the survey itself. So it's not just a matter of sort of average input costs or average exchange rate movements. It's very related to the skew and to the dispersion. What that means, and why I brought up that last slide, is this: we may have been living through a period here over the last 20 years where we've been able to pat ourselves on the back. Oh, the great moderation, central bank inflation targeting and credibility. All of this has, collectively enabled us to keep inflation low. To the extent that what we are now observing is much more volatility in exchange rates, especially financial determined exchange rates as opposed to the trade weighted ones, and much more volatility in inflation and much higher dispersion in inflation across different product categories and therefore across different firms, that we may well be entering a very different regime where we're going to have to work much harder as central banks in order to rein in and tighten in the distributions that firms are facing when they're making their pricing decisions.
Thank you, Catherine. Okay, again, let's open it up to questions and comments from the floor. Raise your hand near the front if you'd like the roving mic. Stand up near the back if you can, near the standing mic, and please identify yourself. Please.
Hi, I'm Lou Alexander from Rocos Capital Management. Thanks very much, great panel. I actually have a couple questions. One for Jose. I was struck by your comments about the last 20 years exchange. We've had a lot of fluctuation in exchange rates and relatively little connection back to emerging market crises. As someone who kind of lived through the Asian financial crisis in the 90s, that was quite striking. To what extent was that a private sector response, that the private sector just decided they didn't want to have the kinds of exposures we had previously? Or to what extent was it a successful public sector response? But as you noted, I think it's a big success. I think for the rest of the panel, as we think about how the major economies respond to these big shocks that we're having, these big global shocks, I am struck by the fact that there are structural differences in the economies that also affect these things. And so it's not just the distribution of the shocks that matters. I have to say, sitting in London, you see what's going on in labor markets. London and Paris looks very different than what's going on in Berlin or Japan, for example. And so I'm curious, how should we think about those differences? And I just have to say one thing for Philip. On your list of things, I was struck that you didn't have German unification and its run into the ERM crises. Like, obviously, that's a very unusual set of shocks, but it had very specific consequences. I've been sitting here trying to think whether or not Ukraine could generate something of that magnitude, and I think probably not. But it is a relevant case, it seems to me. Thanks.
Thanks, Lou. Who would like to, anybody like to respond?
Just very briefly, after so many crises, and so I think that there is a strong regulation and very prudent. So I think that there is a role for public policy. But I think, and this is just by stories that you hear, that people that get very hurt with past financial crises, and that's well known, and they become a little bit more prudent. Then I think, why in the US we had some financial crisis very recently, and it seems that people forget, well, must be more, we need more sociological argument. But I think that there are differences that are striking.
Lou, I'll answer your second question, that the structure of economy should matter for pass-through of, say, exchange rate movements, adjustments, as well as the specific shocks. You're exactly right. I actually, in this work that Kathy nicely cited, a second paper I wrote in the series of papers was actually called Shocks versus Structure. And I tried to separate out what's the role of shocks versus the role of structure. And if I remember correctly, what we found is that in terms of the average level of exchange rate pass-through across countries, the structure of the economy is most important. If you heard in the euro and all other aspects, financial system development, your structure matters. But in terms of why pass-through changes over time within countries, that's where the shocks come in and can matter quite a bit. So both matter, but you're exactly right. The structure is most important in terms of the average level of pass-through in response to external shocks.
Thank you. Phil?
I mean, I think it's it's always true, but of course, the cliche of sometimes decades pass slowly and sometimes decades happen within a short amount of weeks in the sense of the momentum. And I did have on my list geopolitics. So in a sense of when I think about the shocks hitting the world or hitting Europe, geopolitics. So whether at one phase it was within Europe, the formation of the EU, German unification for sure. And then, honestly, for the euro area to work out, what is it prepared to do? Is it prepared to set up the ESM? Is it prepared to have a single supervisor? Lots of things happened within Europe. I suppose I was saying maybe that phase within the euro area was basically, I think, more or less concluded in that phase. There's more to do, maybe around 2015. But then looking ahead, these are some of the biggest potential sources of shocks hitting the economy. Let me mention, which I think is a general issue, is about structural change in the economy and the effect of monetary policy. Definitely one of the topics we're mentioning, and President Lagarde mentioned it yesterday at the Watcher speech, is there are changes in the financial system, but one of the big changes in the world is, I suppose, the rise of the tech industry here and in Europe and around the world. And think about the economics of tech, the economics of intangible capital, the role of basically earnings in the distant future discounted to today, and how interest rates work in that world compared to the world where historically you might think about interest rate sensitive manufacturing, that kind of thing. The role of housing, we spend a lot of time saying, okay, we can see what's going on in housing in the US. In the area, there's definitely been variation in the size of construction, the size of the run-up in property prices in different countries. And in the end, I mean, the euro area and the euro system, we definitely have always a two-level analysis. One is top-down, let's look at the aggregate euro area. But the one reason why we still have a very important role for the 20 member central banks is we have to understand through those national central banks, the variation across the member countries. So that structural differences are quite big in many ways across the euro area. So the bottom-up kind of way of analysing the euro area is also important, even if in the end we just have one monetary policy to run.
Catherine?
The only point that I would add is structural differences across countries ultimately does get manifested in different ways in which financial flows cross borders. And if to the extent that those financial flows are the main driver of exchange rate volatility, which then will have to feed into pricing decisions, feeding into pass through both the first stage and second stage, those structural differences do get manifested in higher dispersion of exchange rates. So I think it's more challenging to figure out a bright line between structural and shocks, because ultimately the exchange rate is the ultimate cross-border relative price. And it has a lot of inputs into it, and some of it's the structure in the different countries, and some of it is the shocks and how they are interpreted. But ultimately, it is the key transmission mechanism.
Thanks. Right here, please.
Fred Bergston. My question really goes to the topic of the next panel rather than this one, but I want to put it to Philip, and this is the only time he's on the platform. So I want to ask him, why, in your judgment, has the euro not assumed a greater role in international finance? As I understand the data, the euro's share of everything is roughly the same as the legacy currencies added up in the past. Why has not the euro, as many had predicted, taken a bigger share of global financial indicators?
Before Fred gets a reply from Philip, I should just note, we published the Peterson Institute 2 books, The Euro at 5, Ready for a Global Role, and The Euro at 10 with a similar title. And both of them we predicted it would not. That was your prediction, Fred. Anyway.
So now I want to ask him, why were we right?
Well done.
So I mean, it's an interesting topic, and it's also interesting to think about the economics. Should we use these kind of share ratios as a relevant metric for anything? I mean, of course, it's interesting. So let me go over some basics here. One is European residents can conduct their lives in euro, and that's just so fundamental, as opposed to worrying about, should I take a foreign currency mortgage So having, it is not, people skip, basically whenever I'm on a panel or conference about the international financial system, people skip over how remarkable this is. So that's kind of, I think, the first order point. The second point, which I did allude to, is for the region, the euro is an international currency. So in terms of there's a lot of euroization, in the neighborhood of Europe. From our point of view, the fact that a lot of trade is invoiced in euro, not just from small countries, but it is important. So from the domestic point of view, how much you care about internationalization is how much does it affect you. There's a second type of internationalization, which is basically where you're basically a vehicle for kind of third-party transactions. That is there, but again, it's not so clear from a policy point of view how important that is. Let me mention one basic point, though, is the important role of the dollar in the world. This is a complete conjecture, but the fact that the euro is a pretty big second currency has meant the euro-dollar swap market is gigantic. So if I want to do something in euro, if I can raise finance in dollars, swap it into euro. So from the economic point of view, in terms of the footprint, if you like, of finance that's relevant for the euro, a lot of that may take place in dollars because the swap market, you have, because the problem with the data is you don't see, you have these surveys of swaps, but to have the perfect alignment of the swap data with the kind of currency of issue. So the currency of issue, the dollar has a very strong role, but that doesn't say that economically that if you like, is really pure dollar finance. If it's swapped into euro, of course, someone has to be on the other side of that swap. But I think that's very important in the dynamics of the European financial system. I can also tell you, going back 15 years, the Irish, the rapid growth of credit to the Irish system, which was a project, most of that was in dollars and in sterling. But the only reason they could raise so much dollars and sterling was because it was swapped out into euro, back to back. But mechanically, going back to gravity, Richard talked about gravity earlier on. Of course, for a country like Ireland, the big connections are with the London and New York. And it's the fact that they could issue a lot of dollar bonds, sterling to some extent, and swap that into euro was fundamental to that particular credit bubble we had in that time. So what I would say is, in a world of derivatives trading, having a clean idea of the role of the dollar versus the euro or any other currency, you get a partial insight from looking at the kind of issuance data. In terms of the economics of it, I think you have to think about the swap market as well.
Thank you very much. And thank you to Fred for previewing our third panel after lunch, chaired by Joe Gagnon, will be about the dominance or not of the dollar. Did I see Harold? Yeah, could you give him?
Thanks. Harold James. I wanted to ask a question about the final observations of in Kristen's paper, but it was an issue that was really raised in every one of the contributions. That is that the advanced economies, the big economies, look different in terms of going to the inflation targeting story than emerging markets. But I wondered whether that was true in the past, and in particular, whether there isn't a case that if you're wildly unanchored, it's not a good idea to introduce inflation targeting just in the abstract, but that you could use the anchor as a glide path to get into the inflation targeting regime. And particularly, it seems to me that that's exactly the experience of the UK, that the EMS period was exactly that period of getting from unanchored expectations to a better regime that then made the inflation targeting possible. And actually, the Bank of England and the UK Treasury got Alan Greenspan to tell Mrs. Thatcher, who was opposed to the EMS, that it was a good idea to have a spine because Mrs. Thatcher listened to Greenspan. So I thought that was an example of exactly this trajectory that you might need.
Yeah, let's reverse the order. Catherine, please.
So Ted and I, over the years, have discussed inflation targeting. And my view was that it, mostly by giving you something to focus on to explain yourself, mattered. That the targeting part wasn't particularly valuable. It was, if there's a target, then I, as a central bank or a researcher about central banks or whatever, I have to explain what's going on in my economy and how I may or may not be reaching this target. There's nothing magic about having a target. Understanding the behavior of your economy, understanding the pressures, the dynamics, the spillovers, the this and the that, this, and having to write about it in an inflation report or a report of some other name, that was the key element in improving monetary policy. I don't think Ted disagreed with me, but maybe he does. He can say. But that, to me, what matters about inflation targeting is not that you have one or not. It's how much do you use the anchor, or whatever we want to call it, the evidence that you have a target. How much does that actually get deployed in giving policymakers a better understanding about why their economy is doing what they were doing, and therefore helping to achieve an objective? I put a lot more weight on the transparency and the research side of inflation targeting. And then I'm just going to finish my final comment is, as we start to see the increasing volatility of the underlying, and volatility and dispersion of the shocks that we've been observing over the last couple of years and will continue to observe, who explains that best? Not who has the best target, but who explains that best is going to determine to what extent we're going to be able to get back to our objectives. And I think it's going to be hard. I think it's going to be hard to do that, harder than the last 20 years. I think the final comment on that, and reason why I put that paper reference in my slides, is because I think we are looking at a regime change here, and we have to think about it in those terms, and we have to think about it at the micro price setting level of the firm.
Thank you. I don't know if the other monetary policymakers want to comment on that.
Jump in. This big picture, this conversation has made me think about how when Bretton Woods broke down, countries needed a new anchor for price stability. Some advanced economies have shifted to the model of independent inflation targeting central banks, combined with flexible exchange rates. That has worked well. Some have combined that with the euro area, as Philip has talked about. That has also worked fairly well. Emerging markets have also tried some different approaches. Some have maintained still fixed exchange rates, and that seems to have been correlated on average with better inflation performance. But then in the realm of the emerging markets that have adopted floating exchange rates, there's a real variance in success. Some have combined it with independent inflation targeting central banks and have done well. Others have combined it with inflation targeting central banks and been less successful. So I think there, some of the different outcomes, undoubtedly, I haven't done this formally, but undoubtedly they're partly at least linked to how independent the central bank is. Is it really an independent central bank that can do what it needs to do to target inflation? And my guess is if you went that next level in the analysis, that would be a key reason for some of the differences that I sort of highlighted very quickly for emerging markets. But Jose, you probably have more to add to that.
Just one small question to not take too much time. There is a confusion many times in emerging markets. Inflation target is a strategy to run monetary policy in a stable country. It's not a disinflation strategy. Argentinians have tried to use inflation target with a huge fiscal imbalance. It's impossible. Macri tried, all of them have tried. So I think that is quite important. And indeed, inflation targets were adopted much later than Bretton Woods. Inflation targets start 1999, roughly. So there was a long way, but a long way to stability, and then how we manage appropriately exchange a monetary policy and for stable countries, inflation target in emerging market has worked.
Yeah. The alarm is going off. Let me just say a couple things beyond. Thank you to our very esteemed panel for engaging in such deep things. This is what happens, as with the previous panel, when you have the researcher policymakers come to the fore. For all the attacks on neoliberalism around this town, here at the Peterson Institute, we value people who combine mainstream economics with actual policy. Just two quick comments on the substance of the last set of remarks. I want to echo, in a way, Catherine's remarks about transparency. Back in 1998, the late Thomas de Laubach and I published a paper about German and Swiss monetary policy as an antecedent to inflation targeting. And we argued very strongly that the point was the transparency, and it gave you not an anchor in the sense Kristen rightly invoked Paul Volcker, but a anchor for expectations and communication that you could talk around. And that fed into the eventual book on inflation targeting. So just to say, I want to strongly associate myself with Catherine's view. The second point on that is through the years, going back to some of the classics at PIIE, in the chapter, the very limited chapter in inflation targeting book that Thomas and I drafted, and of course, Bernanke and Michigan oversaw, we talked a bit about Chile and Israel's transition to inflation targeting. And John Williamson published a book for the Peterson Institute. John Williamson published a book for the Peterson Institute on the crawling band. And it is interesting, again, this just sort of illustrates the point some of the colleagues have raised, that what you had was over time, as the domestic anchor became stronger, the bands widened. As the bands widened and crawled upwards, you got more flexibility. And at some point, essentially, the exchange rate band disappears, dissolves, and you're left with the inflation target. That worked for Israel and Chile, and to some degree for Colombia. And so, again, going back to, I think it was Jose or Kristen who said, it works for a stable country. You had to have had the stabilization, the exchange rate-based stabilization in Israel and other shocks, for example, to get to that option. But so it's very interesting to me, and I promise I'll shut up after this, to think about our colleagues who we're going to hear from in Japan, for example, who have to potentially get off of their yield curve control, whether this provides some interesting analogs they might think about. Anyway, with that, lunch is served. We encourage you to eat heartily, talk heartily, enjoy the break time heartily, and then at what time? Thank you, Jessica. At 1:30, we will reconvene for our third panel with Joseph Gagnon chairing. Thank you very much.
Okay, if everyone could please return. We'll start in 2 minutes. We need to keep on time, but 2 minutes. 2-minute warning, last chance to use the facilities. They should be. They should bring them up when in your the first one. I'll mention your name. Okay. Well, thanks for everyone settling down and returning to on time start. My name is Joe Gagnon. I'm a senior fellow here at Peterson Institute, and I'll be moderating the next session. The title of the session is Europe, China, and the dollar's competitive position 50 years on. When I first read that title, what I thought of was sort of these league rankings of currencies according to foreign exchange reserves or trade invoicing, and I think it's perfectly fine to interpret it that way, and our panelists are free to do so. But I was also encouraged by Doug and Maurice that another interpretation of the title might be the competitive position of countries, not currencies, and so in that regard, a striking thing that actually our very first participant, Bob Aliber, raised at the beginning is the period of dollar dominance has been a period of, especially the floating rate part of dollar dominance has been a period of chronic current account deficits in the United States, which now have pushed the international investment position of the United States to an unprecedented negative 70% of GDP. Never before in history has any one country borrowed so much from the rest of the world. So do we think that this has risks for the world and what policies might be used in the face of it are questions that also could come up. I note that when I was at the Fed, we looked into this in the early and mid 2000s. We were worried about the sustainability of this trend, and at that point, the net investment position was minus 20% of GDP. I never imagined it would get to where it is now, and with the trend still so negative. I would note that the era of dollar reserve currency, dollar dominance now is very different from the era of sterling. dominance in the late 19th and early 20th century. Before World War I, the United Kingdom was the world's largest net creditor, and now we're moving to a position where the US is the world's largest net debtor. So it's very different. Okay, so having said that, let me introduce our distinguished panelists. We have, first we'll do it in the order of presentation, Harold James. He's the Claude and Laura Kelly Professor in European Studies at Princeton, and he's also Professor of History and International Affairs at the Woodrow Wilson School and Associate at the Bentheim Center for Finance. And Harold and all our panelists have published numerous articles in journals and books in the topics of international economics and history, and I won't go into all that for all of them, but they're all quite accomplished. Catherine, or Katie Russ, is a non-resident senior fellow at the Peterson Institute, and she's also a professor of economics at University of California at Davis, and she's an associate at the NBER. Linda Tessar, or is it Tessar? Tessar, sorry, Linda, is professor of economics in the Department of Economics at the University of Michigan, and she's also co-director of the International Finance and Macro Program at the NBER. And then finally, Shangjin Wei is the N.T. Wang Professor of Chinese Business and Economy at the Graduate School of Business at Columbia, and he's also professor in the School of International and Public Affairs. That's our speakers. I would remind them that we have a strict 10-minute limit. I will warn you when there's 1 minute left. At that point, you really need to wrap up quickly. You can think that any points you have to skip over, you might be able to insert into an answer into a question later, so it's not a total loss. But we do need to leave lots of time because given this audience, I'm sure there'll be no shortage of good questions being asked afterwards. Okay, so with that, let me call up Harold James and to the podium.
Thanks so much, Joe. It's a great pleasure being here. Wonderful conference so far. And yes, it's magic. The PowerPoint comes up by itself. I wanted to start off, if I may, with something, first of all, that is just taken really more or less at random from journalistic comment. The euro challenges the US dollar as the global currency. And it's taking a terribly short-term vision of this just over a couple of years and saying, look at this is stunning. The euro is rising comparative to the dollar in the share of global payments over a relatively short period of time. I had to cut down the slides so I didn't show more of these things, but this is the example of how you take something from a short-term period and extrapolate, and it really doesn't make any sense at all. So what I think you really need to think about is the kind of issue that Bob Aliber started off with this morning about the big developments in exchange rates since the 1970s and how they were interpreted. And Bob gave, as it were, one version of it in which he talked about moments in which the dollar was overpriced, and there were, as a consequence, big consumption booms and a loss of employment in the United States. And the other side of the coin is that there are also periods in which the dollar is underpriced, and the Europeans get very upset about that. And this is, I think, the story of some key turning points when the European currencies rise against the dollar. It creates a genuine problem for Europe. It's already visible in the last phases of the Bretton Woods period. So this is a debate that starts already in the late 1960s, before the collapse of the power value system, before the event that we're celebrating the 50th anniversary of this month. What happens characteristically is that when there's an inflow from the dollar to a strong European currency, and in practice that means for all this period until the euro, it means the German mark. That pushes the exchange rate between Germany and France, or between Germany and other countries. And so just having something that goes wrong in the international system creates a strain in an institution where they're trying to get a common market since the Treaty of Rome in the late 1950s. And so if you're thinking of how things are priced then in terms of agricultural prices, when the franc mark rate moves, that's a colossal problem. So these are the four key moments, I think, when there are big shifts, and I wanted to identify them very, very briefly. The story of the end of Bretton Woods and then where the mark is revalued against the dollar. The story that the Europeans, but not the US administration, thinks of as the period of malign neglect in the late 1970s, when some Europeans think that they're seeing a really massive crisis of the US dollar. The period in which the dollar depreciates after the peak of the middle of the 1980s, after 1985, in the episode when the dollar is talked down in between the Plaza and Louvre. And finally, and most controversially, and you can see, I think, also from this figure, the effect that people were mentioning again and again this morning, that is that exchange rate movements, wild exchange rate movements, have got less pronounced. And so in a sense, this topic is less acute. But it's those moments with these red boxes where there's a lot of European innovation. And that's, I think, what fundamentally is one of the two drivers of the process which pushes Europe in exactly the opposite direction as Richard Portes was mentioning this morning, that this is a very strange story in a sense that the world as a whole moves to floating exchange rates after 1973, but Europe moves in the opposite direction and moves, first of all, to creating something that its makers, particularly Chancellor Helmut Schmidt and President Valéry Giscard d'Estaing, think of as a recreation of the Bretton Woods system in miniature. So they're working the Bretton Woods system in miniature. And I just wanted to put up some of the wording that was around in the negotiations of the time, because it's a kind of wording that would almost be timeless, I think. I was amazed when I found this handwritten instruction by President Pompidou in the archive in the French Finance Ministry before the collapse of the Bretton Woods system. It appears to me that it's necessary, this is telling Giscard what to write in his speech to the IMF annual meeting. It appears to me that it's necessary, without being aggressive, to show how unhealthy the role of the dollar is and how it's constantly losing purchasing power. We shouldn't ask people to set their watches by a defective clock. Or later in the 1970s, Helmut Schmidt is really pushing this over and over again, preparing in the foreseeable time a European response to the catastrophic consequences of the collapse of the dollar. And James Callaghan, who constantly then repeated what Schmidt was saying and transferred it, I think, to the US administration. So that's what you knew about Schmidt's thinking came largely via London and from Mr. Callaghan. He believes the dollar is going to get into serious trouble. I think the most fertile of these moments is the story of the dollar depreciation in the second half of the 1980s and the attempt of the French finance minister, first of all, to get a global system, get back to a global system of fixed exchange rates. And he hoped that the Louvre meeting, which he presided over, would do exactly that. But when it doesn't work, what Balladur says then is, we can't do it globally, but we're going to do it in Europe. And so he got together with the German finance minister, Hans-Dieter Genscher, and proposed the plan that is essentially the blueprint for the Delors Committee, and then that's the blueprint for the Maastricht Treaty, and that's the blueprint for the euro. The essence is that first of all, the European monetary system, the recreation of the Bretton Woods system, is a reaction to a particular moment of angst in the late 1970s, and that the euro is the reaction to a moment of angst in the late 1980s. The question is there something analogous to that in the more recent period? And that's, I think, a question where there's more room for debate, because whether there was a currency war in the early stages of the global financial crisis or whether there wasn't a currency war, I think is difficult to get an objective reading on. Clearly, there were voices. The most prominent was the Brazilian finance minister, who was saying, yes, what QE is doing is essentially managing a depreciation of the dollar for competitive advantage. And Europeans signed on to that. So Wolfgang Schäuble, the German finance minister, liked to echo that. The interview that Alan Greenspan, the former Fed chair, did just before the G20 meeting in 2010 gave a lot of ammunition to exactly that line of argument. America is also pursuing a policy of currency weakening. And again, I think you can see the story of the reaction to that, that as in the late 1970s with the construction of the EMS, as in the late 1980s with the construction of the project for the European Monetary Union, what happens between 2010 or 2011, you can really pick your date, and 2015, is the process that Philip Lane was talking about this morning, which is really creating a deeper institutional foundation for the European project and getting rid of some of the, not all, of the original imperfections of the project. Well, I said this story is one of the stories that pushes the creation of the euro. The second story, which I think runs in parallel to that, and is a domestic or internal European story, is also a story about current account imbalances, but a story this time about current account imbalances in Europe, with moments when there are big German surpluses in the late 60s, well, big in comparative terms, they were treated as big in the late 60s, but they're tiny by modern standards, but then more in the 70s, more in the second half of the 80s, not at all in the 1990s because of the consequences of German unification, but then again in the 2000s. And those moments are ones that cause the internal European strain, which also make you think that Europe needs to do something. I have 30 seconds left, so I wanted to say one word about how this is negotiated. This is full of negotiations. This is multilateralism in action. Whereas the creation of the floating system or the non-system is not really multilateralism in action, it's multilateralism by accident. And that was nicely emphasized this morning. Does that have a lesson for the future? I think it does in some ways, and that if you're thinking of the global goods, the problems that we're having at the moment, first on that list is climate change, and Europe has been trying to deal with that for a long, long time by some kind of emissions trading scheme, by discussions of carbon pricing. It's clear that the United States is not going to sign on to that scheme, so it's clear that it's not going to be a global scheme, and you're going to have a kind of retreat to the European level of the kind that Balladur did. But one thing that is hopeful about that, and in the same way that the multilateral non-system is, and I think it was rightly thought of generally as a positive feature this morning, is that what the United States does unilaterally through, in particular, if you take just one bit of legislation, the Inflation Reduction Act, putting tremendous investment into green energy is going to change the pricing structure of energy production so that maybe the carbon pricing models that are so problematic and so difficult to negotiate become less relevant if you just inject a tremendous amount of investment into green energy sources or renewable energy sources rather than a traditional thing that you need the pricing model on. So this is in a way a story about a style of negotiation as well as about an actual outcome. And thank you.
So thanks so much to Doug and Maury and Peterson Institute for including me on this spectacular program. Already learned so much this morning. So like the floating dollar, I am 50, born in the winter of 1973. And although at the time I had no idea of the momentous events occurring around me in international finance, I have made some observations since then. And I'd like to use them in the next few minutes to explain why I think that we can use geography as more of a guide to understand their effects. So, okay, so when I think of the impact of a floating exchange rate on trade, I immediately think of what I learned from Maurice's textbook, which is expenditure switching, and that is how freely floating exchange rates can provide mutual insurance for countries. As an example, when the US economy grows faster than China's or Europe's economy, the dollar appreciates. And that strong dollar makes the foreign goods look cheaper to US consumers. So this boost to US import demand for their goods ends up stimulating production in China or Europe. Now, the flip side of that is that the strong dollar, as we've heard earlier today, makes US goods look expensive, so that dampens US exports. But the opposite is also true, right? So when economic growth in the US slows, the dollar weakens. And that can help stimulate foreign demand for US products. So we get a built-in cooling when the US economy runs hot compared to the rest of the world, and a built-in stimulus when it's running slow. But what about when the dollar is strong for other reasons? Now, the expenditure switching argument really makes a lot of people wonder, well, why should we worry about currency volatility at all when it comes to trade? Because it's always attached to fundamentals such that when exports face headwinds, that will be at a time of broad-based domestic growth. And I think that's why we see the literature in trade on the impact of exchange rate volatility on trade so conflicted. There really isn't one direction when you run those regressions. But sometimes a currency is strong for other reasons, and in particular, the dollar in its special role. So we can worry about fixed exchange rates among trading partners, as we've heard people raise as a concern this morning. And I think that we can think of that as a long-term phenomenon. At least I think most pegs are put in as hoping that they'll be long-term. And we already pay a lot of attention. So there's a lot of attention to these in the literature. But then there's also the exorbitant privilege. So in risk-off events, people flood into dollars, and we might be overlooking local impacts that may be driving some bigger things in the United States. So if you take a look at the long-term relationship between the strength of the US dollar and long-term trends in US manufacturing employment, I mean, if you squint, you can see there may be some, general correlation here, but it's really hard to say that one is driving the other or that there's a really tight relationship. And why is that? Well, some research I've done with Jay Shambach, Catherine Erickson, and Min-Fei Xu suggests that US manufacturing employment appears driven by secular trends over the long term. And these started really a long time before the pegs after the fall of Bretton Woods. So if you look at where, say, the China shock industries were located in 1910, just taking an example of one country that people say the devaluation of their pegs may have driven an import surge and decline in US manufacturing, those industries already had been moving away from where they spawned. So these innovative centers where they spawned at the beginning of the 20th century, by 1980, before the China shock even hit, before most of the tiger shock had even hit, these industries already had aged out. They were aging industries. They'd moved to more fragile labor markets where wages were lower, where workers had less education, where we see fewer patents per worker. So you can think of this as a manifestation of Vernon's product cycle, if you like, but whether or not you do, what these charts suggest to me is that pegs may have contributed to the acceleration of this product cycle or whatever process after 1975, but didn't cause it. They didn't start it. They didn't start the fire. We may be overlooking local impacts, though, of the exorbitant privilege. And I think these local impacts deserve a lot more attention. So dollar dominance means that that global risk-off events will strengthen the dollar. So when investors dump foreign assets and flee into dollar-denominated assets because things are going awry, either here or elsewhere, then the dollar appreciates. Caballero has he's identified a couple different risk-off events in recent years, so September 2008, August 2011, August 2015. These can result in some intense pressure on import competing industries in the US and on US export industries. And at least according to Caballero, these can last up to 9 months. So it's not, it's not an instantaneous phenomenon by any means. This can really cause businesses that have low profit margins to struggle. So I think that we have a lot to learn about the geographic distribution of this kind of turbulence. I'll just take one example, the August 2015 risk-off event. So this was China's Black Monday. It was followed by a period of sustained relative dollar strength. So the dollar already had been appreciating due to fundamentals that would generate the natural expenditure switching, but maybe the dollar strength was sustained for longer than it would have been afterwards. But what we definitely see during this time period is a stalling in US manufacturing growth. So at a time where the jobs reports were just really, really strong in the United States, you see a leveling off of growth in US manufacturing jobs. And what I'm concerned about here is that some effects may have been highly localized in ways that we were really just ignoring as policymakers. If you think about the China shock, the China shock hit Silicon Valley too. We don't worry so much about that. But its negative effects were highly localized in some places. And so the same may be true of these risk-off events. So if you think about a potential impact, well, just looking at these dates, this was a couple months before a change in party in the White House. This was shortly before a change in party in Congress. This was, again, shortly before a change in party in the White House and the fall of the Blue Wall in November 2016. So we have to wonder sometimes if mini recessions in certain tradable goods sectors may generate political instability or other kinds of acute local impacts that we should be concerned about, not just as politicians, but as policymakers. And that we've been overlooking. Because I do think right now political instability might be one of the biggest threats to the special role of the dollar. Thanks.
Hi, my name is Linda Teasar, and I too want to thank you very much, the organizers, for this opportunity to present. And yes, we're going to have the miracle of the slides, and they even are correctly aligned. So let's see how the clicker works. Can we make that full screen? Wonderful. Okay, so I took a really big step back, given that we're doing a 50-year retrospective, what have we learned about exchange rates and what do we think going forward? I took on that big question, in 10 minutes, and added the question, how has the international monetary system adapted to the creation of the euro? And I want to narrow that down just a little bit, though, to ask, what were we thinking as academics about those questions in real time? After all, we were all trying to learn how the world was going to operate under flexible exchange rates. So what I did to try and get my head around that was to go to the JIE, partly because the JIE is the main journal publishing international economic articles, and partly because I've been a co-editor for a little while there at different points, but also the JIE has the data. So the JIE allowed me to pull the titles and the abstracts for articles published in the JIE, and I did this for different time periods to see. I took all the articles that had the word exchange rate, the phrase exchange rate, either in the title or in the abstract, to see what else were we thinking about when we were writing about exchange rates. Now, this comes with a bit of a lag, right, because publication lags are long. So I've got the 1980s, so this is a bit after we've moved to flexible exchange rates, and created a word cloud here so you can see what were the main things that we were writing about. And you're going to see a theme, not surprisingly, things like the current account, the interest rate, monetary policy come up, but But you also see some new things. Dealing with capital mobility was on a lot of people's minds. Rational expectations, how are exchange rates determined? Thinking about the stochastic process and what kind of models we're going to write down that describe exchange rates. We were still thinking in kind of long-term purchasing power parity, non-traded goods as fundamental determinants of relative exchange rates. If we go to the 1990s, things change a bit. Of course, we're warming up for the euro area, and we start seeing things like a lot of papers about the target zone, exchange rate bands, about the European monetary system. The random walk is still in there because we're still dealing with a lot of exchange rate volatility, and also writing about capital controls. Other topics too, but you can kind of see there's a bit of a shift in the focus of what academics are writing about. Now we go to the 2000s. The random walk is still there. Interest rates are always up there as being a covariable with the exchange rate. But you can see we're dealing with volatility, speculative attack, nominal rigidities. We've got some work on interventions. So we're now thinking about how are we managing the world where we both have an exchange rate regime in Europe of fixed exchange rates among those economies, as well as floating exchange rates more broadly in the world. And then finally, we get to the last period, which I would call the, this is the somewhat leading into the crisis and then post-crisis. This is the interest rate era. This becomes really dominant in most articles, the zero bound, financial crises. So you can see, I hope this was interesting to me to see how kind of our thinking about what's important for understanding exchange rates, how that has shifted over time. Now, we were also learning about how the euro was working and whether the euro, how that system was operating. So I've got a figure here that I'm going to use as kind of a framework. Again, I'm going to be highlighting what academics were writing and thinking about the role of the euro. The yellow bars there is a broad-based euro index. This is initially created by Ilzetsky, Reinhardt, and Rogoff. It's meant to capture both financial transactions, real transactions, banking balance sheets. It's a very broad index to pick up the role of the euro in the economy. Now, this is about a third the height of what it would be for the dollar. So I've taken that off the figure. What I'm highlighting here, though, is how it's changed over time, okay? And I've also plotted up there the blue line, and Philip Lane mentioned this, that EU citizen support for the euro based on survey data. So I'm going to divide this into 3 periods. The first part is I'm going to call the kind of euphoria period, and this is where we see rising use of the euro and pretty strong support for the euro in the initial phase. Whoops, I went the wrong way. And to put, quote Richard here, sorry, I hope you don't mind, but people were writing at the time, you know, central banks are looking for ways of diversifying away from the dollar. The dollar may be a more risky asset given high debt levels. And at this phase, you can think of this as the euro potentially punching above its weight, maybe even a greater role than its role in the global economy. This, of course, we know was soon followed by the financial crisis, where, and Philip talked about this too, the many ways that the euro was tested in terms of pressures on banks, high levels of sovereign debt, real fears about what would happen to the euro. And you can see EU confidence, EU citizen confidence in the euro is declining. And, you know, people, this, I'm just quoting one paper. Obviously, this is a huge literature, but people pointing to that the financial crisis was really a test of the euro, and you can see that this actually put downward pressure on the euro as a global currency. And then we get the final phase, which again, as Philip noted, EU sentiment support for the euro is high, and yet you can see the usage of the euro as a global currency, at least as measured by this index, is about as low as it was at the inception of the euro. And indeed, to quote Ilzutsky and co-authors, the euro has yet to expand its role as an international currency. In their view, it plays no larger role at the end of this period than the Deutschmark and the French franc did at the euro's inception. And indeed, if we kind of, again, to quote POG, who isn't here, but we're now in a dollar world. The simple reality is that the dollar is dominant in real transactions, in financial transactions, in banking, and in policy, as dollar anchoring and dollar reserves are so important. So I'm gonna stop here on that provocative note to say, the question going forward is it more about the euro expanding its credibility to take a role aside the dollar, or is it up to the dollar to potentially have a misstep and lose its central role as a dominant currency? Thank you.
Good afternoon. I'm Shanjin Wei. I want to thank Doug Irwin, Maurice Obstfeld, and Peterson Institute for including me in this extremely interesting conference. You might notice that one of the words in the session title that has been comparatively rarely mentioned so far is China. So I guess the session organizers were expecting me to say something about China, so I'm going to limit my comments to mostly related to Chinese currency. So hopefully the page will advance, or I'm supposed to advance myself. Thank you. So when Fred Bergsten talked about the fact that the US policymakers at the beginning of the floating rate period wanted and maybe expecting to return to the fixed exchange rate, one country, China, probably has taken this mantra a bit more seriously and a bit longer than perhaps what US policymakers wanted. And why they may, they are, one can argue about whether exchange rate, the role of exchange rate in Chinese current account surplus, the Fed's view is not the only feasible view. I'm not going to focus my comments on this. Instead, I'm going to talk about somewhat different kind of headlines in quotation mark. In the last few years, we often run into headlines that says something to the effect. So here are two examples of many one can find. China is quietly trying to dethrone the dollar to Chinese yuan, replace the US dollar as the world's dominant currency. So the only thing that's notable was these two particular examples, but these are very recent. Yeah, we have many years of stories like this, and many people in the room have said this simply doesn't make sense because data clearly do not support and logic, what we teach our students do not support this. So here's a piece of evidence. You can get many data on this, but here's one coming from a project I'm working with a few co-authors using firm-level Korean data, where you look at how Korean exporters price, what kind of currencies they use to price their export. So the dotted green is dollar. So dollar used as a percentage of in percent of all Korean exports to China. So you look at it, Korean exports to China. And red is use of RMB in Korean exports to China, and then the other colors are for other currencies. What it looks like, there's a relative decline in the use of dollar and relative increase in RMB, but you have to pay attention to the scale of the axis. Dollar shares on the left-hand side, the weight is between 85% to 100. So it goes from 97% to, we'll talk about, 88% or so. RMB and all other currencies share on the right axis. And so the RMB shares essentially has gone from essentially 0% in 2006 to something like 6 or 7%. We talk about very small increase in RMB shares. even for a country that's essentially next door to China. So the gain in percentage terms, there's an infinite percent increase in the use of RMB, but the absolute percentage term is very small even today. And that's the best kind of picture you can find. If you were to look at, on the next slide, I look at on the left, I look at the Korean exports to the US. Essentially 99% of Korean exports to the US will be invoiced in dollar. That's on the left-hand side. The right-hand side, the next most used currency will be Korean won, and that's about less than 2%. And that's the second most used currency. RMB share will be 0%. The graph on the right is kind of interesting. That's Korean exports to Japan, where dollar share as an invoicing currency is about 50%. So it's much lower than many other countries, like for reasons that we can imagine. And Japanese share is about 40%. So relative to what I learned from Jeff Franco and others, so the use of yen is a bit higher than I would have conjectured, but this is data. So apparently yen is a lot more used in Korean exports to Japan than I would have guessed. So relative to those, RMB is pretty fast. So I guess the next line is that RMB, not only RMB is nowhere near dethroning dollar in the data in terms of invoicing, used as invoicing currency. It's not even close to many other major currencies. Here I'll give you an example of yen, but you can have a few other examples. They will clearly be ahead of RMB as an international currency in this dimension. Why is that? It's not too surprising. Over the last few years, we learned from literature, including many written by people in this room, that in order for a currency to be a widely used international currency, it requires a few important conditions. Here I list the 4 buckets of them. One is the currency being able to provide low cost and low risk facilitation of trading goods and services. The second is a low cost and low risk way to facilitating cross-border financial transactions. And the third is having some initial advantage being designated as a main currency, and the network effect tends to reinforce the initial advantage. And number 4, having a large and investable domestic financial market is extremely important in supporting the currency's role in outside own country in the global stage. And dollar is strong in all of the 4 categories. In some of the categories, it's slightly less strong than before, but continue to be strong. Euro is strong in some of the categories, not all. Whereas Chinese currency essentially is weak in virtually all, except perhaps in the first bucket, China being the largest trading in goods, although I'm less sure about goods plus service, and might be gaining some strength there, but essentially weak in virtually others. Therefore, it's not particularly puzzling to see that all those media headlines simply are not borne out by the data. So can China do something to substantially raise the international use of the currency? Yes, the exact same kind of logic would say that if most importantly is to open up the country's capital account, remove restrictions to cross-border capital flows, among other reforms. But this perhaps is the single most important reform. China has a domestic bond market and other markets, reasonably sizable, not accessible to international investors. So that's not. So the main thing is perhaps most important binding constraint is lack of a current account, capital account convertibility. Should China do it? Of course, what we learn from our research is not necessary, because while there are benefits associated with your currency being international currency, I learned this from Jeff Franco's writing and writings by others. Benefits will include lower cost of borrowing by your government, lower cost of borrowing by your firms, lower transaction costs for individuals, potential synergy revenue, macro policy flexibility, maybe prestige. Importantly, there are also costs associated with internationalizing your currency. This is especially important for the emerging market that's not currently does not currently have a international currency and wanting to do that. If you don't have a strong ability to detect risk, regulate the risk, you could expose yourself to additional risk from international financial market that a less open capital market might not give you. If you have lots of domestic distortions, potentially premature capital openness could exacerbate the domestic distortions. If this were longer talk, one can also think about flip arguments about using those as a way to engender reforms, but I don't have time to do that. The last thing I want to discuss or observe is various experiments. Okay, thank you. Experiments that perhaps one can call innovations that China is trying. That's kind of interesting. That's broadly along the line of trying to, in substantive way, to increase ability of domestic firms and households to interact with international financial market without formally giving up capital controls. And many of them, while it's often reported as discussed here in the context of what do they do to the dollar's global role. But most of them back in China are discussed about what does it do to domestic reforms. That is I think is a potentially interesting point to keep in mind. For example, getting RMB into IMF SDR basket is not substantively important for US and perhaps for the rest of the world. But the Chinese central bank that promotes this thinks it's extremely important for China because it's one way to lock in the central bank's mind market-oriented reforms, because the kind of requirement IMF asked for SDR for IMB to stay in the basket are the kind of reforms they are consistent with market reform. Many people talk about the importance for central bank communication with the public. Here, there's also central bank's ability to communicate with other, maybe more senior policymakers. That, it's one thing to say, please continue to do interest rate liberalization. It's another thing to say, make sure, and we already got into SDR basket. How embarrassing would it be if we get you get a currency out of the basket? So that's domestic objective-driven move that is often looked upon from outside with an international angle. Various kind of swap agreements with central banks. The Chinese central bank learned from other major central banks, and I was told just learned yesterday that the very first Chinese swap agreement was made at the request of a foreign central bank. So, we have a liquidity shortage. Would you consider doing a bilateral swap agreement with us? And the Chinese banks, basically central banks, say, we are not pushing for this, but let's embrace that possibility. So that's kind of interesting. Cross-border interbank payment systems. So maybe I'll use the remaining 30 seconds to talk about various experiences associated with partial capital account convertibility without removing capital controls. We know even with capital controls, China has very quickly moved to be a leading destination for foreign direct investment. Chinese FDI as a share of GDP, for example, is much higher than that of Japan or Korea and many other countries, perhaps several OECD countries. That's one, that's not less surprising. The QFII, Qualified Foreign Institutional Investors Program, and QD, Qualified Domestic Institutional Investor Programs, are super interesting, and the Stock Connect programs. These are attempts to allow what let me just conclude that the international domestic investors, essentially cross-border capital flows to take place in a way that the authority think they can be more selective vis-a-vis what kind of investors can come in and go out, and whether you have a way to adjust the size of the flow without violating your commitment to obligation to the International Monetary Fund. And it's not when we teach our students, that's not part of what we teach. Kind of think that's not possible, but they figure out a way to do this, and by now have tried 2 decades and seems to work out very well. Stock Connect, the same thing. It's a way to allow Chinese households to invest outside China and international investors to invest in Chinese stock market without actually violating capital controls. If I have time in the Q&A session, I can explain how that works. So let me stop here. Thank you very much. I think our panelists should come up. They have signed seats. And while the panelists get seated, I'll use my privilege as moderator to make 2 comments directed to Katie and to Shangjin, and then I'll open up for questions. And I'll also give you a chance, all of you a chance to talk after my questions in case you want to comment on each other, and then I'll open up for questions. So the comment to Katie, which is also relevant for the question that Jeff Frankel asked in the morning, is that you talked about these periods of intense pressure from private capital flows that push the dollar up and the effects they have. But my comment is that just as a matter of fact, for the US and for most advanced economies, gross private capital inflows and outflows tend to match, and there are occasional imbalances that flare up, but they tend to be short-lived and symmetrical, so that over time, US and most advanced economies don't tend to have a net change in the net stock of private capital flows. What actually happens, and I think this can also contribute to some of the things you said, Katie, but it's also an answer to Jeff's point, which is that, yes, we see fiscal policies as driving some of these capital flows to some extent, but we also see, even more important, is what governments do. Official sector capital flows, it's not a coincidence that they roughly, foreign holdings of reserves and sovereign wealth assets in dollars are roughly equal to the US net negative position, because the private positions for the US roughly balance. And this is true for many advanced economies, and it's true both across country and over time, and it's led to, it's the biggest single explanatory, even stronger than fiscal policy, and it might be worth thinking about in the context that you pointed out. It's not just private flows that lead to these things. To Shangjin, I guess I have a question, which is, no, I'll ask both of you questions, then I'll give all 4 of you a chance to respond, both to me and to each other. And for Shangjin, I have a comment, which is, when you talked about the benefits and costs, a couple costs, or I thought might be missing there, or I'd be curious to your view. One cost would be if the renminbi does truly internationalize, has moves to capital mobility that's trusted by people around the world. Would China not worry that this could lead to prolonged appreciation pressure as global investors, both public and private, diversify into renminbi and have a secular upward pressure on the renminbi? Would China care about that? And of course, the opposite risk, which we saw a bit of in 2014, which was perhaps domestic Chinese investors actually have a net desire to leave China more than foreign private investors in. And you could get both prolonged periods of appreciation or depreciation. And would China worry about that? So let me start. I guess I'll go in the order that you spoke. So Harold, why don't you, if you have anything you want to say to your fellow panelists, why don't you go ahead?
Actually, really nothing much to add, except maybe I thought it was terrific presentations. On Linda's point about what happened in the slump of confidence in the euro between 2010 and 2015. she spoke about high levels of government debt in the Eurozone, and that's right in the sense of debts of particular countries. But if you put the aggregate debt of the Eurozone in comparison to GDP, it's smaller than the debt of the United Kingdom or the United States, and much, much smaller than the debt of Japan. And so, in a sense, that fact that you had a debt crisis about this fundamentally manageable quantity of debt indicated what the problem was, that you need to move to more coordination.
Thank you. Katie.
Hey, thanks very much for the really fascinating comments, Joe, especially coming from you with all this insight into the currency phenomena and trade. So for the risk-off events, there's a wonderful paper by Georgiadis, Muller, and Schulman, who show the contractionary impacts, global contractionary impacts of these risk-off events. And so their paper combined with Caballero's show that, although the event itself might appear short-lived, the impacts do linger on some months, and that can really make a difference for industry, as I was mentioning. And in terms of the decisions of governments during these times, I think you're absolutely right. And the Georgiadis, Muller, and Schumann paper, they do mention how important it is for the Fed to offer their liquidity arrangements. My colleague Emile Marin has actually created a whole, basically a new theory of swaps and swap lines that I think could be useful in thinking more about that. Thanks.
Thank you. Linda?
Yeah, I just want to say I completely agree with Harold's comment. Absolutely right that the overall level of euro area debt wasn't the crisis. It was what got exposed was that the crisis hit countries in very asymmetric ways, and it kind of revealed lack of a fiscal union and a way of helping individual countries accommodate the shock. So totally agree with that comment.
So whenever there are binding capital constraints, generally speaking, a removal of this, you will expect capital will flow. There will be new capital flow one way or the other, depending on the net of the two side incentives. So what do we expect the net flow to go? Joe mentioned about possible incentive going both directions. There are many different ways to look at this. I'm going to say at the moment, I would suspect on balance, the desire for Chinese households and firms to take money out, quantitatively perhaps outweigh the other way at the moment. So here's one of the many possible ways to do. We can look at this. So with some co-authors, we look at the Chinese companies listed abroad. By the way, Chinese entrepreneurs are perhaps the most enthusiastic entrepreneurs in the world to have their companies listed in the US, outside and beyond American entrepreneurs. And if you just look at the raw price multiples, let's say you can use Tobin's Q as one of the ways to gauge price differential. The question is, okay, they choose to list in the US. If they were to choose to list for those firms that are eligible to be listed inside China, what kind of price multiples would they get if they choose to do this? If you simply look at, Chinese company listed abroad versus other companies that are kind of similar listed at home, you find Chinese companies are suffering a valuation loss on the order of 40%. This is too simple calculation. But of course, decision to list abroad is endogenous. If you take that into account, with some econometric tricks, you'll find that the discount is even bigger, about becoming 50%. That is on average, overseas listed companies are positively selected. On average, better companies want to be listed abroad. Their price gap, one way to interpret this is this is like an entrepreneur's willingness to pay, how much they are willing to pay, how much value they are giving up in order to bypass broadly defined constraints in capital market. Capital constraints, one of them, is not the only one, but they are willing to give up a lot to do this. And that suggests to me that if you were to remove capital controls, we'll probably see a lot more capital like this to want to leave the country at the moment.
Well, thank you. That's actually quite a striking observation. Let's turn to our audience. So I think Bob is first, then Richard, and then Sebna. And then I'll move back.
Thank you, Bob Aliber, University of Chicago. Actually, my comment is addressed to you, Joe, and to your use of language. So you rightly spoke about the change in U.S. national indebtedness, international indebtedness, and you used the term the United States borrowed. Who borrowed? The U.S. Treasury? Private parties? When I look at the data, the conclusion I come to is all of the initiatives for cross-country flows have occurred on the part of firms, governments resident in other countries, and that the United States had to adjust. In fact, what was happening was these people, the foreign investors, were acquiring US dollar securities so they could reduce the scope of the adjustment within their own economies. This is another case in which foreign countries are playing the beggar thy neighbor role. Thank you.
Since it's addressed to me, I'll briefly say I think that is an interpretation that I sometimes agree with, but not always. And I think it's a bit. I don't want to get into it right here too much, but I think you have a point. But it's not the only reason why official sectors. I mean, we have a big change, for example, in oil exporters who didn't used to save, and then now they are saving in a big way. And I think that's a very different thing than some of the foreign exchange intervention episodes we've seen in the past. But it definitely, it's a big part of my empirical research where I show that the oil exporters that have surpluses are the ones that have governments that buy foreign currencies, and the oil exporters that don't have surpluses are the ones whose governments don't do that. And it's a very striking correlation. But let me move on to Richard.
Well, but the U.S. Treasury borrows a lot from foreigners. Robert, come on. A third of the U.S. foreign debt is owned by foreigners. That's right. So the Treasury borrows. Who took the initiative? The Treasury, because it had big deficits. It had to finance, so it borrowed.
Yeah, we can answer this question. The data, if there's a simple data test on this, and that is to say, when these inflows happen, do interest rates go up or down? If they go up, it's because we are aggressively borrowing. If they go down, it's because the foreigners are aggressively buying. And in the 2000s, it was surely the latter, and I tend to agree with you, Bob. Richard.
Okay, a disagreement with Harold and two quick comments on Linda. The disagreement, I've got nothing against angst. Feel it occasionally myself, but I don't think that the euro was a response to the angst of Monsieur Balladur. No, it was the prospective elimination of capital controls. The Basel-Nieborg Agreement of September 1987 was followed by a speech by Tommaso Padoa-Schioppa the very next month saying that elimination of capital controls projected for July of 1990, the latest, would have to lead to a unification of the currencies. Otherwise, there would be chaos. And so it proved. The second, two comments on Linda. There's no doubt, looking at the data, that the fall in the standing of the euro as an international currency dates from the global financial crisis. But also, and interestingly, and I think relatedly, if you look at indices of financial integration in Europe, they also they rise continuously up to the global financial crisis, and then they fall. And they still haven't regained the level that they were at in 2007. The second point is, for Linda, is, yeah, the US dollar is dominant everywhere except, as Philip said, if you look at the derivatives data coming from the triennial Basel survey, there euros especially in interest rate derivatives, but for the reasons that Philip indicated. The euro is big, very big.
Anyone care to? I'm not, oh,
Shall I say something on that?
well, yes, please.
Okay, wonderful, thanks. Of course, that's right, that it's the capital market deregulation that is driving this also to a considerable extent. But the capital market deregulation is something that starts really with the Single European Act. So this is 1985, 86. And then the movement in, up to 1992, the liberation of the capital movement. But this is a kind of international process that is taking place. What I wanted to do was to really focus on these moments that give a political initiative. I didn't tell the whole story because, obviously it's a complicated affair, and it may well be that the whole Balladur-Delors initiative wouldn't have gone anywhere had it not been for the fall of the Berlin Wall and the collapse of the Soviet Union. And I have a striking reminiscence of this. Peter Kennan telling me again and again that he asked Tommaso Padoa-Schioppa to write a pamphlet on the Delors report. Padoa-Schioppa said he didn't think it was really worth writing about. It wasn't going to be important. It was going to be filed away in the same way as the Vanna report. But what I really wanted to do in the presentation was to say that these moments, the doubt about the Bretton Woods, that's what produced the Vanna report. The EMS initiative from Schmidt and Giscard is thinking about the dollar, and that there's a strong international component to the Balladur-Genscher initiatives in the late 1980s. And I'm sorry, your second point about financial disintermediation is really very important about Europe. But it's after the financial crisis. But it's worth going into the details again about that, because if you look at the international financial, the banking statistics from BIS, you'll see this big fall, but most of it is driven by the European process. But what exactly is it? It's regulators in Europe treating individual banks as separate companies, whereas previously they'd been treated as groups. So there's a Deutsche Bank group, for instance, but after the global financial crisis, you treat Deutsche Bank AG and Deutsche Bank SPA as separate entities, and so they're boxed off.
We have several people that want to ask questions, and we're running low on time. So let me take two at a time, or three at a time. That will allow the panelists to then choose which they want to respond to. So I have Sebnem, Fred, Linda, and then Ted, and there may be more coming. So let's start with Sebnem, Fred, and Linda, please.
Okay, just very quickly, I would like to shed light on this debate of the private flows and the government. I mean, of course, you guys can debate and put different interpretation on a super endogenous variable of capital flows, but I don't think this is the right way to look at this. We do want to understand the vulnerabilities. So we do have to think about capital inflows and outflows into banking sector, out of the banking sector, into corporate sector, out of the corporate sector, and into sovereign and out of the sovereign sector for every country. This is what we did. I mean, you can net out the whole thing or by sector. This is now an official data set of the BIS and updated quarterly for a very large set of emerging markets and advanced economies. And you would see exactly things as Kate is saying, right? In emerging markets, things go in the opposite direction, something Xiangjing and I work a long time. But again, the point is, US Federal Reserve just has underwritten the entire banking system. So if we want to, at the end, understand the vulnerability and really know about what is going on in the real sector, employment, output, outcomes, we do want to know these sectoral inflows and outflows instead of just what is the net current account at the country level and who is driving that, which is a super endogenous variable, obviously. So it is important from the perspective of vulnerabilities and what are the right regulatory policies for that.
Fred's right next to you, here, right here.
Linda made a very important comment right at the end of her remarks when she said the situation will only change if an alternative to the dollar comes on strong or the U.S. really screws up. Well, it's really important to remember that the U.S. has really screwed up many, many times in the past. And people have said many, many times in the past, that's the end of the dollar. Double-digit inflation for many years, prolonged stagnation, regulatory screw-ups, the large NIIP deficit that Joe talked about, huge and growing budget deficits. You name it, the U.S. has screwed up, yet the dollar has remained dominant. So the question is, unless there's an alternative that comes on from the other side, how much and how must the U.S. screw up in order to lose the dominant position of the dollar?
Linda Goldberg, back there. And now is there anyone else that wants to ask? Anyone else after Ted?
So
After, there were.
So I want to.
Go ahead, Linda.
No. I want to come back to Linda's last sentence and Fred's comment and flip this around just a little bit and ask you all, maybe the next panel, where is the upside for the dollar's role? So what are the things that would increase the dollar's international roles? You're only talking about the things that would reduce the use of dollars.
Okay. Why don't you go ahead, Ted? I don't know if anyone else has a question, so you might as well call them all in.
Mine can be brief. I am very surprised that no one has mentioned U.S. sanction policy in this discussion. So I'm expressing surprise, and you can evaluate whether that has anything to do with what you've been thinking about.
Okay. Well, I think we, one more, okay.
I'll take one more. It was David Orden from Virginia Tech. Katie, this is a question for you, kind of a question an advisor can ask. So you speculated a little bit that maybe a 2015 risk-off event might have led to the collapse of the blue wave or contributed to it, the blue wall. And so my question is, are you satisfied to just make that observation or maybe try to improve the strength of the empirical evidence? Or do you have a policy recommendation? Suppose that turned out to be true, where would that leave you in terms of policy?
Okay, so I think we call the questions closed and we can give our panelists a fair amount of time. We can go over 5 minutes. So why don't you, let's go in reverse order. Feel free, whoever wants to jump in, but I'll give Shengjin the first shot if he wants to say anything to the 4 or 5 questions we just had. Are your mic on?
On my last slide, one of the experiments on my list is a Chinese cross-border payment system, which I didn't have time to go into. So often it's speculated it's a way to try, in the event of a future sanction, could the Chinese national sanction continue to work? I'm not sure this was originally motivated by this. We have some more authoritative people who can tell us tomorrow. But it could. We have had perhaps 15 years or maybe longer, 2 decades or so of two very smart central bank governors in Beijing who's willing to innovate, try out various kind of experiments. This is one of the things they try. They don't see obvious downside. They were not thinking about sanctions perhaps at the time, but they say, why not? Whatever US is doing, let's try to see if we can make. So there may be a sanction connection there. Can I actually mention one more thing? It's not quite one of the questions, any of the questions asked.
Well, this is your chance, but be brief.
Of course, in the last 50 years, what's going on in the global economy is not just floating exchange. Many other things are happening, and some can interact with exchange rate regime in very interesting ways. So here I want to point out that deepening the global supply chain is one very important development. The share of intermediate goods trade as a share of total trade has risen substantially over the last 50 years. Implication? Many, but one implication I want to mention, since I see many people who are top policy advisors in the room, is that we know IMF, BIS, Federal Reserve Board, and many central banks routinely compute something called effective exchange rate, which is essentially some weighted average of bilateral exchange rates. One of the very interesting implications of a deepening supply chain is that those measures have becoming are becoming increasingly less relevant or less correctly, the mistake associated with those are increasingly getting bigger. Let me give you an example to illustrate this. Suppose in the world we have 3 countries, Japan producing and exporting intermediate goods sent to China, China combine that with domestic value added and produce final goods and send to all other countries. Suppose that's the only trade you see in the world. In that world, what is the correct way to compute effective exchange rate for China? In the standard world, where we imagine trade is mostly final goods, whenever Japanese yen depreciates, Chinese competitiveness declines. So the effective exchange rate will decline to reflect that. In the world I just described, the correct way you want to assign to Japanese yen RMB exchange rate is negative. That is, the more yen depreciates, the stronger is the competitiveness of China as an exporting nation, because Japan is a supplier of intermediate goods. And our standard way of computing that does not reflect that, therefore it's wrong. So, and the error increases over time as GVC deepens. And they are actually, so I spent a bit of time looking into how to do this correctly, but I just want to point out that exchange rate development and other development of the world economy interacts, and we might have to rethink many things. So this is one of the things that we want to think, we might want to rethink.
Thank you. Lynn?
So, Ted, I'm glad you brought up the question of sanctions policy. I mean, I think it's central to this, right? A global hegemon has power, and if it uses the power for global good, and if people agree that using sanctions in that way is for the global good, then fine. But if the power is used for other purposes, there's a trade-off. How far one can go one way or the other, that's where the questions are and the tension are. The other thing is you only beat a currency with a better currency. So if there aren't alternatives, that trade-off could swing a long time to remain that the dollar can, and dollar policy can be what it will.
Katie?
So thanks, David, for mentioning this issue of empirical evidence on political fallout. So we have Price Fishback, who looked at local effects of the Great Depression. We have Bion and Sufi, who looked at localized effects of the global financial crisis, especially as it originated in the United States. So what we haven't really thought about is these localized effects of global risk events within the United States, or at least we haven't thought about those as much. And so that's exactly what I hope to do, was to provoke interest in empirical work on this issue. In terms of, I think it's useful to look at the fact that it may have had potential political impact, because political instability right now, as I mentioned, may be one of the biggest threats to the special position of the dollar. So Mary Lovely and I just wrote an op-ed, it's in CNN.com, about the potential for default to erode the power of the U.S. to conduct sanctions, as Ted mentioned. I think that the political polarization that we have right now is a big threat to the dollar's special position. And if you've looked at the tick data lately, external holdings of U.S. Treasuries are not increasing. So anyway.
Harold.
So, thanks. So, Fred Braxton's question, I think absolutely on the mark, because indeed, there are lots of instances of U.S. mismanagement, and so you might count the latest story about the potential default. I mean, this is something that is has been there in the past as well, but it seems to go on and on and on. But obviously not forever. I remember in terms of prescient essays, there was a beautiful essay that was given as a talk originally by Robert Mundell in 1969 or 1970 in Geneva, where he made 3 predictions. One is that the Soviet Union would collapse. 2 is that the Europeans would get a single currency. And the 3rd is that the dollar would continue as the preeminent currency as long as he lived. So unfortunately, he's not alive anymore. So I mean, these things don't last forever, and it could be that exactly. I mean, I think that's the the point of Ted's excellent point that the sanctions regime pushes this because, it was a point that was made a long time ago by Juan Cerati in this beautiful book on Treasury's War, where he says, the sanctions regime works very well against a very small isolated country like North Korea. It's more difficult if you apply it to Iran. If you apply it to a globally connected country like Russia, it's really difficult, and people are going to look for alternatives. But there, it's actually worth stressing that this is not a problem about the US dollar, because this would equally apply to the euro. So it's a question about the payments mechanisms that the dollar and the euro have, and Russia is not going to want to do things in euro any more than it is going to want to do things in dollars anymore. And that brings me to say, just at the end of this session, that there is really something odd that we haven't talked about yet, and maybe because of the recent crypto winter, there's too much skepticism about it. But clearly the alternative to this is also the world of private currencies. And so if you want to get transactions done that don't depend on the US clearance system and don't depend on SWIFT and don't depend on the European banks, private digital currencies look like an alternative for doing that. And that, I think, is also one of the instances that is going to spur the official world to think about how it can better respond to the competition of digital currencies. So it's maybe there should be an additional section on, is the dollar going to be replaced by private currencies?
Well, thank you, everyone. I guess I will add my 2 cents in on the sanctions issue. I've always thought that it seemed to me that sanctions work because of asymmetry in economic size, the size of the US market and the global reach of US firms, not the dollar's role, because you can get away without using the dollar at some cost, and it's not that high. But it's really the size, the asymmetry of economic size that matters. And as you say, Harold, I totally agree with what you just said. The less asymmetric you are when you apply sanctions, the less they're going to work, I think. But anyway, thanks. Let's give all our panelists a round of applause. And we have a 25-minute coffee break.
It's not short term. I mean, the
What's
standards,
What's not short term?
what the private stuff netting out. It's not netting out.
In the U.S. aggregate data, it is.
No, but not in the sectoral data. And the short term is 3 years. I mean, of course, when you look at the 10 years,
I'm looking at
course.
total for the whole U.S. economy.
Yeah.
The net is almost zero after decades.
After decades, yes. But the point is, the typical inflow-outflow cycle is 3 years. And that's but that's exactly how it relates to Jeff's stuff. And monetary policy, fiscal policy, and regulatory policy are part of it.
I agree with that.
Structural policy should look at the long-run current account. I fully agree. And then think about, okay, who is saving, who is investment, is right. I fully agree. But the short term is not a quarter. Short term, it can be up to 3 years.
I didn't mean that. Yeah, I meant business cycle, sort of.
But that's important. Short term is now medium term. Business cycle is quarter, right? This entire world is now going under because of 2 years of inflation, and the entire system is these 3 policies, monetary, fiscal, and regulatory, is about the 3 years stuff. So, and during that, nothing nets out. Over a 10-year, yes, of course, but not over a 3 year. And I think it's important we understand the short term being a little bit like short to medium term.
Yeah, but it's still interesting. Like, and Turkey may be different because I think the emerging markets have
Advanced
some.
economies too. By the way, they are not the ones who make this point first. The first, Jean-Maria's and Carmen's worked with this. So
Even for advanced economies.
For everybody, because this disconnect between the business cycle you think quarters, right?
Yeah.
Like, which means like things like employment, inflation, blah, blah. But the capital flow cycle is 3 years. So when you connect the capital flow stuff with business cycle, which is what all we are trying to do, this real sector, financial sector connection of capital flow to real sector, is you are trying to connect something, generally the business cycle people care about, like quarter level, to something in and out 3 years, right?
But here's the
All right, very good. Please come back in and be seated so we can start the next session. Oh. The clock is 2 minutes.
Yeah, yeah. You have to give us.
Beautiful day outside. All right, it's a beautiful day outside, but we welcome you to come back for one final session here. Give you a minute to get seated. Can you hear me? Do I need to do this? Yeah, it should work. Let's come in and start the session. Yeah. We'll give people one more minute. Brilliant. All right, we're going to go ahead and get started today. We invite you to take your seats. I'm Nathan Sheets, the chief economist at Citigroup, previously at the Fed. I'm talking pretty loud, even though not as loud as you can, Ted. Yeah, let's come in and be seated. So our session this afternoon is on dollar dominance in the international monetary system. I think it really carries forward many of the really compelling and interesting themes that we heard in the previous session. And I can't help myself but to get things started, I'd like to put 3 questions on the table that I think maybe help organize some of this a little bit. The first question is, what are the deeper roots of the dollar's continued and durable global role, or if you will, global dominance? My sense is 3 key factors at work. First, the key role of U.S. financial markets. A second, which is broadly related to that, is the familiarity of the dollar. And I do think that there are distinct advantages, if you will, kind of from being a first mover and being the incumbent. And then third, in recent years, I think the Fed has just nailed its role as the international lender of last resort. And specifically through the swap lines, which have been established and provided massive dollar liquidity, the Fed has recognized its responsibilities in this space. And we've seen that, again, even in this episode where they bring out the swap lines. You know, for what it's worth, my sense is all 3 of these, finance, familiarity, and the Fed's role as an international lender of last resort, look pretty robust. And they're likely to continue to favor the dollar for the foreseeable future. But let me say that with a question mark. You know, what is that the case? Then the second set of questions has been touched on in a number of the different sessions today. And, you know, at risk of contradicting my first question, My distinct impression, especially in the years since the GFC, is that the markets are not really deeply in love with the dollar. Rather, market participants have had concerns or reservations about other major currencies. For example, the euro area is in the process of manifesting its durability to a whole range of shocks and the durability of its institutions. China has claimed a central role in global trade, but its financial development, which is a critical component to be a reserve currency, is still work in progress. Thus, the second question is, to what extent what we're seeing really is dollar dominance versus, for lack of a better word, the indominance of other currencies. And then the third question is, going forward, how's this thing likely to play out? What's going to shape the dollar's role? And will dollar dominance survive? And there, I think the question is, what should we be looking at? There's a whole range of various issues that are out there that are grabbing the headlines: geopolitical tensions, fragmentation, deglobalization, the increasing use of sanctions as a tool of foreign policy, which was highlighted in the previous session, and of course, the rise of CBDCs and digital currencies was also highlighted. Are these the key issues we should be thinking about in talking about the dollar's role over the next decade? Or alternatively, is the story more about kind of the same issues we've been talking about over the last 10 or 20 years, which is the scope for the euro and the renminbi to assume an increased global footprint? Still another angle on this is kind of what Fred alluded to in the previous session. What about the quality of U.S. policies? And how does that factor in? And is there some degree of policy error, so to speak, that might convince the rest of the world that the dollar is not the place to be, and generate kind of push factors out of the dollar rather than pull factors from developments in the rest of the world? So with those three questions, the roots of the dollar's dominance, is it really dominance or indominance of other currencies, and the prospects going forward, let's go ahead and jump into our session. Now, I'm thrilled to have an internationally diverse set of colleagues on the panel, and all of these folks have some degree of policy experience, and so it'll be kind of a mix of a policy panel and an academic panel. So I first pleased to introduce Shebnem Kalemni-Ashkan, the endowed professor of economics at the University of Maryland, Philippe Martin, the dean of the School of Public Affairs and professor of economics at Sciences Po in Paris, Eswar Prasad, senior professor of trade policy at Cornell University, and Masazumi Wakatabe, professor of economics at Waseda University, and very recently of the BOJ. So with that, welcome to our panelists, and Shebnem will give you the opportunity to kick things off, and then we'll proceed in the order of introduction, and each one of the panelists has 10 minutes, and Fred's sitting here in the front, and he said he's going to be the timekeeper.
That's your job.
All right, let me start by saying, giving my appreciation to Maurice, Doug, and Adam for inviting me to this amazing event. I'm younger than the floating. I'm going to be 49 this year, and it's an honor for me to be in this distinguished crowd that my research builds on the shoulders of these giants. So I am truly humbled and honored to be here and presenting you today on US and dollar dominance in the international monetary system. So, okay, I'm going to start basically exactly what Ted said at the end of last section. On the surface, the popular view has been around for some time, but kind of gained this increased awareness because of the weaponization of the US dollar within the context of the Russia-Ukraine war. We started talking about pros and cons of this hegemony. Right now, the consensus is there is no alternative hegemonic currency, and as Nathan put, we need to be understanding that. We need to understand why dollar stays in this role and why the others cannot do it. But if I just summarize the current consensus on this is because the contenders, a very strong second euro and the renminbi, they are not going to be as important as dollar in three things. In the world trade, this is the payments role. Dollar accounts more than 50%. World finance, this is the investment role. Again, dollar is responsible more than 50%. And also world reserves, this is the store of value, or the way Nathan put it, Federal Reserve being the international lender of last resort role. So I'm going to focus on this finance aspect, so which combines the second and third, the use of dollar as an investment currency and also as a reserve currency. This doesn't mean the trade side is not important. Issues that we have been talking about, dollar pricing, pass-through to inflation, all that. Linda's work, Gita's work, Catherine and Kristen's work. I'm just going to focus on these finance and reserve aspect, especially because my research has been on that, and also this is what we have been living through pretty much last year and a half and very acutely in the last 10 days. All right, so there's a large and complex academic literature if we focus narrowly on that financial side. And starting with, of course, Calvo-Reinhardt, Fear of Floating paper, we have this observation that especially emerging markets really hurt from these things, right? Emerging markets going back to 1990s suffers when their currency depreciated against the dollar. Jose, talk about that a little bit. Then there's work by Bruno Shin that tells us that it is really about the dollar and not the other exchange rate. So the fact that peso depreciating against others or Turkish lira depreciating against others is not as important as the depreciation vis-a-vis the dollar, especially when we compare that bilateral exchange rate to trade-weighted exchange rates, when we want to understand those countries' outcomes in Mexico, Turkey, and so forth. The global dollar cycle, defined as dollar appreciation vis-a-vis G7, G10 currencies, advanced country currencies, also correlates with global financial conditions, global risk sentiments, and can predict really bad outcomes in emerging markets. This is Maurice's new work, the recent Brookings papers. Of course, global financial cycle runs on dollar, risk asset prices, and US monetary policy, first shown influential work of Helen in Jackson Hole paper, and then, of course, now there's a whole literature on this. Now, where I come in here is really try to understand this difference between Mexico and Canada. Mexico and Canada is in the same trade region with the United States, but when dollar appreciates and US Fed change monetary policy, Mexico is affected worse than Canada. Why that is the case? And my work says one answer to that is this risk-sensitive nature of the emerging market capital flows, and that would be actually telling you that floating exchange rate is a good thing. If the risk-sensitive capital flows is about risk premium shock, floating exchange rate is going to help you a lot if you are Mexico in terms of absorbing that shock. Okay, I'm going to come to that at the end of my presentation. Now, given this literature and given the two key facts in the literature, which is US is the world banker, world's top provider of safe asset. I believe this goes back to the World Banker paper of Pierre-Olivier Henelen. And also, when each time dollar moves or US monetary policy moves, I'm not talking about very expected and little moves here. I'm talking about unexpected or significant moves, as we have been witnessing the last 10 days, EM risk pricing is going to suffer. Now, this is originally shown in a paper by Longstaff, Pendleton, and Singleton, and again, shown broadly in my Jackson Hole paper. This is different than your standard push factor, which of course goes back to work by Calvo, Liederman, and Reinhardt, argues that when interest rates is low in US, capital flows to other countries. This is an effect on top of that. This is really about pricing of risk, which is why financial market volatility and US Federal Reserve is going to be at the center of the story. Okay. I would like to give you a broad picture. So this is, what happens when U.S. Federal Reserve hikes the interest rate as the environment we are currently in. Now, this is a complicated picture. It meant to be a complicated picture because it is designed for graduate students. Graduate students look at this picture and start all sorts of interesting research, understanding international spillovers, international transmission of dollar and U.S. monetary policy is an extremely complex issue. There's going to be a trade side to the story, which most of the literature is going to be focusing about, which is very important, of course, and there's going to be a financial side, which is the recent literature is focusing, especially after Helen's work, and I'm going to be focusing on that, my own work focus on that. But on the trade side, of course, we already heard this morning, this is very complicated. Even this arrow, this is the pass-through arrow, we heard that exchange rate pass-through is going to be dependent on time, monetary policy credibility, and all sorts of things. There is a monetary policy response from the other country. Here I'm going to say, okay, let's forget the fixed exchange regime countries and think about floating countries like Mexico's, like Brazil, like Chile's, like Argentina's, Indonesia's of the world. They are going to respond. And then there's the whole expenditure switching here, which doesn't work. And we have a whole set of literature why it doesn't work. There's a dollar debt issue here, which is going to affect investment. And you are going to have contractional outcomes in emerging markets. Then, of course, there can be a response directly to this strong dollar to defend their currency, which can give you even worse outcomes if you are an emerging market and if you are only responding, only hiking your rates to defend your currency, and if the shock goes through financial channel in terms of higher cost of capital, higher risk premium, and which is going to work through balance sheet friction, asset riskiness, then actually you are going to crash your economy. You are going to have a much, much worse outcome if you try to defend your currency using your monetary policy as a response to a U.S. monetary policy. And SVB is pretty much this and this. SVB and we are here at the beginning. If we see next week the global transmission, we have to really see this in terms of all this picture, and we are literally at these arrows. And in terms of the literature is always going to focus on one arrow at a time. Models can handle only one arrow at a time, okay? But the central banking, exchange rate policy has to be done taking this picture into account. So that's why it's extremely difficult to think about these policies and think about monetary policy, financial stability, and the dollar's role in this world of very complex transmission. Okay, so why this financial channel and the risk premium side is important? So this is emerging market spreads, short-term government bond spreads. So every emerging market government bond vis-a-vis US Treasury, short-term, less than a year or less than 2 years. What happens to those when Federal Reserve hikes? And here I try to get at the exogenous component, surprise hike, because that's how the domestic monetary policy does it. That's why using a surprise increase in the US policy rate in the entire period 1996-2018, you see a very stark difference between emerging markets, Mexico, and advanced economies, Canada. Okay? Emerging market government bonds at a much higher rate because risk premium goes up as opposed to advanced economies when it goes down. Okay? So this is going to tell us that we really have to understand this mechanism before thinking about policies, not just the exchange rate policy, but other policies, how emerging markets can deal with these issues. Now, this is from my new paper with Pierre Delot and Gita Gopinath, where we try to get back to these general findings in the literature. When dollar appreciates, you can link it to Federal Reserve hiking or not. When dollar appreciate and emerging market currency depreciate, emerging markets contract, right? This has been shown in several papers. As you see here, we do this with both with appreciation and also with tighter monetary policy. But the GDP growth crashes in Mexico. Inflation goes up. This is the pass-through because of depreciation of the currency, but then goes down because the economy slows down in Mexico. Capital flows out. This is your sudden stop. This is already known in the literature. What we are showing new is the short-term borrowing and lending rates for Mexican households, for Mexican firms goes up in spite of the fact that monetary policy is losing as a response to Federal Reserve hiking. Okay, so that tells you already there's some weak anchoring, some ineffective monetary policy, as Kristen was also talking today. Now, moving forward, my last slide, then I'm going to summarize. If the risk premium shocks are important, then we really have to think about uncertainty. So now I'm going to give you a counterfactual run on a model. So this is a structural model, my work with Özge Akıncı and Albert Coeralto of New York Fed and board. So we say, okay, let's write down a two-country model, two-country spillover model. One is US, one is the other country, and we differentiate the other country also if we are talking about Mexico or if we are talking about Canada. Put the trade channel, your standard transmission, put the financial channel fully, allowing this risk premium shock. So there's going to be this uncertainty shock that is going to work through US financial market volatility. Just what happened in this past week. So we are trying to mimic what happened in the past week. And what happens out of the model when, not just, Fed hiking, but there is this uncertainty, whatever is happening with the Fed, there is this uncertainty in the financial markets. Financial markets cannot understand what Fed is doing. They understand they want to go to 2%, but the path is certain, terminal rate is so uncertain, everything is uncertain, and financial markets don't know how to price this risk, okay? In that world, what happens is, first, credit tightening. Both bond and loan spreads tighten in US and in the foreign country. Dollar appreciates, of course, the rest of the world, the other country depreciate. Capital flows out of the other country, and the UIP premium, which is going to be the key barometer for this risk premium, is going to increase in the other country and is going to decrease in the United States. and it's going to increase more in Mexico and not in Canada, as I was showing you in the other figure. The summary is two points. One point, if this is the world we are living in. If in a world where financial channel of both US dollar appreciation transmission and US monetary policy transmission dominates, the international transmission of these things dominated by the financial channel, in that world, uncertainty shocks and volatility becomes very important. The financial market volatility in the United States, because those are the global investors, those are the investors pricing in not just the United States, but also outside. And then, if these things are first order in terms of the things we care about, we don't care about the banks because we care about the banks. We care about the banks because they are the providers of the credit to real sector. We care about employment and output. That's why we care, the financial market volatility. In that world, actually, flexible exchange rate is going to help you, because flexible exchange rate is going to absorb this risk premium shock. Completely different function than the standard expenditure switching and shifting the demand function. Exchange rate is going to help you to absorb this risk premium shock. So the volatility in the financial market that is feeding into your real sector have to tighten the credit, you have to fire workers. That is not going to happen because exchange rate is going to absorb that. And I believe that is to somehow the original intention of the going to floating and the Bretton Woods. Thank you very much.
Okay, thank you very much for the invitation. As I'm coming from Paris, I'll start with two French obsessions. One which is a long-standing one, and we've already discussed this, which is the exorbitant privilege. And the second one, which is more recent, is the one on the Inflation Reduction Act. I think it was mentioned this morning. It's also a French obsession these days. And the relation was made by a recent discussion I had with a senior policymaker in France, who basically was explaining, and I'm not saying it's valid, but who was basically explaining that the choice of subsidies in the US for climate policies against taxes in the EU was made because of basically of a soft budget constraint in the US linked to the exorbitant privilege. Again, I'm not saying it's valid, but the link was there. It at least suggests that maybe some of our session topics have some repercussions much beyond the trade and the financial side, and potentially on also on the climate policies. So my main comments are going to be based on some conjectures, and they may be again quite strong, but that the economic world order, which in the past 50 years have been based on rules, on trade integration, financial integration, tacit acceptance of US domination, is certainly under attack in an unprecedented manner. And that we are going, and in some sense it's going towards your questions, what's next? What's next is that there's certainly a unique set of economic and political factors that can lead to a weakening of the dollar dominance. But I would make the argument that the same economic and political forces that may reduce the role of the dollar as a global dominant currency means that this is going to limit the extent of the weakening and certainly prevent the elimination of global dollar dominance. And I would take again, I think that, I think it was Philip who mentioned the fact that indeed we may go towards more regionally dominant currencies, but still no elimination of the dollar as a global dominant currency. I think we have a relatively good understanding from at least a theoretical point of view, and again, this is we have not coordinated, but this is a bit of an answer to Nathan again, on the reasons why we have the dollar dominance, and there are many theoretical papers. Of course, Hélène has contributed to this. There are some recent papers also on the theory side to understand these the self-reinforcing mechanisms and the dollar dominance. And there are basically two tracks. One is on finance and one is on trade. On finance, it's linked to this positive feedback cycle where more liquidity and more safety of dollar assets means that there's more incentive to issue in dollars, and that again is going to increase liquidity, and that's part of the positive feedback cycle. In some sense, in trade, it's a bit different mechanism, but it's also one where, and in particular because of the global value chains and all these steps where it's important to have invoicing in a single currency, that's also going in the same direction. So all this we know is generating a very stable equilibrium, and that's one reason I think it's going to be very difficult to change this equilibrium. In some sense, I think somebody said, how much does the US need to, I can't remember the word, but basically to mess up to change the equilibrium, and I think it will have to be a big negative shock to do this. And again, what is important is relative. It's not the absolute shock. You know, the US can mess up, but if the rest of the world also messes up in the same direction, I don't think that would make a big difference. And by the way, of course, these trade and financial mechanisms are interrelated, in particular because you need financial collateral for international trade. So what is next? So it's clear that, and I think it was already mentioned, there's no obvious substitute to the dollar. And the fact that we have two competitors with very different, at the moment at least, market shares, two different competitors, the renminbi and the euro, also facilitates, I think, the stable equilibrium where the dollar remains a dominant currency. So let me first talk about the Chinese renminbi and geopolitical tensions, which I think is an important dimension in the debate. So I would, but maybe under I mean, Chen Jiwei might want to comment on this, but I would say that eventually China will abandon the fixed exchange rate. We can think of the Mundell trilemma. At some point, this will happen. I don't know when, but certainly this will happen. And so that means that some of the diversification gains that we can have by investing or denominating in renminbi will be higher because basically this would break the isomorphism between the dollar and the renminbi. Somebody talked about the financial sanctions. Yes, it's true, certainly in some sense for some people in the world, the dollar is less safe. But again, everything's relative. If we compare to the Chinese rule of law, it doesn't look very good either. On trade, the China shock on trade is behind us, not in front of us. And in any way, and this is the next point, that we have unprecedented geopolitical tensions. And I think it was also mentioned this morning, with a clear, and in some sense the first time in the last 50 years, with a clear US objective to decouple, and the political pressure to align trade and financial flows with political affinities is going to be extremely strong. And we did not have that in the last 50 years. So I think this is a very strong change. Again, it's maybe only a potential conjecture, but I think it's an important conjecture to take into account, in some sense, what if indeed this comes to be realized. So I think we're going to go through, we already in some sense seeing some of this, of regionalization of global supply chains. We talked about friendshoring, which may potentially link to friend currency. So in some sense, that's linked to my guess that we could have some regionalization of currencies, and clearly here the renminbi would be an obvious candidate. So, and more generally, I think that the economic mechanisms that I mentioned at the beginning are very much linked to the fact that we had a positive sum game view of international economic relations. That, you know, more gross flows, both in finance and in trade, are important. And remember, it's gross flows that are going to be at the base of these self-fulfilling mechanisms that are behind dollar dominance. We're clearly not going in that direction anymore. I mean, if you hear both the Americans and the Chinese, we are in a situation where it's a zero-sum game. It's viewed as a zero-sum game. As economists, we certainly don't agree with this, but this is a new world from that point of view. A word on military conflicts. This is related to some research I've done on military conflicts. We know that military conflicts, and in some sense, whatever, I mean, how large, how important, how violent they are, do reduce trade flows persistently, and that make more military conflicts even more likely. So we are entering in a new geopolitical tension world, and that clearly is going to reduce some of the mechanisms which were at the origin of the dollar global dominance. But again, my view is that this would generate potentially regionally dominant currencies, but that's not overthrowing of the dollar as a global currency. Euro, I'll be a bit shorter, and I think in some sense, Philippe already mentioned this. So the size factor is important. It is not in favor of the euro. If anything, the size of the euro GDP, world trade, is going to be reduced in the next 20 years. The euro crisis has put a doubt on the safety of euro assets. We can have different views on this, and in a sense, maybe we can say also that there was a test, and we, let's say, have passed it in Europe. But sadly, it's not. It was clearly a negative on, and we've seen this in the data on the market share of the euro. If we go in the direction of thinking that of these geopolitical tensions, the weaponization of international economic relations is not also going to be in favor of the euro. Europe, I think, is going to align with the US, because all we hear from American policymakers is you're with us or you're against us. And I'm pretty sure that Europe will go with the US. So that means no strategic autonomy vis-à-vis the US, or no space for a third partner, in particular in the financial side. My last point is that economics and politics, deglobalization, fragmentation will reduce the mechanisms behind dollar dominance in trade and finance, but because it might also reduce the growth flows, it might also reduce the possibility of an abrupt change in equilibrium, and therefore the elimination of the dollar as a global currency will have more regional dominant currencies, but not dominant at the global level. There was a last slide, but basically I won't do it. Does this matter? Yes, it will matter in terms of efficiency losses. As economists, we do think that potentially having a dominant currency has some positive externalities in terms of lower transaction costs. And the exorbitant privilege literature points to potentially sizable gains. But remember, the exorbitant privilege tells us it's the interaction between the difference in returns between assets and liabilities and the size of the gross flows. So if we indeed go into the direction of lower gross flows, this should also reduce the gains from dollar dominance for the US. So in a sense, I'm going in the same direction as this morning, Adam, I think, was saying, does this really all matter? Thank you.
Change is coming, not necessarily in the way you might think, and perhaps not necessarily for the reasons you might think. But first, let's set the stage. Everybody despises the dollar outside the US. The French do it more stylishly than the others, but the emerging market economies feel beset by what the dollar's dominance means for them. Many people in this room, Elaine, Kristin, Hyun, Shebnem, have talked about the dollar financial cycle, the dollar cycle, which impacts very negatively in terms of spillovers on emerging market economies. We've heard talk of sanctions, which means that countries that are not seen as geopolitically allied with the US at inconvenient times lose access to the international payment mechanism. But even worse, what countries put away as their rainy day funds turn out not to be invulnerable to US machinations. the US made it very difficult for Russia to get access to many of its reserves. So even there, where we thought that there were certain rules of the game that the US would play by, it turns out those rules can be violated. So things should change. In fact, there are many reasons why things should change. Fred laid out a few reasons why the US has been working very hard to shoot itself in the foot. I'll add something to the economic reasons that Fred so eloquently put out. When one thinks about reserve currencies, until the renminbi came on the stage, the notion of a reserve currency and a safe haven currency were essentially congruent. China's appearance on the stage and the renminbi's rise has led us to make this distinction. I think what is behind the safe haven currency, one that inspires the trust of international investors, especially at times of turmoil, is one that is not only backed up by a strong economy, very deep and liquid financial markets, but also an institutional framework that includes an independent central bank, the rule of law, the way we think about it, where even the government is subservient to the rule of law, and an institutionalized system of checks and balances. And every one of these elements of the institutional framework has certainly suffered some fairly serious blows in the last few years. So there should be change. And there are other reasons as well. You have emerging market countries like China beginning to play much bigger roles in the global economy and in the global trading and financial systems. And in addition, you have the emergence of digital currencies, both private and official. So what does all of this mean for the dollar's role in international finance? I think there are some changes that are coming. Linda Goldberg has told us about vehicle currencies. If you think about how emerging market countries trade with each other, they essentially have to go through a dollar-based financial system because these countries don't have deep, well-developed financial markets. They don't have the ability to transact directly with each other in their own currencies. That is changing. Shangjin referred to the cross-border interbank payment system that China has set up. It's not quite there yet, but the day is not far away when the cross-border interbank payment system could directly communicate with the payment systems of Russia, for that matter, India, when those payments are mature enough. You have much more developed financial markets in the emerging market economies, which allows for more hedging opportunities, which makes it a lot easier for developing countries, traders, importers and exporters, and financial investors to hedge their risk. So change is coming on that front, and digital technologies, I think, are paving the way for this by providing some important catalytic elements. Right now, as we know, international payments are fraught with inefficiencies. They are very slow, cumbersome, expensive, difficult to track in real time. And while digital currencies, especially private digital currencies, might not be the answer, they have shown us how much more efficiently things could be done. We now have central banks using wholesale CBDC projects in order to try to improve cross-border payment mechanisms. So I think the day is not that far away when the need for the dollar, but also the euro and other major currencies as vehicle currencies is going to decline. This is going to mean much less reliance on a dollar-based financial system, but there are some twists to the story. But before we go there, one can think about what role the CIPS might play, not just in avoiding the dollar-based financial system, but also in avoiding the SWIFT-based messaging system, because it turns out that CIPS also has messaging capabilities that are consistent with international standards. If you think about the business model of SWIFT, essentially getting around technological incompatibilities, language incompatibilities, this is ideally subject to technological disruption, and that disruption is coming. So the day is not too far away when China can manage payments with India and perhaps with Russia without either touching SWIFT or without using the dollar or, for that matter, the euro. Now, digital currencies could play a role in all of this. We've seen that stable coins, fiat currency-backed stable coins, have started to play something of a role in payments, and especially in payments on decentralized blockchains. Now, it is true the crypto winter is just behind us, and maybe blockchain will come back to become important or not, but I think there is something that is brewing in that corner of finance. Stable coins, of course, have no intrinsic value of their own. They get their value precisely by being backed up by stores of existing fiat currencies. Now, stable coins can be used for domestic payments as well as international payments. And here I think there is an interesting analog in terms of domestic as well as international payment systems. If you think about what stable coins are, they're not creating intrinsic sources of value. They are ways of using existing fiat currencies more effectively. One can think about digital payments through stable coins and so on, essentially giving us more efficient ways to use fiat currencies and thereby transplant them in one particular function, which is as mediums of exchange. So one could well see a bifurcation of these roles of money at the domestic level, where we have private and official currencies coexisting as mediums of exchange, while as stores of value, fiat currencies still remain dominant. I think we will see an interesting analog at the international level. First, on the issue of stable coins, there are dollar-backed stable coins and there are non-dollar-backed stable coins. Guess which one of these is getting traction? Circle has issued a euro stable coin, which is not getting very much traction. So even in this world where I laid out that the dollar might play a smaller role as a vehicle currency, you can very well see the dollar indirectly actually getting even more prominence because dollar-backed stable coins or dollar-backed digital currencies of other sorts start getting much more traction in international payments because the fundamental source of value is still coming from a currency that everybody trusts. Now, in international finance, I think there is a compelling case to be made. And again, people in this room have made the case, and I think Linda Teeser's work touches on some of this, that there is a complementarity if you think about the relationship between a payment currency and a reserve currency. But here too, one can think about these two functions being separated. You could think about the dollar becoming even more dominant as a reserve currency simply because you have the alternatives, as has been pointed out by many speakers, becoming much less prevalent, dominant. Now, what we might end up is a world where the dollar does in fact have an erosion in its dominance. And this might be for very good reasons. As I pointed out, emerging market countries are beginning to develop their financial system. Even if China does not improve its institutional framework, it is likely that reserve managers around the world will move into renminbi-denominated assets purely for diversification purposes, if nothing else. And in fact, I think there is very important work by Barry Eichengreen making the point that the decline in the dollar share, the marginal decline that we've seen in its share of global reserves in the last few years, is not accounted for by the major reserve currencies such as the euro, the pound sterling, or the Japanese yen. If anything, their shares have fallen, but the smaller reserve currencies, the Australian dollar, the Canadian dollar, have started gaining slightly more prominence, cumulatively giving them a slightly bigger role. So one could see much more fragmentation where the second-tier currencies, and at the risk of receiving brickbats, I'm going to put the euro in that bucket for now, where these currencies compete with each other for what's left of the scraps, while the dollar remains dominant, although with perhaps a little bit of shaving off of its dominance as a payment currency, but also perhaps as a reserve currency. So I think we're coming to a world where essentially we might have much more fragmentation, leaving the dollar in some sense even more prominent in terms of the distance between it and what one might think of as the second, third, and fourth currencies. So we're not necessarily getting away from a world. And in fact, one of the final points is that if we think about the world we are living in, which is fraught with economic and geopolitical turmoil, that is precisely the world in which the demand for safe assets is, if anything, going to be stronger. And I have spoken to many central bankers, emerging market central bankers, who say, we have to move away from the dollar. You ask them the logical question then, to what? They don't have an answer yet. Perhaps the answer will come. Perhaps the answer is to move to better domestic financial systems, flexible exchange rates, better monetary policy frameworks, so we can stop saying, where do we put our reserves, and instead ask, why do we need so many reserves at all? But that day is not at hand, and until that day is at hand, I think the dollar is going to remain pretty damn dominant. Thank you.
Where's my slide? Okay. Where's my slide? Sorry. How can I open my slide? Who is in charge? Yeah. Oh, here. Oh, no. Okay. Okay. I do need my slides, but okay, so I have to improvise now. So my name is Masazumi Wakatabe. I am delighted to be here, and I, of course, would like to thank the conference organizers and all the staff who is making this conference. So I was the deputy governor of the Bank of Japan just about 4 days ago. Depending on the time difference, maybe 5 days. But I am now as a freshly minted ex-policymaker. I am going to give some perspective, both from Japanese and policymaking perspective. But I, as a central banker, I don't deal with the sort of intrigues of dollar-yen diplomacy or anything like that. So I'm going to straight concentrate on relationship between the exchange rate regimes and monetary policy. So let me just say one word about dollar dominance. I'm going to talk, I don't talk about dollar dominance at all. I mean, that's the dollar dominance is not necessarily useful concept to think about the flexible exchange rate regime. So I am more sympathetic towards the concept of the inflation target regime. So that if you have that regime, actually you don't really have to care about the reserve currency. But of course, that's for the transaction purposes and for other purposes, you're going to have to worry about the one particular sort of currency to do transactions. But my broad understanding is that if you have sort of the IT regime, inflation targeting regime, we don't really have a big trouble. Now, I do need my slides, but here it's not coming. In a minute. Take a pause and... Okay, I cannot entertain you. Okay, so several things 3 points I would like to make. The first point is that the exchange rates and their regimes have been the interesting intersection of politics and economics, both domestic and foreign. So, and will remain so in the future. So I'm going to talk about the regime, but regime has several dimensions. But the choice of a regime is not only economic, but political. So that's what the first panelists, the panelists at the first session testified. So, and as such, politics and public opinion matter a lot, and the issue of exchange rates are easily politicized. As a deputy governor of the Bank of Japan, what we have been criticized for these recent days was the depreciation of yen. Okay, but before then, that the BOJ has been criticized for appreciating yen. So, and we'll come back to that point with my slides, maybe. But there's interesting sort of fluctuation of public opinion. My second point is, because this is the 50th anniversary conference on floating exchange rates, let me start with putting this 50 years of existence into perspective. Now, looking through history,
the current floating exchange rate system is quite resilient. Okay. And the gold standard system, international gold standard system, has lasted from around the 1960s. Oh, here comes. Okay. To me and to the, I think, project question. Oh, good, good. Thank you very much. Okay. So let's go to. Is it responding now? Okay. Yeah. So I have already talked about my first observation. The second observation is that the 50 years in perspective. So at most, I think the international gold standard system has lasted, let's take the 1870 as the starting point, and the lasting point is in 1914. That's the kind of the framework for the international gold standard system. The interwar restoration period was quite short-lived, and precisely because of the onset of the Great Depression. And the Bretton Woods system, if you take the longest sort of the time interval from 1946 to 1973, the flexible exchange rate system has already outlasted those international monetary systems. So the one reason precisely this is a floating exchange rate system, so that's lots of freedom and flexibility to deal with shocks. And another reason is the rise or the emergence of the inflation targeting. So that gave the international monetary system a lot of sort of stability with freedom. Now, so in this sense, that's one could think of 50 years of existence into two periods. Sorry, it's not that bad. I mean, it's the 50 years in existence. Now, I would like to divide this period into two. One is the sort of the adolescent period. So from the 1973 to 1992, or maybe to the mid-1990s. And after the coming of age, a more mature period emerges. And it became durable and stable due to the transition to IT regime. This, I have relied on the Andrew Rose's characterization of the international monetary system. I'm going to talk about that. And under IT regime, exchange rates volatility has decreased. All right. So, sorry. Yeah, okay. So this is the sort of the schematic comparison of international monetary system. Gold standard, Bretton Woods, and inflation targeting. Regime durability is quite high for inflation targeting, precisely because it has not been planned. So it's an unplanned sort of bottom-up system, so that it was quite resilient. Now, how about the volatility? I have replicated and expanded the Reinhardt and Log of the 2020 paper. So you see the first rise in the volatility and then the declining trend in the volatility for US dollar, JPY, and USD euro. So you see that's the reduced volatility. Now, of course, in this sense, we have the adolescent period and the more mature period. So the next question is, is this current system experiencing sort of midlife crisis or being fit at 50? Okay. So that's the question for the last session. Okay, I'm going to make, the third point about the Japanese experience. Now, if you are on the inflation targeting regime, the volatility for exchange rates would be reduced. But that's not the whole story. So that's where I come in. That's the Japanese experience. So Japanese experience shows that the freedom has been testing the competence of exchange rates and the monetary policies. Okay. So my take is that Japan lost decades, 2, 3, or maybe 2 decades, has been characterized by the combination of deflation and the appreciation of yen. And the Mackinnon and Ono call this as ever higher yen syndrome. So one way to interpret Abenomics after 2013 was to end this ever higher yen syndrome, and by adopting the inflation target, a 2% inflation target. So let me go back to my slides here. Okay, this is the history of 60 years of Japanese economic history in one chart. Now I have calculated the sort of theoretical values and compare them with the actual values. Now we need a huge grain of thought to believe these theoretical values. So we don't take them at face value. But this has a very nice sort of implications to interpret Japanese exchange rate. Now, the Bretton Woods system, the dollar-dominated system, has served Japan very well. So this is a time when Japan became China before China, so to speak. And Japan didn't manipulate the currency, of course, but the fixed exchange rate has served Japan very well. But now, after that, the turmoil came in. But interesting part is that this from 1975 to 1985 period, Japan has actually experienced the Great Moderation before Great Moderation. During which time the Japanese inflation rate has been reduced to a modest 4 to 3%, while the real economic growth rate has been the highest among the advanced economies. Then came the problem about the Plaza Accord and the ever higher yen syndrome started. So you see that throughout this period, up until the start of the Abenomics, the Japanese yen has been overvalued. Okay, so underlying theme, if I want to connect this with the US dollar dominance, is precisely the question why Japanese yen didn't become a sort of a dominant currency. Precisely because Japanese macroeconomic and exchange rate policy didn't live up to the expectation. So that Japanese economy stagnated, so that nobody wants to have the currency at a stagnating economy. So right. So after that, this is the Abenomics part. So the Abenomics has sort of restored or has reversed the upward trend of the Japanese yen to the downward trend. And so we see we are now here at this part of the exchange rate movement. But as I said before, I come back to the first point. The freedom still generates fear. So public opinion fluctuates as the exchange rate fluctuates. So I use the Google Trends. I could have done a final studies using the newspaper articles count or so, but this is a kind of rough sketch. We have a saying of the endaka skill, that yen appreciation, recession, and bad yen depreciation, waru yen yasu. So you know that these two concepts are quite opposite to each other. But what we see is a kind of alternating sort of appearance of these words. So yen appreciation, recession happens when the yen was appreciated. But then again, that when yen depreciates, then people talk about a bad yen depreciation, and goes on and so. So this is a period I experienced as deputy governor of the Bank of Japan. So people talked about the bad depreciation, even though that's all sort of evidence suggests that the depreciation is the thing that Japan needed to conquer and end deflation. So in that sense, that we go back to the first point. Exchange rate regime is the intersection of politics and economics. So politics and public opinion matter a lot. Thank you very much, and thank you.
Well, we invite the panelists to please come forward. This was a very rich and stimulating set of remarks, and thank you so much for sharing your insights. Let me just start off as you're being seated here as to whether any of you have any burning comments that you'd like to make before we go to the audience for questions. Are we good? All right, let's pivot. Floor is yours. We're sure that there are lots of questions, but I think what we'll do here is maybe take a couple and then answer them in batches. Yes. Then we'll go to Fred, then over here to Joe.
Thank you. Richard Portis, London Business School. I want to take issue with Eswar about crypto and all that. First, I just wouldn't like to see you guys all walk out and start buying this stuff, You might be convinced. Look, first, it's not a more efficient technology. It's a costly technology. It is time-consuming to move cryptocurrencies. And as I say, it's not cheap. And there are plenty of data about this. It is not more efficient than my telling my HSBC account that I want to move money to Italy, for example. Secondly, in order to, stablecoin is a funny sort of concept because as we know, as we have seen, stablecoins can break their pegs, as Tether did last year and as USD coin did just a few days ago. And that's not stable. So we have to be careful about the terminology there. But they need, in order to convert either from fiat to stablecoin or stablecoin to fiat, you need a bank. You need an on-ramp and an off-ramp, okay? And the US authorities are being pretty clear that, as we know, two of the main banks that have banked for the crypto sector have failed in the past couple of weeks. And the US authorities are not very keen on US banks getting involved in this exercise. So I'd be very, very skeptical about the likelihood that cryptocurrencies, stablecoins in particular, will become a serious medium of exchange in the foreseeable future, I would say.
All right, well, that's very pointed, Eswar. Why don't we give you an opportunity to respond? And then if others on the panel have thoughts about crypto or CBDCs, I think that that would be of interest.
Far be it from me, Richard, to tout cryptocurrencies. It's worth making a distinction between decentralized cryptocurrencies such as Bitcoin, which are indeed very expensive, not efficient as mediums of exchange. Stable coins do have a potential role as mediums of exchange that have more functionality than other forms of digital payment. Now, are they the best way to conduct transactions? Far from it. They do have a role in decentralized finance because of certain functionality they have. And again, the point I want to make is not so much that stable coins are the wave of the future, but they are pointing to ways in which things could be done more efficiently. I mean, perhaps central banks would have moved towards retail and wholesale central bank digital currencies inevitably. But the emergence of cryptocurrencies, the vision of possibilities that things can be settled like Ripple does with practically instantaneous payment and settlement across national borders, that I think opens up a vista of possibilities that is leading us to, in some ways, a better world. So I think the cryptocurrencies revolution's real legacy might be the shift towards more efficient forms of payment, even if cryptocurrencies, especially decentralized currencies, drift away. But having said that, yes, the Facebook or Meta DM project is dead, but there is a compelling reason why one can think about, building a medium of exchange on top of an existing commercial or social media ecosystem, because the network is already there. We already have Amazon coin that we can use for buying games and so on. One can well imagine it being used more broadly within that ecosystem, perhaps even outside that ecosystem. And going back to a point that Philip Lane actually raised earlier, I think that poses an existential issue for many small countries without credible central banks, without credible currencies. The fact that you could have stable coins issued by trusted corporations or central bank digital currencies issued by the major jurisdictions that become available easily around the world. Now, having said that, I don't think the emergence of CBDCs, retail CBDCs, is going to fundamentally change the structure of the international monetary system. China is going to have a digital yuan, India is going to have a digital rupee, but if you think about international payments, most of those are digital already. Yes, in some corners of Africa, maybe where there are no payment systems, if you have a digital yuan easily available, and if that country has a lot of trade with China, you can see that supplanting domestic payment systems. But fundamentally, in terms of the structure of international payments and what currencies are important as settlement assets, as reserve assets, I don't think there is going to be a big change.
Other thoughts from the panel on crypto or CBDCs? I think we have a profusion of questions, which is wonderful. And we'll take several here. We'll go to Fred and then Joe. I think you had your hand up, and I saw Catherine. And I'll recognize Maurice since he's running the conference. And we'll get Jose in the next batch, plus in the back.
Nathan, I want to make a comment on your question about indominant currency.
Yes.
Why are they? An important reason, which nobody mentioned, is no country wants it. I have never yet, in my 50 plus years in this business, found an issuer of a currency who wants to become a key currency. I always used to urge Helmut Schmidt, who the Deutschmark was the second currency, to play a bigger role. He would say, Fred, you realize West Germany is the size of the state of Oregon. We're not going to play a key currency role. The Swiss would always resist any effort. Now, the French might have liked it, but they didn't have much demand. The European Central Bank has certainly shown no proclivity to aim for an international role. We talked about it a little bit this morning. Haven't seen that. Japan, at one point, looked like its criteria might be moving in that direction, certainly resisted, did not want the external exposure and risk that was involved. So I don't see anybody wanting it. Now, you might say the one exception is China, which has said frequently, we want it. But their revealed preference is the opposite. They have not, to put it violently, moved their policies in a direction that would qualify them. In fact, if anything, the policies are now moving in the opposite direction. More state control, less rule of law, et cetera, et cetera. So, in addition to all the economic criteria that we talk about, several of you have mentioned, the will or desire for a country to have an international currency, I think is lacking, and I would say rightly so, if they read correctly the British and American history. But even if they read that differently than I do, they're pretty small and therefore not quite so capable to do it, and I understand their position. But the basic point is an empirical one. I don't see anybody seeking to move into that role, and so in that sense, the U.S. is stuck with it.
Critical set of insights there, I think, and probably a good segue into a follow-up conference, actually. Great points. We'll go to Joe.
Thanks, Nathan. It's a question or a comment, and it's for Philippe on, do we know that the China trade shock is behind us? I actually, if you ask me what's the biggest international macro shock I worry about over the medium term, it would be a China trade shock. For the reason, you could imagine a real estate crisis in China really hindering the major channel of growth. It's also not going to be good for consumption, so construction and consumption could be weak. Local governments may find it ever more difficult to finance infrastructure. What is the way out? The way out is to release what Shang Jin said earlier, is this pent-up massive desire for Chinese investors to put their money abroad, push the renminbi way down and have another big export boom like we had before. And as Philippe, you've done the work, big trade deficits like these lead to protectionist pressures. So it's not a happy world. Anyway, do you think that's a risk, or is there a reason to be more cheerful?
Nicely said. Let's go to Catherine.
So to sort of follow up with Fred's comments with sort of my own experience, my undergraduate thesis, 1977, was entitled "Internationalizing the Yen Towards a New World Currency?"
You're a
question
visionary.
mark. So why did we think it was going to be, and why did we end up not? And it really goes to exactly what Fred was saying, is that you lose control of your monetary policy. And most countries don't really like that idea. And, what data were available at the time was, I think, supported the point of view that no, it wasn't going to be a reserve currency. But on that same vein, no one has brought up the Suez Crisis and the role that it played in the transition from pound dominance or sterling dominance to dollar dominance. And I wonder if we want to think about that type of framework for possible changes in the currency, who's dominant in the currency, because it suggests that this isn't something that happens gradually and with treading carefully with policymakers, that there are other factors. The geopolitical ones, obviously at the time, was a big factor.
Great. And Maury.
Just parenthetically, one China shock I really worry about is China deciding to deliver weapons to Russia, triggering secondary sanctions. That would be a major shock. But I have a question for Dr. Rakatabi. I want to press you on your newfound freedom to speak candidly as a former deputy governor. One of the things that I think has been implicit in a lot of our thinking is that the position of a currency globally depends to some degree on its fiscal backing. And I was struck that in your discussion, your wonderful discussion of the history of the yen and monetary policy, you really didn't bring fiscal policy in. But fiscal policy has clearly been there, because if not, the debt to GDP ratio in Japan would not be what it is. So what I want to press you on is what you think of the prospects for the yen, given that fiscal overhang, when probably interest rates are going to rise, and especially with the likely abandonment or modification in some way of yield curve control. What do you expect to happen, and what are the risks?
Great. Well, Masazumi, let's start with you in response to Maury's question. And let me also ask you pointedly, does Japan want to be the reserve currency? Should it want to be the reserve currency, as Fred was raising?
Yes, I think that my understanding is that there were some sort of discussions about making Japanese yen as an internationally circulated currency. So the internationalization of yen has been the sort of pet project for the Ministry of Finance International Division. So in that sense, that's to that point, I think the more officials still today, up to today, have been sort of pushing this idea of making yen international currency. But now, if you when you ask about the making Japanese yen as a reserve currency, that's a different sort of issue. So that's the clearly that would kind of challenge the U.S. dominance. So Japanese officials don't want to do that. So for many reasons, I mean, we have a security pact with the United States. So that in that sense, we are one big family in the sense that the national security-wise. So that may some may sort of wonder the challenging the sort of U.S. dominance by making the Japanese yen as a reserve currency would sort of affect the very delicate political balance. So in that sense, I think international sort of security concerns have been clearly there on the minds of the policymakers. And of course, that should translate into what you're saying. The Japanese didn't really want to make the Japanese yen as the international reserve currency. But there are two tiers. One is to make the yen international currency, and the other one is to make the reserve currency. Now, as for the monetary policy or fiscal policy, now I think that's where I think we should read the Olivier Blanchard's new book, the fiscal policy under low interest rates. So the question is that this is the Blanchard's new book is a history book, or still a sort of a book which is relevant to the policy discussions. So that comes back to the question about the future trajectory of the real interest rates for the Japanese yen. Okay, so my sense is that the Japanese have accumulated lots of savings, and still the corporate sector is a net creditor. So that is the flip side of the same coin of having sort of low inflationary environment and sometimes downright deflationary period. So that is changing, but we're not quite sure that the all talks about demographics and the lengthening of longevity and increasing sort of the uncertainty towards the future would play out in which direction. Would the real interest rates in Japan rise or fall? Okay, that's a big question mark. And I tend to agree with Olivier Blanchard's side because we still have huge savings in Japan. So in that sense, it's the fiscal sustainability is not really a huge issue given those conditions. Okay, so as for the yield curve control, I don't want to really talk about it right now, but I can talk about it. But I think that's the sustainability or durability of that yield curve control clearly, has been questioned. But now the recent sort of turn of events having an effect on the lowering interest rates, so that suddenly that yield curve control seems okay for the time being. But the question is, of course, that if Japanese inflation expectations became higher, then at some point of time, the BOJ has to think about the durability or sustainability of yield curve control. But my sense is that if that comes, that is a success for the Japanese monetary policy, not a failure. But of course, the more difficult question is how to communicate the BOJ's intention to keep sort of monetary policy, monetary easing, while that we are going to abandon one piece of the monetary policy framework.
Great, thank you. And it looks like we've got about 5 more minutes. But Philippe, I want to give you an opportunity. China trade shock, and any thoughts on the euro, and should the euro area want to be the reserve currency?
So on the first point, Joe, so I'm not a China specialist, but I know that there's a strong predictor of trade to GDP and openness. It's the size of the country. And from that point of view, China was an anomaly. And in some sense, it's just going back to the regression line that we know on the correlation between size and trade to GDP. On the politics, look, I think this is the only issue which is bipartisan in the US, which is decoupled from China. And so I think it's a very strong political movement in the US. On the euro, indeed, you mentioned the French. The French were indeed those, for plenty of reasons, and not very successful, I have to say. Those who wanted the euro to become an international currency. Remember, the exorbitant privilege is coming, is a phrase, it's a sentence under your control, Hélène, by Valéry Giscard d'Estaing. And so, indeed, there is this idea that the exorbitant privilege can bring fiscal benefit, basically. Whether it's true or not, we know there's a large literature. I do think there are some gains of becoming at least a regionally dominant currency in terms of, in particular, the supply chains, which are becoming more and more regional. So yes, I do think that not globally dominant, but regionally dominant, I think that there are some gains to that.
Great, great, thank you. Shabnam.
Yes, very quickly going back to this indominance, right? So I fully agree with Maurice that this fiscal backing is very important. I think that is the reason about euro. I mean, you know, as long as we don't have a fiscal union in Europe, I think it's very hard to have the euro as replacing a dollar. They may not want it, but again, even they want it, they need this fiscal thing. But I would like to emphasize the importance of monetary policy credibility too, and this goes back to, you know, Japan. So as Kristen said, you know, when you have another anchor and not a fixed exchange rate, you replace with an independent central bank, credible monetary policy, inflation targeting. But that is a big word, right? So when we think about that, and when you do unorthodox monetary policies, again, I don't want to, you know, criticize, but yield curve control is an unorthodox monetary policy, and that affects financial market participants in a very different way. So I think that is an important part of this: the fiscal backing for sure, monetary policy credibility for sure, and finally, you know, so in terms of the countries who want to do this, China, right, they seem to be going on the right track, right? I mean, if you really have to have all three at the same time, you know, your currency in trade, your currency in finance, and your currency in reserves, they pretty much, you know, did a lot in terms of trade, using renminbi as a payment thing, and also in finance. You know, they lend now even more than World Bank in many countries. But you also have to be a borrower, which means, you know, countries should trust you and your institutional system to hold your assets. And that's only US. I mean, so you have to have these three, again, going back to Esther's point.
Very good. Maurice, can we have 5 more minutes to take a couple of questions? Yeah. All right, great, yeah. It seems like we have lots of comments. Yeah, Jose, and then we'll go to the 2 questions in the back. And there will be a lightning round in the responses. We'll wind up in a few minutes. But go ahead, Jose.
I just want to make a very short comment about the stablecoins. Stablecoins are certificates of dollars. So the dollar still is the currency, because in order to have a stablecoin, you have to have full backing. Now, the big problem with the stablecoins on the market is that they don't have business model, because the only business model is you have to charge and spread. So if you want to be efficient, you cannot be charging for transactions. And this is why, for example, Facebook with Libra and then moved to Diem, it didn't work. And this is because the smart guys from Terra and Luna discovered a way to have a stable coin and create the crypto winter. They discovered a way to have a stable coin without backing, because they had another coin, Luna, with a complicated algorithm that would make consistent for people to keep without backing Terra at one. This is a dream of Argentina, to have a stable currency without. So, and and it was impossible, and so the business model for stable coins, and they will be at the end dollar certificates. So it's
very helpful. All right. Yes.
So a question and a comment. The question to Shabnam about emerging markets, you know, the word that we see in the markets, that you have the contamination from exchange rate volatility to local bonds in emerging markets in a way that we don't see it in developed markets. And BIS, Professor Shin has done work on it, and you've commented before. So how does that work for your exchange rate as an adjustment mechanism? And then the comments were to Ashworth and others in terms of, I think we shouldn't underestimate the importance or the convenience of wholesale CBDC in terms of sanctions avoidance. And Maurice just said, I'm worried about China supplying weapons to Russia. First of all, China is already supplying weapons to Russia. That's a separate question. But the way we can find that out, it's either via SWIFT or that money touching the dollar or the euro, and banks being afraid that we're going to look into it. Imagine if there is a wholesale CBDC transaction between the Central Bank of Russia, Central Bank of China, PBOC, or India on the oil price cap. We have no credible way of saying we can check on you. And I think that gives a lot of freedom to some of these countries.
Great, thank you. And Louis.
I have more of a comment than a question, but it's about information technology. I'm not going to talk about crypto. I don't really know that much about crypto. But I think we just way underestimate the importance of advances in IT in all of this. One of the things that was raised in this session was trade flows versus financial flows and exchange rates. I think you have to think about what's happened in the last 30 years as being capital flows have become more important, and that is the thing that it drives that more than anything else is Moore's law. Sitting over there at my desk, I have two iPhones and an iPad. Each one of those devices has more raw computing power than the most advanced computers that were commercially available in the late 90s. And I have a laptop sitting in my hotel room. I walk around with 4 things that in the late 90s we called supercomputers. And I just don't think we think enough about what that means for our world. I work at a macro hedge fund. To be perfectly frank, we're an IT firm that does a little trading on the side. And I don't know exactly how this is going to evolve. I don't think crypto is necessarily the answer, but I do think central bank digital currencies, the opportunities that those things create are going to have a big effect. And I would look at what happened in the US banking system in the last 2 weeks. That more than the question that raises in my mind is, when does the information technology make deposits in the banking system less sticky? To me, that's the most important question for the macroeconomy right now.
Great. And I suggest, why don't we just let each of you a few sentences to sum up kind of your views. Shebnem, there was one specific question that was directed to you, so you'll start.
Yeah, so the link is capital flows, exactly what Lewis is saying, because what happens is when the spreads rising means your cost of capital increasing above and over, because there's also this risk premium on it, right? So there's this safe rate increasing, risk rate increasing, so your investment collapses. So imagine at that moment, so you are going to work also to limit the volatility of the exchange rate, investment collapses more. So go back to the chart Jose showed, like how countries went from blue to green, blue the peg, green the intermediate regime. This is from Les Greinhardogov. And there's very little orange, right? The pure float, right? I'm talking about emerging markets, which is why it is very hard to identify things, as Kristen argued. But because most of them are this intermediate managed flows. But if you look at that intermediate regimes, managed flows, and those orange pure floats do much better in terms of investment collapse and output collapse, because they don't extra crash their economy by raising the interest rates, right? I mean, so they let the exchange rate go, so then they don't have to raise the interest rate, which goes back again. These are core variables. So that's why, to me, it is impossible to think about the dollar and the US monetary policy being separate things. Same thing. It is impossible to think about peso depreciation and Mexican monetary policy as separate things, right? So, yeah, but it is through investment and soft cap.
Excellent. Philippe?
Just a very general comment on I think the need for more research on the link between geopolitics and geopolitical tensions, military conflicts, and all these issues. I don't think we understand very well.
Yeah.
I mean, this is difficult. These are difficult things to test, and therefore we certainly need to speak more to political scientists and historians. But I really do think we're getting into very new territory, and from that point of view, we are we have not made the right research on these topics.
Excellent point. It's a new frontier. And Azor, you're our visionary on the panel.
So I go to a lot of crypto conferences these days, and I'm seen as a skeptical party pooper, so I don't want to leave this room with all of you having the impression that I'm touting crypto. But the point about digital technologies having significant implications for payment mechanisms, I think, is a really important one. It is going to change the nature of payments domestically. It has already done so in many emerging market economies. It is going to change the nature of international payments. So there, the bite that sanctions will have, the ability to monitor payments among countries is going to decline. But having said that, I think as stores of value, there are going to be some very important characteristics that still remain essential for currencies, assets to have those characteristics, which is why I argued that we might see something of a bifurcation between these roles of money, both domestically and internationally. To complement Fred's point, if you think about the supply of safe assets in the world, and think about it in a slightly different way in terms of this net supply of safe assets. If you think about the Fed, the ECB, they don't have that many reserves on their books, but the Bank of Japan, the Swiss National Bank, and so on accumulate a lot of reserves themselves. So if you look at the net provision of safe assets to the rest of the world, the US becomes even more dominant in some sense. And finally, on this issue about whether we are going to move away from this equilibrium, which Philippe characterized as a stable one, I would think of it as a suboptimal but stable one. And building on the work of many people in this room, Gian-Maria and Philippe, Helene and Maurice, I think the gross stocks of foreign assets and liabilities and the currencies they denominate in really matter in this context, because if a decline in the dollar's role were to be accompanied by a depreciation of the dollar, that would represent a pretty significant transfer of wealth in effect from the US to the rest of the world. And I don't think the rest of the world is quite ready for that. So we are pretty much stuck in this equilibrium for a while. And if anything, we're getting deeper into it.
And Masazumi, the last word.
Oh, last word? Okay. So two things about China and the digital technology and CBDC. I think about China, I think you should talk about, of course, politics. And you should talk about the China's role in the world international relations. So that if you go back to the switch from the pound sterling to the US dollar, clearly that was a kind of one big event. But you should see that there are some sort of similar sort of context between the pound sterling works and the dollar works that has been sort of a free market, financial market, and the restrictions are not really there. So about the CBDC, I think that you're right. I think the Louis is right. We shouldn't underestimate the power of natural scientific technology. But what I'm been worrying about is that are we keeping up with the sort of social scientific technology to accommodate and absorb these new developments in natural scientific technology? So that, when we talk about CBDC, we should think about lots of other things, like how the two-tier system of banking would survive or not. Should we abolish this the current system, or should we go to another level, another system, or improve upon it, or money laundering, and all sorts of concerns? So that in that sense, we cannot really talk just about natural scientific technology and science, but we should really think hard about how we should handle this technology implementing into the society.
Very good. Thank you. We're so grateful to the panelists for the excellent insights, the excellent questions. And looks like Adam's ready to make an announcement about appetizers.
First, just to repeat, Nathan, that was terrific. I had to step out for a bit, but I got to watch online while I was... Anyway, you guys were terrific. Thank you. And Nathan, of course, was a very special moderator.
Thank you, Adam. I appreciate that.
As Nathan said, and as I hope all of you gathered, we'd like to invite you to the Anthony M. Solomon Sculpture Gardens behind me, also known as the Institute Backyard, for wine and snacks, a reception. If you're not sick of talking to each other, please go ahead. Jessica, any corrections or updates to that? No. Okay. So please do join us, and we'll continue the conversation informally. And we'll look forward to seeing as many of you as possible back here tomorrow for another half day of really terrific discussion. Thank you.